Good morning, retail traders. This is the Sneaky Snake trading strategy where I talk about chart patterns and moving averages. Good morning. Good morning, retail traders. This is the Sneaky Snake trading strategy where I talk about chart patterns, moving averages, and being in the now. I have a feeling that a lot of traders are a little bit shook up right now because of the small pullback that we've had. And I'm going to show you, I did a video a few weeks ago about calling this pullback before it even happened. The indicator was a double top pattern at an all-time high. And then also I noticed on the yearly candlestick that we had a triple top. I've never seen anything like it where the triple top, and I'll show you that here in a second. But out of the 20 years I've been trading, I've never seen a candlestick pattern like this. So I had to safely assume that the double top all-time high and the triple top yearly highs candlestick pattern was definitely a hard resistance, very hard resistance to break. A lot of indicators out there, but a triple top is, a lot of the people that trade on Wall Street use that as an exit signal when they're in a trade for a long swing. And I've been told that by a few of them. Me, I know a triple top is a hard resistance, same as a double top. You're going to have a pullback. You might as well sell, take profit, and buy the dip. So today we're going to talk about the resistance lines and the support lines on the SPX and the SPY, which I called out a couple weeks ago. And we're going to start off with the SPX. Now I added the MACD on here, and I'm going to talk about it briefly, and I'll also put in the video below there's a link where you can learn and study the MACD and on how to trade it. But we've called every pullback and every resistance on this trade from the beginning. If this is the yearly, so we're going to go to the 3-year, and it's real simple chart, real easy to read once you understand what a support is and how to find a resistance. For example, back in September I wrote a song about this pullback. We had 3 black crows bouncing off the 200. They gave you plenty of opportunity to get in this trade. 3 weeks to think about getting in this trade. But 3 black crows is a bearish indicator, which could cause for a possible reversal. And I've talked about that many a times. It is a bearish indicator. And if you look it up, they'll say it's bearish. But this is called a flush out to me. And especially when you hit a moving average of the 200 SMA on the weekly, it's going to bounce up. As we started to bounce, and I called every one of these pullbacks, and then as we started to move up, I called what you call it a head and shoulders resistance. And we hit that head and shoulders resistance and pulled on back. So you've got also in this here 3 black crows as it hits the 200. You also have another pattern in here that can tell you that it's a reversal, and that's called the inverse head and shoulders. As it starts to pull back, there's your shoulder line, your left shoulder, your head, your right shoulder, and your right shoulder. And I called this reversal out. And then we came up and hit the neckline of a head and shoulders, which is another possibility of a reversal. Once you hit that shoulder line, it can pull back. And that's exactly what we did. We draw the trend line right here, move it across, and actually use the wicks, but we're going to use the bodies in this case. And it brings you right up to that top of that candle, which is the shoulder line of the left shoulder and the right shoulder in the head. So it pulls back. We called this out as we started getting close to the shoulder line of this inverse head and shoulders. She bounced back up. Now we've got a double top resistance. And I put out a video a couple weeks ago that we were approaching this double top and that it'd be an all-time high, and we might not break it, we might hit it to the penny, but it's definitely a strong resistance. And I mean strong, I mean you're going to have pullback, and we've had a real strong pullback. So now I'm going to tell you where I think we're going to go next, and I've already mentioned it in the video 2 weeks ago. Once we hit this all-time high, before we hit it, that we're going to pull back to the 9 on the weekly, or we're going to pull back to this previous high and then come up for a triple top break into 2024. Now, a lot of these fat cats on CNBC, which they've been pumping stock, they've been pumping these all-time highs. I mean, crazy highs. For example, if you look at LLY, this thing has had one heck of a run. If you look at the yearly time frame, and it's consolidated into what I would call a triple top. 1, 2, 3, we pulled back. Then we came up here to a double top, all-time high. So they're pumping this stock, and this stock has had such a heck of a run that it's scary. It's beyond scary. It's a CNBC pump. So I shorted this thing yesterday, and unbelievable, I was able to get $400 out of a contract. Should have kept on holding it. Let it run down to my moving average of the 50, or maybe come back to this triple top. What was resistance now becomes support, and you got a triple top breakout right here. So this thing could easily jump down here and bounce off 600 long. I mean, seriously. So I'm looking at the MACD. I've got the MACD here as an indicator. As we start to cross down over it's a sell signal to get into this trade. You know you're irrational when you got a big gap between the buy and the sell indicator, and when it crosses down, it's time to exit that trade. And that's what I did yesterday. This is on the 1 hour time frame. So as it starts to curl back up, it'll be time to get back into this trade. Now CNBC's been pumping the heck out of this. Same as the way they've been pumping the market at an all-time high. They know better. They know better. Their fundamentals don't match up with mine. There's a difference between the fat cats and the private sector. So I call these people out all the time. I'm the devil's advocate when it comes to these pumps. You know, they're in these trades, so they want to keep them going, and they're starting to get a little shook up. I can see it in their voice. I was listening to them yesterday, and they're just getting a little shook up, getting angry because the market's pulling back. It's going to pull back. You got an all-time high, double, triple top. I mean, come on. It's nothing big. I mean, we're just having a consolidated period. We've had one of the biggest runs I have ever seen in the 20 years that I've traded. Okay? This is one of the biggest runs that I've ever seen in my lifetime in the 20 years of trading. And I'm going to look at the SPX and the SPY. The SPY was up 20-some% in a matter of a week or two. Hello. Traders, fundamental traders, these fat cats, they're lucky to get 10-15% a year. And they're getting 100, 200, 300% on a trade. We had an all-time bottom. So SPX. And this is what I've been saying for 2 weeks. I said they're irrational. We had a nice little run. And when we had that big gap up, and that scared me right there. That means the fat cats came in here and they just run this stock all the way up. They're saying we don't have a Santa rally. I called this Santa rally back here way before Powell came out and said he wasn't going to raise interest rates. It was a no-brainer. We're going into an election year. If you don't think it's all political, it is. These progressives love the money that's being printed, and we're going to get a lot of money printed in 2024 that hasn't even been used yet. So they're going to come out with new bills and blah, blah, blah. We got a possible government shutdown coming up because of the open border policy that the Biden administration is now involved in. And it's tearing up our cities. It's making America bankrupt. And I think we just hit $34 trillion in debt. And that's the interest alone is more than our national defense. It's way out of hand. And it's just, So I stress out on that a lot. So if we go in here to the SPX on the daily, we have one resistance here at the 21. Now we could get a little shake up with this double bottom here, and we could get a possible, but we kind of broke below that, and now we got an inverted hammer down here below the 21. Momentum's a hard thing to stop. So the next support levels is going to be every body of these candles. And then I think we're going to get back to that weekly support level here at 4607. Now we've got earnings coming out within a week, and I think they're going to be good. I think they're going to be better than anticipated. But economists, I mean, CNBC was pumping the market like they forgot that we were even. They've had it all wrong for the last 2 years. All the fat cats, so very few of them that know how to chart, know how to find reversals. It doesn't mean the fundamentals don't mean nothing if you can't stop the momentum. And once you hit a hard resistance, we're going to pull back. We're going to pull back. Always pull back. And they got to consolidate. We haven't consolidated in 2 months, 9-week period, where we've had nothing but a straight run. And it's just unprecedented. Wall Street has been talking about the interest rates for over 2 years. And Powell has tried to done the cycle that happened back in the 70s, where they screwed up, and it caused our country to go into a big recession. But times are different, and you cannot compare them times to the times of today. We are extremely greedy in this market. I think the money's going to go into small caps and micro caps. I haven't seen the penny stocks run like, they're so down so much in the last 2 years. And I was a penny stock trader for over 10 to 12 years, where I traded pennies every day. And I did real well in the pennies back then, but we've been nothing but in a downtrend ever since. So I'm going to be trying to figure out how to find trades in the Russell 1000. I'm going to be looking at the micro caps, and I'm going to look at the mid caps, and I'm going to start playing some of these notorious. They've been beat down so much. I'm talking about stocks that were $40 at $2. And if you go in here to your scanner, you got the Russell mid cap right here. And that's what I'm going to be watching today for any breakouts. And I might start putting a little bit of money in the sidelines there. And you got the micro futures, you got the market movers, you got the Russell mid cap, and that micro cap and mid cap. Those are the ones I'm going to be watching, seeing if there's anything that's breaking out on these stocks. And I'm going to put me a little. Let me see if we can get here. It's like right now, we've got ATXI at 34 cents. This thing's had a nice little bounce. We're starting to form a little bear flag. So if this thing knifes down to the 51 maybe, or bounces off this here wick, I might take this trade. But I got to look at the news and see what's going on. We got CPRX. But it's had a really huge breakout and pulled back to the 200 on the 1 hour. Plug's been beat up notoriously. If you look at these charts in the past 3 years, Plug was at $60, now it's at 429. CPRX 2211, now we're at 17. Riot had a run of $79, now it's 15 something. VYGR, this one here had a big spike yesterday. Sneeze, SNES, here's another good one that I like trading. Hive, Blink, look at where Blink is now, $40 stock all the way down to $280. ALT is another good one that I used to trade a lot, and it's already started its rebound here on the weekly. You got AI. It's a new one to me this year, but I've been trading it with the AI sector. I mean, they've just been beat down so much. Here's one that was at $10. Now we're at 155. Invax is another good one. Invax has had some splits and stuff. We're down here at 477. So I'm going to keep a good eye on a lot of these stocks. FBIO. And how I do that is I pay attention to the volume breakouts and the gap ups. And once I figure that out, I'll keep a good eye. I'll see if they have any news. That's the micro cap. Let's go to the mid cap. If I find it. Daku's on here. Here's another good one to watch. DocuSign. I mean, this is one that they really were pumping here this year at the beginning of the year. Oh yeah, I'm going in DocuSign long. It's a $314 stock. Lulu's had, this might be a good short to the 9, back to this previous high. Ulta. This Russell Midcap's a pretty good one to watch. I've got some good stocks in here. You got Lulu in here. Ulta is another one for perfume and stuff. Etsy's in here. TTWO. A lot of these are they've already run them up. Dollar General. Getting rehabbed, getting new management. This store, Dollar General's turned out to be a dump. Their stores went way out of understocked, and they're filthy. So they're going to clean that up a little bit. MCK's got a bear flag. We could possibly pull back on this one today. We had an all-time high on this one here. Yeah, I think this could pull back. Merck was another one that was popping. All these stocks that have popped, like Merck, this is irrational exuberance. We're at 108 and it runs all the way up to 117 in 3 days. We hit my hard resistance, so this thing could pull back and maybe a 50% retracement on this breakout. Come up here and put your fibbies in. Go to that all-time high right there. So maybe around 113, short it to this ascending triangle right here. So there's a lot of good opportunities. Don't try to overdo yourself if you don't know how to trade. Yesterday I screwed up. I'll sit here and tell you it's one of the worst days I've ever had, when it could have been one of the best days, because I called out these puts. I got in LLY and I traded it, got a couple hundred out of it. It ran up to $1,000 from where I got in, 585 on an option. Then, there was another one. Oh, the SPX. I could have made 50,000 on the SPX yesterday. I was so pissed off. I called the reversal on the SPX. I traded a put and I scalped it, and then I got back in it again. And one of the ladies in the room mentioned, Jim, you think we're going to hit this 200 SMA, which I talk about a lot. And so yesterday I called it out right here, and then we hit the 200 up here on a triple top, 1, 2, 3, and boom, she did nothing but nosedive. And I scalped it for a small percentage. And I could have had, this thing went to like $3,000, a $270 call, went to $3,000. And I had 10 of them, and I just beating my head. It could have been one of my best trades ever. It got me so upset. I mean, sitting here, I'm doing this live, and I'm in the room live, and I'm on YouTube live, and I'm getting stuck. I got stuck in a call. And that cost average down, and I ended up taking like a $300 and $400 loss on the trade because I thought we were going to reverse at an indicator, and it just didn't do it. It just kept failing, and I kept adding and adding. Before you know it, you're down 800, $900. So I had to really stick with it and add on. It's one of the worst things you can do when you're in the downtrend. And if I'd have held it today and wake up this morning, this thing probably. But I do the same day option when I'm trading the stock. That's the only one I do. So that's it. We're going to go ahead and go. I just want to emphasize the MACD and that we're in a good downtrend, and don't try to fight the trend like I did yesterday. This is probably one of my worst days of trading because I was so right and then I was so wrong. I have a good anchor and I'm finding resistance levels and reversals, and then sticking with the plan that I've already shouted out for a couple of weeks, telling everybody be careful, be careful, be careful. And here I am not going with my strategy and going against it. And that was a big mistake on my behalf yesterday. So I'll get back in it today. I talked about the philosophy and the psychology of being in a bad trade and waking up the next morning. You just got to kind of write it off and start fresh. Now, I'm a trader that trades only one trade at a time. I don't want to get stuck in this volatility. I mean, I could be in a trade and be up real nicely in a trade, and then the next day a downgrade comes up because it's too expensive, and that's what's happening. Apple. You had Apple. I mean, they're pumping the hell out of this company, and Apple has a bad reputation of holding its gains. I mean, it doesn't, for one. Many years, Apple was the one that you wanted to try to avoid unless you were going very long in it. And it was one that was and just here lately, it's caught the momentum of the AI. And you get all this bad news on Apple and never get pumping. CNBC's pumping the hell out of this because it's a market leader indicator. It has a big market cap. And I'm saying, no, I ain't. You got a ban. They banned the iWatch. And then now there's something about the phone or the iPad. So we're about to hit the 200. Now we bounce off the 200 all the time. So this today, or maybe next week, this is going to be a great trade to go long and run it up to the 51. There's a lot of people stuck in this stock that are holding on to it because it's been pumped so big. And I 2 weeks ago, I said no. Why did I say it? Because we were at a frickin' double, triple top all-time high. Any fat cat will tell you that a triple top is an exit idea. 1, 2, 3, boom. 1, 2, 3, boom. So remember the triple top. When you get up here close to a triple top, double top, off the wick, I mean, it didn't want to go no higher. It was a great short. And I alerted the room. I said, man, get this thing and take it down to the 21. We're not going to hold this. It's an all-time high. And they're pumping the shit out of this stock on CNBC. They were counting on this thing to break so the whole market would break with it. That was their game plan. And I'm saying, no. The SPX is at a double top all-time high. You've got a double top on Apple. We're not going to break this. So as we approach the previous high, which is right here, which was the triple top, this thing can start to balance out and come back up and break that triple. 1, 2, 3, and move on out into earnings. So we had to consolidate. This was too big of a run, too fast, and it was a great Santa Claus rally. The CNBC comes out here and says, well, we didn't make it, we pulled back, we didn't have a Santa Claus rally. Like hell if we didn't. We had one of the biggest runs I've ever seen in 2 months of trading stocks. So that's it. I just want to emphasize how important it is to recognize a double top, triple tops, and how to kind of take the MACD and use it in your favor. As we start to cross down, this could be a negative sign, or if we start to level off, we could start to reverse to the upside. And that's it. Retail traders, be patient. Trade stocks that have a lot of cash. As they pull back, they could be a great opportunity to get into these trades. And I'll give you one example that I haven't mentioned yet, and that's Meta. Meta did not make it to the all-time high. So there's a lot of room for this thing to run up. Now you're going to use the 9 and the 21 as a buy indicator. As we came down and touched the 9 yesterday, this week, and if we go to the daily, let's stick with the week. As long as we hold the 9, we can bounce back up, break this resistance, and hit that double top. If it does fail the 9 on the weekly, it's a sure thing that you're going to come down here and see this 21 and balance it right around the 317 area. And if we go to the daily and look at that indicator, we're definitely starting to squeeze between the 21 and the 9. Now, if the 9 starts to cross down more, crosses the 21, we're going to hang down here and hit this moving average, the 65 or the 51. She likes bouncing off the 65. So it could be a good little trace back down here to the 65 and then take it back up. But there's a lot of good opportunity out there right now. Like I said, yesterday could have been my biggest day if I just stuck with my plan. Biggest day in trading ever. And I didn't do it. I had a lot of calls. I had 10 puts. I mean, that could have been $30,000 in my pocket. Not counting the one I had earlier. So if I'd have kept both of them, oh my, it would have been a $50,000 day. So that's it. Retail traders, study that MACD. I'm going to have the indicator down here to where you can watch a video on it. You can learn about it if you're not trading with it. It is a good indicator that traders use, experienced traders. It's a great swing trade indicator. If you get the crossovers, you know when to get in and when to get out. And we'll just go ahead and leave it at that. Everybody have a great day, where I talk about chart patterns, moving averages, and being in the now.
Thanks. Have a great day. Good morning and welcome to Jobs Friday. We're going to get you ready for today's big number and the impact on the Fed, the markets, and your money. A supermarket giant is dropping Pepsi and Lay's products in several countries in protest of rising prices. We've got the details straight ahead. And ESPN is betting big on women's hoops as part of a $920 million media rights deal with the NCAA. It is Friday, January 5th, 2024, and Squawk Box begins right now. Good morning, everybody, and welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick along with Steve Leisman and Mike Santoli. Joe and Andrew are off today. It is Jobs Friday, and I guess for now, we'll put the emphasis on jobs on that, not on Friday. This is a big deal for the markets today. We're waiting to see what happens because there is a lot riding on this. Let's take a look very quickly at where the futures stand on this Friday morning. Red arrows once again. This has been this picture for the year for the most part. Granted, the year is only 4 days long in terms of trading days so far. But we have seen this weakness in the futures in the morning. We've also seen markets down for this week. And we'll continue to keep an eye on this. Right now, the Dow futures off by about 60 points. S&P futures up by 10. The NASDAQ up by 59. For the year so far, the Dow's actually down by 2/3%. S&P is down by 1.7%, and the NASDAQ closed lower for a fifth straight session. Now down more than 3% for the week. Small caps are also off. They're down by about 3.5%. And a lot of this is because of what we've seen, the action in the Treasury market. Treasury prices have gone down, yields have gone up. Honey. In fact, the 10-year this morning, back above 4%. We've been flirting right around that level. Crossed above it yesterday and the day before, I think, and then you see right now 4.04%. The 2 years back to 4.427%. Bitcoin rebounding after what's being described as a flash crash on Wednesday. It tumbled as much as 9% after an analyst wrote a note that said he expects the SEC to reject all of Bitcoin's ETF proposals this month.
God.
Other analysts have said that they expect one or more of those ETFs to be approved by next Wednesday. This is something we talked about yesterday with Pompliano. He said, forget about it, don't worry about it, it will continue on after this. This morning, Bitcoin at 43,741.
Right now to today's jobs report. Economists' forecasts call for an increase of 170,000 in non-farm payrolls, although the range of estimates is from 100 and 250,000 or more. If it holds near consensus, that would mean the economy added 2.7 million jobs last year, the strongest job gain since 2015. A hot jobs number, well, it could push investors to pare back their expectations for rate cuts this year. That's already happening. We'll talk about that in a second. Traders now see a 63% chance the Fed starts cutting rates in March, down from 71%. It's actually 75%, and at some point it was even higher than 80% several weeks ago, or a couple weeks ago. What's happening now, Mike, I think, is the market, I feel like getting a little more realistic. Paring back
consolidation
of that March breakup makes more sense to me. I think it incorporates some of the risk. It doesn't happen or happen as fast as the market wants. So what I have here, I've got to put my glasses on for this one. Looking at the January funds rate at 397, it had been as low as 375. So it's put back
January 2025.
January 25, right. And I use that, by the way, because it's a clean month. I don't have to worry about the fact that the meeting happens in the middle, which has an effect on the funds rate. The story here, I think, is that they're putting one of them back. So the Fed had forecast average 3 for Fed officials. Market went to 6. Now they're down to 5. So they're getting a little closer.
Yeah.
And it is just
pushing it out.
And pushing it out just a little bit. The probability of...
He's right about consolidation, but they've been wrong about everything else. They'll pump this market as hard as they can. They're going to come up with excuses now because of how they failed here at the end of the year.
199 from the prior month, which was flattered by the union workers returning as an input to their models. I think the actual number was maybe down 160, 170. So I think the idea of it cooling a little bit below that makes more sense to me.
So we're somewhere around trend if the consensus is met. I mean, sort of a equilibrium moment in the jobs market on the way to who knows what, but it seems like it's a slower but still relatively healthy level, I guess.
What interests me is the Fed has talked a lot about risk becoming two-sided.
Yes.
when they talk about that, that's also true for the market of risk being two-sided. So what does that mean? Two-sided risk means there's some risk that there's higher inflation, also risk there's lower inflation and slower economic growth. So at some point, as these jobs numbers come down and moderate, there's also a lower level to start thinking about.
Yeah.
Like if this number, for example, I don't think it does, comes in below 100,000, is this a, oh no, the economy is weakening more than we thought, and the slowdown is stronger than we anticipated?
You're explaining, in my view, why the Fed funds futures has a lean in that direction for more than the Fed might cut. Because once you know they're done, and once you know inflation is going, better than they expected by now, and once you know they don't want to keep rates too restrictive, all those things, you put everything that we are already aware of about how they may react to the incoming data, and you say, okay, which direction is the risk in terms of more cuts versus no cuts? And you think it's probably, no, at least on a hedging basis. And I guess the other thing I would say is, markets always overshoot the short term. There's a lot of momentum in dual trades at the end of last year, which is buy treasuries, assume disinflation, assume the Fed's easing, and also just stay with the stocks that are winning.
And
we've unwound part of it.
Don't do that.
Just in terms of overshooting, that's what it felt like.
The market right now, the S&P 500 has checked back to the December 13th Fed meeting level. It's 47.07 to close that day. It's actually below that. 10-year Treasury yield was a little over 4% on that day. That's where it's back to. So this is what the market does. It kind of has to, 2 steps forward, 1 step back if we're lucky.
I can't think of it as ebbing and flowing like it
Yeah, exactly. Yeah.
Like you just explained the difference between a Fed forecast and a market forecast.
Right.
Think about the roulette table. You guys ever play roulette?
Yeah,
So,
badly.
Badly. It's a terrible game. It's one of the worst
Not a
games
game.
in the casino, odds-wise. But here's the deal. A Fed official, when they do a rate forecast, they have to come in and essentially put their chips on one number. That's a Fed forecast. The market, as Mike just brilliantly explained, can come in and put chips on a variety of numbers. And in part, what we talk about when we look at these probabilities is the result of not just one bet by one guy and one number, but it could be one guy's bet or one woman's bet on a variety of numbers. I'm going to take 10 chips, put them on 9. I may pick a whole bunch, put them on red. I may take a few
By the
more.
way, that's the smart way to do it. How often is a Fed forecast right? You're kind of betting all over the place and things are going to move and change.
But the point is that the Fed forecast requires the official to come in and say, pick a number.
Yeah.
And so that's what they call the modal forecast, whereas you come in, and I like the way you explain that, the market has to bet not only on the possibility of upside inflation, but also downside, the idea that somehow the economy is weaker than we thought. So we've got to put some chips over there. And that's one of the reasons you get this dispersion. But it is also important to look at how the market's leaning. It certainly has leaned aggressively.
Right.
And now, I don't know, Mike, if you think that you get to a point where the Fed and the market are more in line, the market has more adjusted the price level to the risk that it is two-sided, and then the market can move from there.
Right, I think that's right. You have this reset of expectations, and then also, I just really push back against the idea that because the S&P got to 4750, and because the Fed funds futures said X at that moment, that we're at 4750 in the S&P because we're going to get 150 basis points of cuts. Those things are not causal, or they don't explain one another directly at that moment in time. Is the way I All right, we're going to get to all this continually in the next couple hours. But one of the world's biggest supermarket chains, meanwhile, is dropping several PepsiCo products in protest of what it called unacceptable price increases. Carrefour operates thousands of stores in more than 30 countries. It will stop selling Pepsi, Doritos, and other products in France, Italy, Spain, and Belgium. A spokesman for the French company said it will add notes on its store shelves explaining the change to customers. A spokeswoman from PepsiCo told the Journal that they've been in discussion with Carrefour for many months, would continue to engage in good faith to try to ensure that their products are available.
I need to chime in.
This is one of my favorite stories of the day, actually, what's happening with here, the push back and forth on it, because I think you need to be concerned as an investor that this could be the end of the margin expansion. They're pushing back. Carrefour's pushing back because they're saying inflation has slowed down. You can't keep raising prices like this, and that's not acceptable to our customers. If you see this happening with other big retailers, which I will anticipate would be the trend, I'm sure it's already happening with the Walmarts and the Costco's of the world, because they have a lot of control over these things. They always push back on some of these things happening. If you see that continuing, it's going to signal to investors okay, you're not going to continue to get margin expansion here. Look out. You can't use inflation as an excuse anymore for raising your prices.
I love this story because this is where the micro meets the macro.
Yeah.
Tom Barkin, the Richmond Fed president, who has been the best guy talking about the process of inflation, the micro process of inflation, the process by which, before the pandemic, you went to your customer and said, I need to charge you 10% more. And they laughed in your face and said, go back and do the numbers again or I'm going someplace else. That dam broke during the pandemic. These prices were accepted. They passed them on to customers. We're now on the other side. I think Barkin looks at this and he smiles and he's happy about this. The pushback from the customer to the supplier is an improvement in the micro inflation dynamic that then ends up in the macro numbers.
Yeah, I mean, granted, Carrefour doesn't have many locations in the Richmond Fed district.
I'm a small business owner. I have to have my supplies to keep it going. During the Biden administration, my supplies have gone up 30%, and they've not come down one bit. None of them. Trash bags, paper goods. My accountant fees are up 34%, almost 33%, from 100 to 150 in a year. I can just go on. The gasoline costs, I'm paying double what I was paying. Not double now, but I was paying double. You got the government coming out, giving government employees a 5% increase in pay. That doesn't affect the private sector. There's a lot of bad shit going on right now that's not being, and they're talking about it. Things are just too damn high. And the spending's not stopping. I would love to see a good government shutdown over the border crisis. We've got a whole new welfare system of 12 million people coming into this country in the past 3 years, 2.5 years. The crime rate will rise about 10% in 5 to 10 years. It's a no-brainer. When you bring uneducated people into the country at this alarming rate, it's going to affect a lot of stress in the country. I hate to be a negative, but it's just all shit's all hitting the fan right now. And it hasn't even begun.
Sliding again this morning, now down more than 6% since the start of the year. We're going to dig into that move after the break, and later, Energy Secretary Jennifer Granholm.
But I don't need to put, we don't need to be putting fear in the market, because all we're doing is consolidating on one of the biggest runs I've seen in over 20 years of greed. So you have to consolidate. And if we just pull back to, like I said, on that previous high, I guarantee into earnings we'll have a nice little bounce. 100, I guarantee it. So be patient. Try not to overtrade. And you'll do well. And I'll be back. Make sure I got all my volume up. Yep. Alrighty, I'm ready.
the app today.
Apple shares off to a rocky start this year, down about 6% since Tuesday, following two downgrades citing growth concerns and a general sell-off in the tech sector. Joining us now is an analyst who also downgraded the stock last year, Barton Crockett, Rosenblatt Securities senior analyst. Barton, good morning. You saw the writing on the wall in August, I think, before some of the folks that were out there. I thought it was interesting reading your notes. Reporting on Apple is like reporting on a small country, right? And there's all these different sectors out there. I'll just quickly summarize what I think I got, which is you think the valuations are high relative to historical norms, and you don't see the growth drivers. Give us some detail on that idea.
Look, I mean, I think Apple is a remarkable company, but I would argue that it's a stock that you can trade. You don't have to own it all the time. And I think you can do that because it's a maturing business. The growth trajectory is very much leveling out, and I think the combination of the growth slowdown plus valuation, which when we downgraded it in August was at an all-time high at 30 PE, 1.5 times the market average. You did not need to be overweight at that point. Since then the stock's pulled back a little bit, but not enough where I feel like you need to kind of jump in. This is a business that's going through cycles, and the cycle they're in right now is one of muted growth. It's a business that you'd love to own if they're rolling out disruptive new technology, which they have a history of doing. But I don't think Vision Pro is that. I think Vision Pro is more a bunt than a home run. And I think the rest of the business, is fighting through some, choppiness. And as great as Apple is, I don't see them putting up the kind of earnings that's really compelling at this point.
So the biggest part of the business are the phones. And I guess you're not that excited by the growth rate of the phones. Talk about where it is right now, where you expect it to go.
Okay, so, I think the phone trajectory in the December quarter is one of flattish, not really much growth. And I think we're going to stay in that kind of trajectory through next year. And, that's important, right? And if you're not growing in that line, if the trajectory there is kind of meh, which is where I think the consensus is at this point, even if they're hitting that kind of lowered bar, I don't think that that's going to be something that's going to be really compelling for the shares. A flattish iPhone, I think, is a really tough kind of setup. So iPhone is kind of there. I mean, it's really not a lot of excitement right now in iPhone.
So one part that looks like it's doing reasonably well or better is the service part of the business. And apparently Tim Cook's a little more excited about this. But that's not enough for you to get excited about the growth prospects for the company?
Look, I think services was tremendous in the September quarter. I do think a meaningful part of services is tied to search, the search ad market. And I think what we have there are increasingly difficult comparisons. So I think to argue that they accelerate from the September quarter is difficult in the face of that. You also have clearly a lot of regulatory noise there, the antitrust trial, some of the App Store regulation. So the headlines there could be a little bit problematic. The impact of that on the business, it's not something that you'd get excited about. Maybe you'd be a little bit concerned about what could happen there.
Barton, Apple's always a fascinating stock in the way it trades relative to fundamentals. Everything you've said has been true for some time. Of course, you downgraded it back in the summer, and yet the stock continued higher in this latest quarter. The valuation has gone up, and there's kind of this separate thesis on it, which is it's a super defensive stock in a tough macro environment, completely insulated from the rate pressures or anything else that's going on out there. And at the same time, Berkshire Hathaway owns 5.9%. They're not selling any. Apple buys back stocks from the rest of the world. And it's sort of this magical, melt-up machine. On the other hand, the stock does nothing for 18 months at a time, 2 years at a time sometimes. And so it has been this tough one to trade. How do you approach it with all that?
I think it is okay to trade it. I think when the valuation is stretchy and the growth trajectory is unimpressive, it's okay to ease up on it. If the stock were to pull back a lot, you could get into it even with kind of muted growth. I think you've got to look at it much like you would other consumer products goods companies where you're not in there all the time. you're there when it makes sense. As for the macro, look, I think if we are in a more difficult macro, if the economy were slowing down and the stock, we're certainly no more expensive than it is right now, maybe a little bit cheaper, one could get more interested in it as maybe a relative kind of stability kind of CPG play. But that's not what we're feeling right now. We're feeling that the economy is pretty good, pretty Goldilocksy, and that's maybe not the defensive argument for Apple, and I think the growth argument for Apple is also challenged right now.
Gotta go, Barton, but do you have an entry point that you feel comfortable?
So we've got a 189 price target, and I'd like to see double-digit kind of opportunity to our price target. I think you'd have to see a little bit lower for us to get more interested.
Barton, thanks for joining us this morning.
Great, thank you.
Coming up, ESPN and the NCAA inking a $920 million media rights deal. We'll tell you what drove up the value from the previous deal. That's next. Squawk Box will be right back.
NBC.
The NCAA and ESPN have reached a new 8-year media rights deal worth more than $115 million annually. That is roughly 3 times the annual value of the current 14-year deal. An NCAA spokesperson confirmed that an additional 25%, or $28 million annually, will help with production and marketing costs. The deal runs through 2032. It includes the rights to 40 NCAA championships, 21 women's, 19 men's events. Also provides international rights to the Men's College Basketball Championship, which is carried by CBS in the United States. Sports agency giant Endeavor, which consulted for the NCAA on the deal, said about 57% of the value of the deal is tied to women's college basketball. Specifically, the next major sports right deal, specifically to women's college basketball. The next major sports rights deal up for grabs is the NBA. Its current deal expires following the 2024-2025 season.
I mean, it makes sense. It makes sense in part because of gambling on sports, which has increased viewership on sports, which means that you can charge more for ads on these things. If you've been watching Caitlin Clark and what she's been doing in women's basketball in Iowa, she's about to break the scoring record of the NCAA.
I know our minds are kind of warped in terms of dollar values, but it seems really cheap to me, like $100 and something million a year for this aggregate deal.
They didn't used to get the viewership.
No, of course, yeah.
Now they're getting the viewership, which is why you have the dollars that will go along with it, and I think it's commensurate to what you've seen, and a lot of it has to be tied into.
Yeah. ESPN also can create the interest itself. It's promotion, and Bob Iger made this point with Disney when he talked about sports rights. It's like, nobody else is going to be talking about your tournament for the entire day the way we will on ESPN, and therefore feeding into the promotion of it.
So they have a bit of an advantage in terms of the bidding.
They kind of almost creates its own demand a little bit.
I had a little bit of an opposite take from you, Mike. I'm still just blown away by the amount of money in college sports. In my lifetime, what's gone from you can find a college game here or there, and now it's just big money.
No, fair enough. I mean, in real world dollars, it's big. And relative to history, it's big, but just relative to like the money that gets thrown around in pro sports.
Look, I watched every championship game, and I'm going to watch the when is the championship?
Next Monday night.
Yeah.
I'm glad to see the athletes get a share in what they've done, but at the same time, it also makes me sad that everybody leaves every team every year.
It's up for grabs.
They all go to the transfer portal. It's hard as a fan to be like excited about the team because you really get invested with the players, and when they leave after a year, it stinks.
I just had a reaction because, as an economics reporter, the idea of these guys from Florida State sitting out makes perfect sense. You go in, you get an ankle injury, you reduce your value by $3 million. At the same time, as a fan, very sad to see what happened with that game, right?
Right. It's hard.
Okay, let's move on. Last night, on Last Call, Brian Sullivan spoke to the CEOs at the Goldman Sachs Energy Clean Tech and Utilities Conference. Here's what Chevron CEO Michael Wirth said about the future of the energy industry.
5 years from now, the world will be using more oil and gas than it is today.
More, not in 5 years, more.
5 years from now, we'll be using more than it is today. We meet demand. We don't control demand, we supply demand. And so we will grow our oil and gas business over the next 5 years. We'll also grow our lower carbon energy businesses. We'll grow renewable fuels, we'll grow our hydrogen business, and we'll grow our carbon capture business. So we need to reduce the emissions from traditional energy, which we're doing, reducing our carbon intensity of oil and gas that we produce today, at the same time as we invest in new technologies to grow new sources of supply as demand for all forms of energy continues to grow.
Wirth said he'd also been surprised at the recent strength of U.S. oil output. Now the largest producer in the world, the U.S. is. Shares of Chevron falling nearly 17% in 2023 amid a 10% decline in the price of crude.
And separately, ExxonMobil warning investors that it's going to be taking a $2.5 billion write-down of the value of some California operations. This comes just days after rival Chevron said that it would incur a hit of up to $4 billion, largely because of California's energy policies. Exxon's impairment is primarily related to its operations in Santa Ynez. After a 2015 pipeline leak there, it shifted crude shipments to trucks, but California regulators stepped in and restricted Exxon's ability to move oil by the road, citing risks to other drivers and the environment. Exxon said that continuing challenges in the state regulatory environment have impeded progress in restoring operations. It's part of the reason that gasoline prices are so high in California relative to where you see other states. Part of it is the gasoline tax. The other part is the refinery issues that they've had. ExxonMobil shares up by about 22 cents. When we come back, jobs predictions and the potential impact on the Fed, the markets, and your money. That is next. And later, Dr. Scott Gottlieb will join us on the FDA's new probe of potential side effects for the weight loss drugs that have surged in popularity. Right now, as we head to a break, let's take a look at yesterday's S&P 500 winners and losers.
Asset.com.
Good morning, everybody, and welcome back to Squawk Box. We are live from the NASDAQ market site in Times Square. The futures this morning under pressure once again. You're talking about the Dow futures now down triple digits, a decline of 108 points. NASDAQ futures are off by 73, and the S&P futures are down by about 17. Of course, this is all coming before the big number that hits at 8:30.
Yeah, that December jobs report is less than 2 hours away. Joining us now for what to expect, Jack Caffrey, Equity Portfolio Manager at JP Morgan Asset Management, and Michael Gaitman, Chief U.S. Economist at Bank of America Global Research. Good to see you here both. Gentlemen, Michael, you're expecting about 175,000 net new jobs. That's roughly in consensus. Is that now, I guess, the new run rate? Do we have this equilibrium in the labor market where this is what we should expect for now?
I think we should expect employment growth to slow further, right? So the 3-month average coming out of December was about 204,000. It was 221 in September, 321 a year ago. So I think directionally we should expect further cooling. So I don't think we've quite hit the point where employment growth has stabilized. I think we should expect it to slow further.
And are we, is the top spinning slowly here enough that we have to worry about it falling over in terms of getting toward a stall in job growth?
Possibly, right? Most of the job gains have been coming from leisure and hospitality and education and health, right? The last of the so-called catch-up sectors. But in terms of private sector employment growth outside of those, over the last 6 months, we've lost about 48,000 jobs. So I think the concern would be when the catch-up effect fades, when does that happen? And when it does, are we basically at zero employment growth, or will kind of jobs start coming back in the remainder of the economy and be strong enough in leisure and hospitality and education and health to keep us at a more sustainable run rate? That's the open question.
Zero growth at like 3.7% unemployment is a funny spot to be.
Yes, it's an odd spot to be, right? And maybe a Fed more concerned at sticking the landing and having a slightly more balanced reaction function, as the minutes indicated, would react to that more quickly. But I think that is the open question. Where do we settle in when this catch-up effect fades?
Jack, since at least the November CPI report, like November 13th or something like that, we really got further confirmation. People got more confidence that disinflation was really in train. It seems like that released investors to view good news as good news for the economy. Is that still the case? Are we still making sure we want to see that the economy is resilient here?
I think that we have a little bit of creative tension on a cross-asset perspective where the equity market wants good news. I think they need good news in order to justify the prospect of double-digit earnings growth. I think the bond market wants to lean into inflation remains transitory and that we are going to get to a softer landing. And I don't want to accuse my fixed income colleagues of always wanting to look to the dark side, but I think they still remain a little bit more biased towards the downside as possible, and the downside is good news for them. And so that, I think, looking to drive earnings, you almost need something miraculous, because fading inflation takes away pricing pressure for the corporate sector. Wages are sticky-ish. And if you go back and think about, over the weekend, I watched a regularly running commercial. 256 people will get drafted into the NFL, but there are 400,000 trades jobs open to be hired. There's an ad for hiring to build submarines. I've never seen that before in my 58 years of life. So you have this need for employment, which we haven't seen, and we've actually lost jobs in. And that makes me think wages remain sticky-ish unless companies start firing in order to maintain profitability. If that's the case, then you're not getting the growth that drives earnings. So how do we get this operating leverage without, we need operating leverage with a slow economy, without pricing, and where you've got some sticky costs.
All of this, though, is sort of an old discussion in the sense that we're now toying with this idea that there's not a whole lot of connection between either job growth, wage growth, or economic growth and inflation. We have seen, and Mike, I mentioned your thoughts on this, the economy remains strong and resilient, and inflation come down from 10% to 3%. So there's a lot of, on Twitter and the Twitter outside when it comes to the economy, saying, you know what, maybe this thing is completely disconnected.
Yeah, I think that there's probably still, a lot of the distortions from the COVID cycle are still getting wrung out of the system, which may be kind of masking what's happening underneath. But we haven't been in a situation in decades where we've come off of massive supply constraints like we are. So whether it's global supply chains or in the domestic labor market, right? It was only 12 to 18 months ago we were talking about massive labor market shortages, early retirement effects that won't go away. And it's been the surge in participation that's unlocked, I think, the ability of the domestic economy to grow faster while still giving us inflation. So it's been a lower inflation. So it's given us a much different mix than we're used to dealing with say, normal demand, the cyclical demand story, right? It's to me, it's been this supply story overlying it that's made it unusual.
Jack, if you characterize the implicit desires of equity investors, at least, as a miracle, it would seem like that's not one you think that you would bet heavily on.
Well, I think companies spent 20 years being very good at managing their cost structures. And if we go back and think, I'm a child of the 80s and early 90s, we talked about rolling recessions. I think if we do look within the equity market, we might have had a version of a rolling recession where in late 2022, there was pressure on companies that were perceiving themselves as secular growth. It was growth almost, if you will, with profitless prosperity. I'm going to grow quickly, but I don't need to be profitable. And then suddenly something changed in a world of inflation that I need you to make money. Those companies were aggressive at cutting costs and turning that into restructuring charges, which turned into margin expansion in 1Q, added some boost from the hope for lower inflation. Those stocks took off. They led our market last year. can we see some rotation underneath the surface of companies saying, I'm getting slower and I'm going to start firing some people, but hopefully not to the point that you actually start infecting consumer sentiment, that the consumer really retrenches and so effectively forces a slowdown rather than strategically or surgically managing your way to profitability on a cost basis.
Yeah.
To drive that miracle.
Muddle through is an option. I also always point out the magical mid-90s soft landing also had serial corporate restructuring the entire time. I mean, it was, in retrospect, it's like, you don't think about it.
The late 90s, the mid-90s also was the real problem that the Fed caused happened out of the United States and the derivatives market.
Right.
Yeah,
and so, Mexico going bad, let's create some treasury programs and let's cut aggressively. The U.S. itself wasn't really touched as much by that.
No, it's not perfect. It's just
not a perfect
the point
analogy,
is you
but-
can always point to,
we pulled it
winners
off
and
of the
losers.
problems of somebody else's.
Yeah, exactly. Guys, thanks a lot. Appreciate the time.
Good stuff. Coming up, we'll talk about new tax credit rules that could help car dealers sell EVs, but with one big caveat. You got to tune in to find out what that is. And as we head to break, here's a read on the economy from Royal Caribbean CEO Jason Liberty. He spoke to Brian Sullivan last night at the Goldman Sachs conference.
I can tell you that the consumer is very healthy, and when we poll our customers and we look at credit card data, they're sitting on a lot of wealth, a lot of savings, and low credit card balances, and so we're very encouraged by that.
New tax credit rules for 2024 should help auto dealers move EVs, but there's a catch that could limit which vehicles actually qualify for the incentive. We have Phil LeBeau. He's going to explain it all to us. Phil, good morning.
Steve, the rules and the requirements that went into effect on January 1st require the EV batteries and the components in them to meet a certain threshold in terms of sourcing in the U.S. or in trade-friendly countries. And as a result, take a look at the EVs that are currently offered, or eligible, I should say, for federal EV tax credits. Now, we're strictly talking pure electric vehicles at this point. 9 models qualify for up to a $7,500 discount. Another 5 get half of that. could get half of that, and you can take that at the dealership if you're buying one of these vehicles or as a future tax credit. And as I mentioned, the whole goal here, and this is being driven by the Biden administration, is for EV components to be more sourced here in the United States or in trade-friendly countries. That's the key here. We're not going to get into the percentages and how it shifts over the next couple of years, but suffice it to say, the idea here is that you will see more and more of the sourcing, especially with EV batteries, the components, the raw materials coming outside of China, not being in China, which is where most of the battery chain is right now. Is the EV market going to respond with more people buying EVs because they are eligible at the dealership and they can take it right there off the price of the vehicle? Maybe. The number of EVs that are sold topped 1 million for the first time in 2023. It's 7.6% of the market. There you see, it's been a nice increase in terms of market share, but not all automakers are qualifying all of their EVs right now. General Motors is a good example. Only its Bolt and Bolt EUV qualify for the federal tax credits as they're structured right now. So what has the company said? Well, we're going to offer $7,500 off on all of our EVs. Don't be surprised if you see that more from other automakers until they can get the sourcing where it needs to be to offer the full discount. And also, I want to show you the auto dealer stocks. Why am I showing you Auto Nation, Group 1, Penske Auto Group? Because the auto dealers can now offer these incentives at the dealership. And that means when you go in, instead of saying, well, okay, I'll take $7,500 off my federal tax returns next year, you can say instead of paying $60,000, I'll pay $52,500. And that may have prompted people to be more willing to buy an electric vehicle. Also, guys, leasing is the loophole in all of this. A lot of foreign automakers, their vehicles don't qualify because they're not manufactured here in the United States unless you go through a leasing option, which is what many offer now. Last month, guys, 55% of all EV sales were leases. Don't be surprised if we see that continue.
Right.
The market overall is about 20%. So you see a lot of people saying, I'm going to lease an EV right now.
Phil, using tax policy to influence consumer behavior is hard enough in and of itself. Do you think they've made it too complicated here for people to say, well, I don't know if I get this $7,500 or not?
They don't believe so. The Biden administration believes that they're trying to make this as consumer-friendly as possible by you going to the dealership and saying, I want to take it right now. I don't want to take it, 12 months from now when I'm filling out my federal taxes. And as a result, they believe that more people will be willing to buy an EV at a dealership. It's a little early to tell, Steve. I think the bigger driver here is not the tax policy, it's the cost of the vehicles.
Yeah. But doing it at a dealership, like Tesla doesn't have a lot of dealerships.
Interesting.
Tesla doesn't have dealerships. Tesla has no dealerships, but you can still get it through Tesla. The whole goal here is that you'll see more EVs at dealerships.
Phil, great job explaining this. Thanks for joining us this morning.
All right, when we come back, Dr. Scott Gottlieb will join us on the potential side effects of the weight loss drugs and Eli Lilly's decision to sell them directly to customers via an online portal. We'll talk about that and some potential side effects for these drugs, too. Squawk Box will be right back. Welcome back, everybody. The FDA is examining possible side effects linked to obesity drugs, including reports of suicidal thoughts, alopecia or hair loss, and inhalation of stomach contents. An update to the agency's adverse event reporting system said that it was evaluating the need for regulation for these drugs, including Wegovy, Ozempic, Mounjaro, and Zepbound that are connected with those possible side effects. The labels for GLP-1 drugs already list suicidal thoughts as a possible risk. Joining us right now to talk more about the FDA's probe and the new direct-to-consumer model that Eli Lilly launched this week is former FDA Commissioner Scott Gottlieb. He sits on the boards of Pfizer and Illumina and is a CNBC contributor. And Dr. Gottlieb, let's talk this through, the risks of what potentially could be side effects for these drugs. I think we've all been kind of waiting to see, is it as good as it sounds? Something that takes the weight loss off, a magical cure, a magical pill. How concerned should we be about these potential side effects?
This is an early stage investigation by the agency. So these are events or reports that came into their adverse event reporting systems, their post-market reporting system, which comprises reports sent in by doctors, reports collected by the company, as well as spontaneous reports generated by consumers and data that they gather from payer databases and from some post-market surveillance that they do, including some monitoring of electronic medical records. So these are fairly routine, getting these kinds of post-market reports. That said, it doesn't surprise me that you're going to see an increase in reporting related to these drugs as more people use them and as a broader, healthier population and more diverse population starts to use these drugs. Whether or not these side effects that have been identified in the post-market monitoring are related to the drug needs to be evaluated. That's what FDA is going to be doing. They're going to be looking to see if there's a causal relationship. Are these side effects related to the drug? Are they incidental and just being detected in the background? Or could they be related to the actions of the drug? For example, the weight loss that's being achieved. Could somehow dramatic weight loss that's achieved by these drugs instigate alopecia, for example? Those are the kinds of things that FDA is going to be looking at. But again, I wouldn't be surprised to continue to see these kinds of reports come up. And I wouldn't be surprised if over time the labels of these drugs start to reflect a higher incidence of some of these kinds of side effects as a much larger and broader population uses these drugs. That doesn't necessarily mean it's going to change the risk-reward of using these medicines, but this is why we have an aggressive post-market surveillance system.
Yeah, inhalation of stomach contents. That sounds disgusting, but I was thinking about it. If part of the drug's effect is to slow motility and it makes you feel fuller because you are fuller, it doesn't digest your stomach contents as quickly, I guess that would make sense if something happens.
Right, there were reports of aspiration, so again, you're exactly right. It could be related to the mechanism of the drug in that instance.
Here's the question. You said that risk-reward scenario is still the most important thing to be looking at. And I think that's probably the key. The idea that somebody who is morbidly obese can be on these drugs and it can give them a healthier life is probably worth the risk of some of the side effects. My concern with these drugs has always been that they're being used in off-label prescriptions, they're being used for wider uses, they're being used for cosmetic purposes, somebody who wants to fit into their skinny jeans again. How do you manage the risk-reward scenario under that sort of a situation?
Yeah, look, I think it's inevitable that there's going to be some inappropriate use on the margin. I suspect that it's much lower than we think right now. I think that a lot of the inappropriate use, the more cosmetic use, is just very visible because we see it on TikTok and we hear about celebrity reports of people using these drugs. But the payers have really clamped down and made it hard to get, or harder to get access to these drugs if you don't qualify based on your BMI or other comorbid risk factors. I think for the target population right now, people who have diabetes, people who are overweight and have risk factors related to obesity, certainly patients who have severe cardiovascular disease and maybe have suffered a heart attack or stroke and are overweight and can use these drugs to try to reduce their weight and get better control of their blood sugar. These drugs can really provide a substantial public health benefit. We saw the data that came out last year from the Novo studies looking at the substantial reduction in cardiovascular risk related to use of these drugs in that population, patients who have established cardiovascular disease. There's going to be inappropriate use in the margins. I suspect it's, again, much lower than we think. There's a supply constraint on these drugs, and the payers are making it difficult to get access. Cash pay patients will get access to it.
When you say the payers, you mean the insurers. And what we heard from Lilly yesterday sounded like an end run around the insurers, where they're going to drop the list price and try and make it so you don't have to go through PBMs or insurers.
Yeah, look, still expensive, even though they're dropping the list price. This is only for patients who are underinsured or uninsured. They're providing some incentives in the market for patients to get access to these drugs. If they don't have insurance or they're underinsured, it's still going to be quite expensive out of pocket. That's not going to preclude some people from using it and some people from using it in a cosmetic fashion. I think with respect to the telehealth, at least that Lilly set up, they seem to have taken care to try to provide oversight over that. It's very hard for a drug maker to set these programs up because they're going to be subject to the FDA regulation on promotion. So they have to put in place measures to make sure doctors can't aren't paid to prescribe it, doctors can't promote it, that any promotion that goes on has to comply with FDA regs. So you saw Lilly say things like the telehealth providers that they're using are going to make sure that patients have the access to the full complement of weight loss options and aren't going to be steered to one drug over the other, although within the telehealth mechanism that they set up, the Lilly product is going to be shipped for free, whereas other products will presumably be shipped for a cost. So there's going to be an implicit inducement there. And maybe one reason why Lilly went to two smaller telehealth providers to do this. They went to a company called 9 AM Health with respect to their diabetes offering, and then a company called Form Health to provide the drug through telehealth, the weight loss drugs through telehealth. And one of the reasons they may have done that, and I'm just speculating here, is because these smaller providers, and these are two companies that were financed in Series A financings just in the last 2 years, the smaller companies may have been more willing to give up some of the potential upside of things like promotion to get the Lilly business.
Dr. Gottlieb, thank you for your time.
Thanks a lot.
Squawk Box will be right back.
Good morning and welcome back to Squawk Box here on CNBC, live from the NASDAQ market site in Times Square. I'm Mike Santoli along with Becky Quick and Steve Leisman. Take a look at the futures. Another day of weakness, at least in the morning. S&P 500 indicated off about 0.25%, a little more than that. 4 straight down days for the S&P 500. The index is about 2% off of its high from very late December. You see the Dow indicated lower by 72. That's actually firmed up a little bit in the last half hour or so, NASDAQ has been the downside leader. It's down almost 4% off its high. It is off 56 points in the pre-market. Treasuries, also a story here. 10-year Treasury yield ticking back above 4%. It's about where it was when the Fed meeting occurred on December 13th, so we've kind of retraced some of those gains in Treasuries.
And less than 90 minutes to the big jobs report. Let's get the jobs too with a look at how the market is trading. And he's going to tell us how it's all going to change after the number.
Oh, all right, so let's talk about some of the some of the individual stock stories of the morning so far, outside of that macro narrative on this Friday morning Movers edition. We'll start specifically with energy. ExxonMobil shares, the integrated oil and gas giant, is up fractionally in early pre-market action on just around 1,500 shares or so of volume, so thinly traded. Exxon says it's going to take a charge of between $2.4 and $2.6 billion to write down the value of its production assets along the coastline of Southern California that have been really unable to get online given some of the regulatory hurdles in that state. Exxon joins fellow competitor Chevron in taking multi-billion-dollar charges tied to those challenges for production in California. So those shares up about 0.25%. Checking in also as well on shares of Peloton, which are up again another 3% this morning, just around 175,000 shares of volume. This follows a big gain yesterday. It's hard to see on a chart like this, but it was a 14% drive yesterday to the upside. That positivity coming out of yesterday's news that the connected fitness equipment and content company is partnering with Chinese-owned social media platform TikTok to offer short-form fitness videos and other content. The move is part of a broader strategy over at Peloton to increase its appeal to a wider range of customer demographics, not just the upscale side of things. And we'll end with fitness as well on the apparel and footwear side. We're talking Dow component Nike, which is just about flat on this session, just around 8,000 shares of volume. Analysts at UBS have named Nike one of their top picks in U.S. softlines retail, saying that some of the best growth outlooks aren't yet priced into shares. So Nike shares, ones to watch as well. Steve, I'll send things back over to you and more on that big macro narrative around jobs and interest rates later on this morning.
Yeah, I think, thanks, Dom. The market's sort of setting up for a weaker number, a stronger number. What is minus here on the Dow? Tell us about where they're leaning.
It's modestly minus. I'm more interested in how the bond market is sort of bracing perhaps for something. Let's talk
right?
Bonds in the markets, it would seem. Joining us now is Kamal Srikumar, president of Srikumar Global Strategy. Sri, we're obviously sort of unwinding a little bit of the moves that occurred at the very end of last year, both in equities and in fixed income. Bond market got pretty confident in a hurry that disinflation certainly has some momentum to it, and the Fed's going to be cutting significantly. Where do you think that leaves, let's say, the 10-year around 4%? Corporate credit spread's really tight. It seems like everyone was pretty happy with the soft landing scenario. Where do you come down?
I think a good part of what has happened, Dom, is a result of the uncertainty, the volatility that was caused by contradictory messages from the Fed. Actually, if you were to look at the bond yields by themselves and you did not concern yourself about the Fed messages, then you should have had a much more stable 10-year Treasury yield. Instead, what you had was a December 13th press conference by the Fed chairman, who essentially gave the tailwind even more of a propeller up, and then it pushed up, and then you had John Williams of the New York Fed pulling you down. We have had different Fed people, including Raphael Bostic, talking in terms of how it is too soon to expect a rate cut. All of those were ready to cause the treasuries to, again, the yield to move up again. Has anything really seriously happened to cause all of this move, Mike? I don't believe so. So I really think that around the 4%, 410, 415 mark, the U.S. Treasuries at 10-year is a buy. You're going to be very happy a year to 2 years from now.
I mean, on some level, Sri, it's markets doing what markets do around an inflection point in policy, and the committee is not necessarily all in unison about their particular outlooks. I mean, I don't know. It doesn't seem to me that the market has been really unusually volatile around this. However, if you think 4%-ish on the 10-year is a buy, what are your assumptions that feed into that view? In other words, do you think that we have a rapidly decelerating economy? Is it just about inflation being friendly and we have, real yields are now attractive again?
That's a great set of questions, Mike. My assumption here is with the interest rates having risen so sharply during 2022, 2023, and now being reduced or at least kept paused right now with the possibility of a decline, you still have something that is going to break in the system, whether it comes from banks which are losing deposits, if you look at the small and medium-sized banks, or if you were to look at the commercial real estate problem, the credit crunch, any one of those could cause another big failure, and that is what is going to cause the Fed to ease, not lower inflation rate, and that in turn is going to cause the long-dated yields to also come down. So it is a result of a breakage in the system rather than a result of the inflation coming down.
Sri, didn't something break about 10 months ago? We had banks go bust. A lot of people thought at the time Fed's got to be done. In fact, it should be cutting soon. It didn't happen. We kind of absorbed it. And I guess before that, you could argue we lost trillions in crypto value. We saw the speculative parts of the stock market implode. I guess what particularly makes you think we have further vulnerabilities systemically?
Something did happen last March. Between March 1st and March 15th of 2023, you had quantitative tightening shifting to quantitative easing. The assets of the central bank went back to the November 2022 level because the Fed hastily gave up on its tightening program. And then they started to go back again to quantitative tightening. But that you're talking about relatively small banks in the setup. If you have medium-sized bank failure, or if you have a big failure on the commercial real estate side that makes big news, then you're going to have a more long-lasting easing of policy, and that is the difference between March of last year and what I look for the next 3 to 6 months.
Sri, we have about a minute, so I want you to walk me through all of 2024 in that 60 seconds here. Tell me when the Fed cuts, how much it cuts, and I think the most important question that Wall Street's really focused on right now is when or if the curve disinverts.
A terrific question, Steve. Let me give you a timeline. Obviously, they're subject to change, but within the 1 minute that you gave me, I'm expecting within the next 3 to 4 months, something breaks. Let's assume it breaks by March, April. Then the first rate cut also happens in March, April. Quantitative tightening is stopped, and then you have quantitative easing following, and then that is the whole thing progresses further. The 2 to 10 year, which is now about minus 38, minus 40 basis points, goes to zero very quickly within 3 months, and then the yield difference becomes positive for the rest of the year.
Okay, we're going to have you back, Sri, because I have a different take on this, which I believe now and into the future. The Fed the bar for using quantitative easing is much higher, and I believe the bar for zero is much higher. I believe the Fed doesn't want to go there again, and next time it's faced with that choice, it will be much more reluctant to do so. But I'm not disagreeing. I'm not saying he's wrong about that. I'm just saying it's a really important debate to have it.
Sri, thanks so much. We'll talk to you again soon.
Thank you. Thank you.
When we come back, Korn Ferry's chairman talks wages and the labor market in 2024. What he's seeing in the nation's workforce is next. And then professor, author, and podcaster Arthur Brooks will join us. We're going to get his take on the art and science of happiness in 2024. Squawk Box will be right back. Me too.
50% off.
Counting down to the December employment report, which coming out at 8:30 Eastern time. Joining us now with more on the job market, Alan Guarino, Korn Ferry Vice Chairman. Alan, thanks for joining us this morning.
Steve, how are you? Good to see you.
I'm good. Let's talk about what's happening with wages. I think that's a big part of what we're looking for today. We had the ADP wage insight data on yesterday, and it showed that things are coming down. Not only that, it's not paying as much anymore to leave a job as it is to stay at the same job. What's your take on what's happening broadly in the job market, but specifically when it comes to the wage component?
Sure, Steve. Well, you know, the beauty of this topic is that it still parallels what you talk about a lot, which is the economy and economics. Let's face it, we had significant wage growth over the last couple of years during the reopening for a whole bunch of reasons. We had the Great Recession. We had this sense that there was a big piece of the economy represented by people that, quote, didn't want to work. So there was that whole buzz happening, and the reality was it was true, and so employers had to bid up wages to get people to work in what was a rapidly growing economy that had gone through a nosedive. So if you think about it, it's really a stabilization, right? If you think of wages as a reflection of supply and demand, we all know how that works, right? And then price is determined at the cost. So we have, you know, meaningful demand right now. We have meaningful supply, but still looking at very low unemployment from a historical basis. And so the reality is that this, to me, is just sort of a normalization of what was a phenomenon of, let's say, explosive wage growth.
So, Alan, your business is on the front line in terms of demand. Give us a feel for what your book looks like in terms of, and what you're hearing from your clients. Are they pulling back from the searches that they had for executives and other positions last year, or is demand pretty constant?
Yeah, well, you know, fortunately, we're 10,000 plus people in 60 countries. So what happens inside our firm is, you know, is just a microcosm of what's, you know, may or may not be directly reflected. What's important, I think, is what we're hearing from CEOs and other leaders, and we're all hearing it in the same dialogue around the market and the economy. I think right now we're certainly not in a party economy, but we're not at a funeral either. And so I think it's steady as you go. And I think that what we're going to see is maybe this jobs market, jobs report data over the next year is going to be a proxy for this thing that we're talking about called the soft landing. And look, we've all lived through what is not a soft job market situation, where literally job opportunity marketplace fell off a cliff. I can think of at least 2 or 3 previous cycles over 25 years where we all know what that looks like. This doesn't feel like that. I'm pretty optimistic. And by the way, as a free marketer and a person that's, you know, looked at trying to understand the economy as it is over the last year, it's been perplexing, right? It's defying a lot of gravity. But the reality is maybe indeed this is reflective of a soft landing. Job growth will continue, but not at a skyrocketing pace. Numbers like we've seen in the last, you know, few months, the 190s and so on.
Right. I'll tell you my concern, which I don't know how to look at this in terms of data, but I've seen this behavior before, which is this notion of labor hoarding, that it was such a hassle to hire people that even when sales were to come off, you're not willing to let people go the way you would normally adjust your head count to revenue or profits. And that suddenly a dam breaks and all of a sudden we have all this unemployment. Do you have any visibility into this question as to whether or not companies are holding on to people because of what a hassle it was to hire them in the first place?
Steve, love the question. I've seen it myself twice. I've been in this business a little longer than some, so I have seen it. Honestly, the counterbalance to that is we have a massive skills shortage in the world. And so when in previous years, quite frankly, hiring is more fungible. You know, it was easier to find great people 15 years ago or 10 years ago than it is today relative to the demands of jobs. So I don't think we're going to see anything like that again. Right. I think that if you look at the data for at least the next decade or more, depending upon how AI helps ease some of this pressure, we have a massive skills shortage across the world. there are more jobs than there are people who can fill them. And I think that will be, you know, if you think of the job market as a free market, a moderator.
All right, Alan, hang on, because I just want to show Becky. She asked yesterday about the wage data.
Yeah.
So we made a couple charts for you.
Thank you, Steve.
So here you go. Here's the charts that I should have had available yesterday because I knew this was going to come up. I had a nice chat with Neil Richardson. Here we go. We're looking, Alan, I don't know if you can see it there, at the percentage change in year-over-year wages for job stayers versus job changers. And I look at that chart, and what I see, Becky, you tell me what you see. It was a massive premium in the midst of the pandemic to change jobs.
Yeah.
You got a big raise that was up near the double digits. Mac is looking at it and said, darn, why didn't I go then?
16%,
But now,
that was huge.
now that premium has now gotten to be smaller, where the change...
Although, I'm surprised that it's still 8% versus 3% or whatever we're looking at on the chart.
It's still 8%. So, Alan, do you want to talk to this chart? I'm hoping you can see it here. I probably should have sent it to you ahead of time. That it's not quite as lucrative now. It's still lucrative.
It's a lot better than it was before January 2025.
That's true, but not as lucrative as it was. Alan, you're on the front line of this. Talk to us about it.
Right. Love the last minute chart, but I did get a chance to figure it out in the last 20 seconds. It looks to me like a classic reversion to the mean.
Right.
And so if you look at where we're going, you're going to get a moderate increase, which we always have to change jobs and go to a new company. However, we're not going to get that major delta that we had between the bid and the ask at staying where you are versus going to someplace new. And I still think that's also reflective of the fact that, you know, we had a significant jump. You know, the old saying, 50% of a number that's twice as large as it was 2 years ago is still at the quantum a fairly sizable number. So people got big raises, and now they're getting what looks to be smaller raises on a percentage basis. But I bet if we looked at the dollar amounts, they're still meaningful dollars in making changes.
Alan, thanks for joining us and giving us these insights into the job market.
No, great to talk to you, Steve. Thank you.
All right, see that, Becky? You got to ask for something. We bring the charts in, boom, 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 just like that.
In just 24 hours.
I could have had it right away, but I didn't.
All right, coming up, Congress has 9 days to negotiate 4 spending bills to avoid a partial government shutdown. A look at how Washington is preparing for that. Squawk Box will be right back.
Time now for today's Aflac trivia question. What was the worst performing stock in the S&P 500 in 2023? The answer when Squawk Box returns. And now the answer to today's Aflac trivia question. What was the worst performing stock in the S&P 500 in 2023? The answer? Enphase Energy, which fell by more than 49%.
All right, welcome back, everybody. The odds of fully funding part of the government by January 19th are looking less and less likely as top lawmakers still haven't come to an agreement on how much to spend next year. Emily Wilkins joins us right now on where things stand as Congress gets set to return to Washington on Monday. Emily, that does not give them many days to get this together.
Becky, it really does not. And I mean, the main thing that's missing right now is exactly how much they're going to spend. That needs to be figured out before the details can get there. House Speaker Mike Johnson, Senate Majority Leader Chuck Schumer, they've been negotiating, they're continuing to negotiating on the overall amount to spend for the federal government for the remaining 2024 fiscal year. Right now, the House and Senate, they're about $120 billion apart in the spending bills that each chamber have come up with. Tennessee Republican Chuck Fleischman, one of the top government appropriators, said both sides will need to come closer together to ultimately get to an agreement.
House Republicans are in the position right now of saying we are at the baseline lower level, and that's where they're holding. Do I think that number will go up? If we're going to get a budget deal, I think it's going to have to. Will it go up to the Senate levels? Absolutely not. To the White House levels? Absolutely not.
About 20% of government funding is set to lapse on January 19th unless Congress acts. That includes bills covering the Departments of Agriculture, Energy, Veterans Affairs, and the Department of Transportation, plus military construction, the FDA, housing, and urban development. Although Speaker Johnson has vowed to have no more short-term stopgap bills, Fleischman said if lawmakers were close to an agreement by the 19th, there could be a short-term stopgap to last until February 2nd. That, of course, is when the rest of the government needs to be funded by.
We could see the potential, if the parties are close, for the olive branch of a continuing resolution, maybe from the 19th to the 2nd, as a stopgap or something like that. That's not beyond the pale of reason.
The Senate gets back on Monday and the House returns on Tuesday. And Becky, they're going to basically have to get right to work if they have any hope of making that deadline.
Emily, what pathway do you see? This just feels a little unknowable because we don't know as much about Mike Johnson, who he works well with, who they might be reaching out for the White House to be working through the Senate. Doesn't seem like a particularly constructive path when somebody's going to have to figure out what the House is going to agree to on all of these things. It's just, this feels more unknowable than some of the things we've seen in the past.
You're absolutely right, Becky. I mean, this is yet another big test for Mike Johnson. I mean, he hasn't even been in the Speaker's office for 3 months at this point. And so this is really a test for him to be able to negotiate with Schumer, to be able to negotiate with the White House. And at this point, I think there is kind of a big question about how he negotiates with sort of the hardline conservatives. They have come out, they've really criticized some of the discussions about what the top line number should be. They want to see these major cuts that really don't stand a chance of actually getting into law with the Senate. And so Johnson has a lot of folks that he's going to have to negotiate with, a lot of people to try to keep happy. There isn't a lot of talk right now about trying to oust a speaker again. I think everyone's exhausted from the last time that happened. But I think there are growing concerns about what Johnson is doing, how he's negotiating, and whether he's paying attention to kind of that rightmost flank of his party.
Well, if anybody can herd the cats, you know, that's been the problem for the entire year. And with the Republican numbers dropping and the gap between the Republicans and Democrats there, that just seems like a tougher and tougher fix.
Absolutely. And, you know, the end result here, if they don't get these bills done, Johnson said he's going to just continue 2023 funding into 2024. And that is making a lot of folks nervous, especially in the defense industry, because that would mean there would automatically be a 1% cut across the board. That translates into billions and billions the defense industry says they need to make sure that the U.S. is just simply ready for whatever comes up on the global stage.
Emily, thank you.
Coming up, Harvard Kennedy School professor, author, and podcaster Arthur Brooks joins us to talk about the contrast between how consumers are feeling and the real economy. As we head to a break, here's Royal Caribbean CEO Jason Liberty last night on Last Call from the Goldman Sachs Energy Conference on what he's seeing from the consumer. We'll be right back.
I can tell you that the consumer is very healthy, and when we poll our customers and we look at credit card data, they're sitting on a lot of wealth, a lot of savings, and low credit card balances, and so we're very encouraged by that.
Signs of cooling inflation in last month's jobs report paint a relatively upbeat picture of the U.S. economy, but economists are saying watch the gap. According to the most recent All-America survey, pessimism about the economy reaching an all-time high of 66% last quarter. That's despite the good news about the health of the consumer, the spending, the low unemployment rate. You have no idea where this next interview is going to go, I got to tell you. But for a look at this supposed disconnect, let's bring in Arthur Brooks, President Emeritus of the American Enterprise Institute. He's with Harvard and the Atlantic, and his latest book is Build the Life You Want, co-authored with Oprah Winfrey. Thanks for joining us.
Hey, Steve. How are you?
We're all excited you're here today, but I'm going to start with the mundane, and Becky has some crazy, crazy stuff she wants to talk about.
Right on.
Okay, so let's start off with this disconnect.
Yeah.
The data looks pretty good. And you say that to people and like, are you crazy? Now, there's the obvious explanation of, well, the inflation rate is high and the price level is high.
Right.
Hasn't come back down. My wages haven't kept. Does that explain the disconnect, you think?
Yeah. Have you ever been to an unhappy family that's rich? I bet you have. You know, people who are doing just fine, but everybody's unhappy.
Yeah.
The truth of the matter is that your relative level of prosperity and the ups and downs of the paycheck have nothing to do with whether or not the family's going to be happy. This country has been seeing more and more people saying the country's on the wrong track. This has been going on for 20 years, and it's out of control right now. The truth is that we have leaders who are just unfailingly negative about the country. We have media that's talking down the country. It's all bad news all the time. People are grumpy about that, and so the result is that they can't even actually get through it to see some relatively good economic news. Look, what we need happier leaders. We need to make America happy again, is what we need, and that starts with leadership. You go into a company, you've done it, we've all done it. You go into a company and you can see there's something wrong. You start with the leader, and usually the leader's a downer. That's where it starts, and that's what we've got in America today.
Sounds okay to me, but what I look at, I think about some of the prospects out there for solving our problems, and they look more intransigent or unsolvable.
Like what?
Tell people like we have $34 trillion worth of debt, and I'm sitting around a table with a bunch of people my age. They don't think they're getting Social Security. They think that's a problem. You look at the prospects for the country's finances. You look at your own prospects for getting ahead in the world, and you feel like, well, maybe it's capped here. I don't know. The idea that there isn't, it's the expectations component. 'Cause, I've been doing this survey for 20 years almost, right? So what always happens is if the current assessment of the economy goes down, the expectations component goes up. That's not the case right now. That's why that thing is so high. That is pessimistic now and for the future.
Right.
Typically, those have worked in a somewhat inverse way. It's not happening anymore. People are down now, and they're down about the future.
Yeah, you had the right word, pessimism.
Right.
That's exactly the wrong quality for leaders to have. Pessimism is when you're a leader, your main job is to say, there's a better future. Do you see it? Do you see your part in it? Will you come with me? That's what leaders are born to do. And what do we have? We have leaders who don't speak with hope, who don't speak with the optimism. Look, and by the way, optimism is realism in this country. Let's not kid ourselves. The whole, people who say, the best years are behind us, that's crazy talk. This is the most prosperous, upwardly mobile country in the history of the world. We know perfectly this is a great country in our hearts. But at the same time, we have leaders who are talking it down, who are pessimistic, and everything is bad news all the time. You can't blame people.
Are the political returns to pessimism higher than the political?
Of course. Well, they're shorter term.
So you get paid better as a politician.
Hey, man.
To talk trash about the future.
Hey, misery is good business. Misery is great business. I'm telling you.
Look, I think it's on sorry.
No, I was going to say, is there a generational component to this?
Well,
the leaders, what age they are. I mean, I know I'm supposed to be in the happiness trough age-wise, demographically speaking, 53.
Nice. That's exactly the bottom.
There you go.
Here's
the bottom of what?
Good news coming.
Happiness.
Generally speaking, 53 to 70
Why?
is the greatest increases in happiness that people actually feel.
But why are you at the trough at 53?
Well, what happens is, generally speaking, people think they're going to get happier from their early 20s all the way through because life is going to get better. Your dreams are going to come true. They mostly are. I mean, not entirely, but the whole point is that the things that you're working for are actually going to come true. The problem is those aren't the things that actually bring you day-to-day happiness.
That's
and so the result is
that
that people actually have most people have a slight decline in happiness from the early 20s to the early 50s, and that's incredibly disappointing. Look, there's not that much enjoyment in having teenagers.
Too high.
What's
We
that?
set our expectations too high.
Yeah.
We have unrealistic expectations.
Everybody's optimistic about their own life, and it turns out that life is pretty complicated in your 30s and 40s. Now, when you get into your 50s, things kind of turn around. I have, my students are on average 28 years old, and I show them these data. That on average, your happiness is going to be declining a little bit from early 20s to early 50s, and it's going to turn around and go up. I say it's a kind of a bad news, good news story. The bad news is your happiness is declining. The good news is I'm getting happier.
I do think that's
You're consuming their
part of it.
happiness.
We have these unrealistic expectations.
for sure.
I think part of what plays into that are the things you see on Instagram, but it's the same thing we've been seeing in movies and on television and magazines for so long, that life is going to be this idealistic, perfect thing.
Exactly right.
Not.
No, we feel like we should be happier than we are, and we look at other people who have their fake portraits up on social media and their ideal lives that's going on. The other thing is that we just don't have a good culture for dealing with unhappiness, which is part of a normal life. Back in the 60s, the hippies, used to say, if it feels good, do it, which is a great strategy for ruining your life for all kinds of reasons. But today, the mantra for a lot of young adults is basically, if it feels bad, make it stop.
Yeah.
If I'm suffering, you better treat it right now. You're broken if something's making you unhappy, and that's exactly wrong. One of the things that I do with my young adult children is I talk to them all the time about the sacredness of suffering, about the humanity that actually comes, the learning, the growth that actually comes from these negative emotions and how to manage these things. The real skill, the real reason that you're going to get happier over the next 15 years is because you know how to manage yourself now.
Arthur,
I'm not as dumb as I used to be.
Turn this around. Tell me if you're advising a presidential candidate right now.
Yeah.
What's the message you would be giving right now? Run the campaign for me.
Yeah.
Not me.
Make America happy again. look, we need somebody who says our best years are ahead of us. Here's how we're going to get it. Here's the role that you're going to play. And I truly believe that we can actually get there, as opposed to the 3-week campaigns, the political, highly glycemic messages of everybody's crummy and they want to hurt you and I'm your only savior. That stuff works in a very, very short run, and we go into these short run cycles again and again and again and again. This plays kind of with the media, it plays with the political messaging, and it's bad for us.
I mean, I think thinking about the last 30 or 40 years, Ronald Reagan and Barack Obama perhaps embodied that strategy best. Am I wrong about that?
Bill Clinton was great at that too.
He was good at that too.
Bill Clinton was exceptionally good at that. But look, Ronald Reagan coined the term "Make America
Great Again," Morning in America.
He was in Detroit at the convention, and he was extolling the virtue of immigrants. Think about that. He was talking about how great immigrants are to remembering our spirit, that these are the people who show us who we truly are. That was what Make America Great Again was really about. That's an incredibly optimistic message.
I wonder if there's something a little more acute or cyclical about this period of years we've been in, though, because it seems like when you tell people, oh, you know, we had stimulated the economy, we had the shortest recession ever, wealth has gone up, wages have gone up, even if it's outpaced inflation. This sense of disorder and big stuff out of my control that was happening to us, that even if we responded to it well, it didn't feel comfortable.
Right. Yeah, no, this is true. But this is the balance that national leaders, by the way, corporate leaders, family leaders, community leaders, there's a lot of stuff out there that we can be scared of. You need to direct people's attention to the things that we can control and the things that we can make better, and to help them see their role in actually getting us there. And that's exactly what leaders are not doing.
But also successes. I was thinking about the pandemic, both monetary and fiscal response.
Right.
I don't think you can tell the story of what was done unless you begin with the following. At the beginning of the pandemic, the debate was, would the unemployment rate be somewhat lower than, exactly at, or above the unemployment rate of the Great Depression? We avoided that.
Yeah.
Whatever story you tell about the post-pandemic period and the response, you need to begin with that part of the story. It was, at least up until the point where this inflation thing happened, was a pretty good success. Also, by the way, you talk about the pandemic response to the health response. How many people were we thinking might have died, and how many people actually did?
I think the question might be, does our brain chemistry seize upon counterfactuals to make us happy?
Yeah, well, this is a communications point, and this is a really important point to make. You have approximately 7 seconds when you talk to somebody for the first time to make an impression.
7 seconds?
To frame your argument and to frame yourself. You have about 7 seconds. There's a part of the brain that actually decides who you are when you talk to somebody for the first time. Don't waste your 7 seconds. And so this is what politicians need to do when they get up in front of new audiences that might be hostile, for example. They say, like, I'm going to tell you some things tonight about what I believe. You might disagree with me, but you're not going to go away tonight thinking I don't love you and your family. That's the 7 seconds, because that's what they're going to remember. You get the point, right? You have to frame everything. And when politicians are talking about COVID or the economy or anything else, they need to frame it to say, there's victory around this.
Corporations know this already.
Not enough CEOs are doing it.
But in terms of how they talk to
How they
consumers
advertise to you.
and how they advertise to you, it's about making you feel either hungry, which happens to me a lot, or good. Or good, right? And they don't come out and saying, your life is miserable a little bit, but we're going to make it better is the basic gist of it.
You poor a miserable SOB. You need to buy my product.
Exactly.
Because all they're going to remember is that you poor miserable so-and-so.
Arthur, thank you for joining us. Ladies and gentlemen at home, there is a huge investment thesis in what Arthur just said. You just have to figure out what it is.
I always want more of it, Arthur. I have like 50 other questions.
Yeah.
Come back.
Yeah, you know, it's I love this show. Thank you.
Oh,
Thanks for coming.
Yeah. See you soon.
When we come back, Google introducing a new tool that defaults to blocking third-party cookies has begun. We're going to talk about how marketers may have to reconsider ad tactics. Squawk Box will be right back. We thought we were done.
Asset.com.
Beer, wine, and liquor company Constellation Brands just reporting mixed results. Earnings coming in at an adjusted $3.19 a share. That was ahead of the street's $3 estimate, and that was on revenue of $2.47 billion, which was a miss. Sales of Modelo, which topped Bud Light as the top-selling beer in the U.S., grew 12% during the quarter. Constellation Brands is affirming its EPS guidance and raising its operating cash flow expectation for the full year. The stock's down about 0.5%.
When we return, Google wants to crumble cookies. What it means for advertisers and the digital marketplace is next. Squawk Box will be right back. Welcome back, everybody. Google is shaking up the online ads business. This week, Google started a test that restricts cookies for 1% of its Chrome browser users. It's aiming to completely remove third-party cookies that online advertisers use to track people on the internet. Joining us right now with whether the $600 billion a year digital ad market is ready for these changes is Adam Singolda. He is the CEO and founder of Taboola, which is a native advertising platform. A disclosure we should mention, Taboola powers ads on CNBC.com. But Adam, thanks for being here. This is a little bit of a complicated question. Just the idea of cookies crumbling, what does that mean, first of all, for users of the internet?
I mean, I think, it's interesting to take the consumer point of view, and thanks for having me on this topic. So I'm not sure people read, the story in the journal yesterday about what this meant to the industry, but to me, what's interesting, and getting back to the consumer, is who are the losers and winners, the clear winners of this transition, and what does that mean to consumers? To consumers, it means, I think, less freaking out type of ads. Those ads, like when you go and you buy shoes on Christmas for your kids, and then suddenly the entire internet is following you with those shoes, even after you bought those shoes.
Yeah.
I think we see less of that, and that's probably a good thing. But it also means, to investors, that companies will rely on those cookies to track consumers between websites and show you those ads might be, out of the game in some way. However, the winners, the clear winners of that transition, I think will be companies that have a lot of scale, a lot of strong signals, and specifically perhaps good at e-commerce.
Meaning what?
I think, if you're able to, look, e-commerce is one of the most interesting segments in advertising, and it's no surprise to me that Meta is all over marketplace trying to get in e-commerce, and TikTok is saying that in 2024, they'll 10x their e-commerce business into $17.5 billion. I think, companies and websites such as CNBC and others who are able to interact with consumers directly, who are able to know what they want to buy, sell it to them, will be benefiting from this transition of cookies going away and the rebirth of kind of direct-to-consumer e-commerce business.
Let's just say what this really means. To me, thinking it through, it means that Google is going to say, we're killing cookies, and that's good from a privacy perspective. You're not going to have these marketers following you around all over the place. But it probably is being done more out of self-interest, where they can say, okay, if you want to reach the consumer, you have to come through us and pay us for this, instead of allowing us to have all these, remora of fishes swimming on the sharks following you around. You're going to have to pay us for access to these people. Is that the right way of thinking of it?
There's definitely a point of view there, but I still think that, look, outside of Google, you have almost $100 billion of open web industry outside of Google, right? So you have a large industry of advertising companies and publishers and journalism of companies who are participating in that space outside of Google. And then the question is, what happens to them? Will Google benefit from that? Maybe. I'm not even necessarily the right person to say that. But to me, what's more interesting is what happens to the $100 billion that sit outside of Google, and who are the losers and winners of that? And you can look
Basically,
at
don't be annoying, right? Be annoying. I don't mind ads that are targeted to me if it's something I want, but don't be annoying. Don't be
do we know why Google is doing this? Do you understand?
My guess
is this altruism on Google's part, or is it just saying you can't track customers, only we can track customers? What's the reason for this?
Look, remember, this is also on the back of Apple doing that in 2017, right? So we've already been in that segment. We've had this segment, on CNBC probably before in 2017 when Apple deprecated cookies. And they were the first to say privacy matters to us as a company. Consumers should not be freaked out. If you use iPhone, if you use Safari, good on you. Less ads that follow you in a way that you're not expecting. So this is not necessarily a surprise Google is doing that. However, I do think that we have to think about what does that mean to the advertising industry as a whole, outside of the Google and Facebooks of the world. And I'm looking at TikTok doubling down so much on that. I'm looking at companies like even the New York Times, right? Wirecutter, such a great business. You want to buy trampoline for your kids? You don't know what to try, so you go to the New York Times, you read a review on the New York Times, maybe you go to time.com stamped, you read a review about coffee machines, you buy it. That, I think, is a big part of the future. You trust publishers, you trust journalism, you should buy from publishers direct, not on Amazon.
Adam, while you're here, I was hoping to ask you about something you posted on Twitter earlier this week. It came across my feed, and I was kind of stunned to see it. You've lived in this country for 14 years, and you said you had your first anti-Semitic moment recently. What have you seen? What's happening?
Yeah, it's interesting because I've been here for 14 years, and I've never felt more welcome in this country. And I've never actually had that experience before. And my wife, me, and the kids, we were just outside playing with the kids, and this guy came to me and started talking to my wife and us. It was a random, just casual conversation. And from that, he jumped into something very nasty about the Jewish people. But luckily, my wife was there, and she told him, dude, we're with the kids, just move on. So he moved on. But that was kind of my first interaction with someone who I think was not educated enough of knowing exactly what's going on, but jumped into a fairly nasty experience. So, I'm praying for better days than what we're seeing these days.
What was the outpouring you got on Twitter? How did it come down? And my guess is you got a little bit of both sides.
Yeah, I think mostly support. I don't think anyone really is into hate of any kind. And this was a very hating thing. And, the world deserves better days, more love, more compassion, more empathy. And I tell this to anyone, whether you have strong opinions in any one way, empathy is the way to go. You have to choose just to give kindness to what's going on around the world. And look, I'm Israeli, my family is in Israel, my people are in Israel. I think about them all the time. I am biased, but I still think that, hate has no room anywhere.
Yeah. Agree. Adam, thank you for joining us today. We do appreciate your time.
Thanks for having me.
Thank you.
And still to come, Energy Secretary Jennifer Granholm joins us to discuss oil prices, the situation in the Red Sea, and the impact on the economy if the situation gets worse. And then the December jobs report will be released at 8:30 a.m. Eastern Time. The numbers and the market reaction are ahead. Squawk Box will be right back.
Good morning. It's Jobs Friday in America. We are just 30 minutes away from the big, huge number. Meantime, stocks on track to snap 9 straight weeks of winning near the end of a tough first week of the year. Futures are pointing to, unfortunately, more losses. And shipping giant Maersk now says it will avoid the Red Sea for the foreseeable future. We'll talk about the impact to energy and global commerce from the tensions in the Middle East. With us, U.S. Energy Secretary Jennifer Granholm. The final hour of Squawk Box with the big jobs number begins right now.
Good morning, everybody. Welcome back to Squawk Box right here on CNBC. We are live from the NASDAQ market site in Times Square. I'm Becky Quick along with Steve Leisman and Mike Santoli. Joe and Andrew are off today. It is Jobs Friday, as Steve mentioned, and ahead of that, we're watching the U.S. equity futures. Right now, Dow futures down by about 85 points. S&P futures down by 13. The NASDAQ off by 65, or 56, I should say. Treasury yields have been picking up. This has been the story for the week. Markets down, Treasury yields up. Right now, the 10-year is yielding just above 4%. The 2-year is at 4.4%. And shipping giant Maersk saying this morning that all of its vessels due to sail through the Red Sea and the Gulf of Aden will instead be diverted south around the Cape of Good Hope for the foreseeable future. Houthi militants based in Yemen have been threatening global shippers for weeks and making attacks on some of those ships. The tensions in the Red Sea, as well as Israel, Gaza, Ukraine, and Russia have been keeping energy markets on edge. Here's what Chevron CEO Mike Wirth said last night on Last Call from the Goldman Sachs Energy Conference in Miami.
We're very close to the Russia-Ukraine conflict with our Kazakhstan business. We also are the primary supplier of natural gas in Israel and have offshore platforms that have been shut down during the conflict in the Middle East. We've had ships that have been attacked by the Iranian Navy within the last few months in the Straits of Hormuz. We've got ships that transit through the Red Sea that we work very closely with the U.S. Navy and other military forces to ensure safe passage of those vessels. The reality of doing business around the world in our industry is we face these kinds of risks.
Joining us right now to talk about how global tensions are impacting energy and much more is U.S. Energy Secretary Jennifer Granholm. And Secretary Granholm, thanks for being here today.
You bet. Thanks for having me.
Let's jump right in and talk about what's happening in the Red Sea and the surrounding areas. Mike Wirth talking about not only the Red Sea, but these attacks in the Straits of Hormuz from the Iranian Navy. What does this mean? What can we do to try and ensure safety of shipments?
Yeah, this is an issue that's been certainly top of mind for the administration. In fact, we've put together a coalition of more than 20 countries that are countering these attacks and really protecting international commerce, focused on that through an effort now called Operation Prosperity Guardian. That's the title of it. The U.S. issued new sanctions last week on individuals and entities that are facilitating these attacks. And we're going to obviously continue to be very much on this. But with respect to how we're seeing it play out in the energy space, is that so far the ongoing conflict and attacks, which are indiscriminate. They're on any commercial vessel that's coming through, whether it's touching or related to Israel or not. But this conflict, they have not really been successful in terms of getting their targets, but this conflict itself has really only had a limited impact on energy prices. For us in the U.S., the gas prices, for example, are at $3.09 today, 3.089, something like that, more than $1.93 lower than the peak after Putin's war. 30 states, the average is less than $3 a gallon. So we aren't seeing the price per barrel or the impact at the pump. But obviously, the United States is on it and is leading this coalition to protect those commercial shippers.
Yeah, honestly, WTI at $73 a barrel probably doesn't reflect a lot of these renewed concerns. The news, the very latest from Maersk this morning, saying that they're going to be diverting vessels from the Red Sea for the foreseeable future. They just say that it's a highly volatile situation and that there's a big security risk here. We have seen these types of actions in the past. What will it take to actually ensure that ships can go through that area? How complicated?
Well, obviously, yeah, there has to be this coalition effort. I know that many commercial shippers are really not just, they're doing what Maersk has decided to do, which is to circumvent the Red Sea and the Suez Canal. And that may add some price to energy in terms of how long it takes and how much more fuel it takes to get those shipments around. But this coalition and the active, not just monitoring, but insertion of both sanctions as well as lots of discussions behind the scenes. I think we're going to, hopefully, if it doesn't escalate further, we'll be okay, even if there has to be a wholesale diversion of shipments around the Red Sea.
Secretary, we've talked a lot about what's been happening with ExxonMobil and Chevron as well, walking away from basically the refinery situations, their operations in California. They've taken massive write-downs in the last several days to the tune of billions of dollars. Mike Wirth was on talking about this last night and mentioned that the situation in California is largely because of California policy. I realize that's not a federal policy, but when you look at California and the gas prices there, it creates unhappiness with the consumers. They've basically said, we can't continue to make investments in some of these operations, whether that be the refineries or the pipelines, because we don't think we'll get the return on investment. When they say something like that, and you have multiple big companies basically walking away from some of these things, what does that mean? What can you do on the federal level?
Well, it's interesting because I think there's a lot of those who have refineries who are converting some refineries anyway to biofuels. There is significant policy incentives to the creation of drop-in biofuels, so you're seeing some of that happening. The refineries that are around the country are working full tilt and are producing. So I will say this, Becky, we have seen in the United States that we think that we have achieved peak gasoline because of the increase in electric vehicle sales. And obviously this is just the US. Other more developing countries are still looking at, significant, potentially significant, but lessening so increase in demand. But in the United States, we're seeing a leveling out and a diminishment of the demand for gasoline. And, we just got the numbers yesterday for the sales of electric vehicles. I know you had a segment earlier about this, but in 2023, 1.4 million sales of EVs. That's a 50% increase from the year before. That's going to have an impact.
Fleet, though. It's still an incredibly small part of the fleet in the United States. But
10%.
What I will
10%.
say is to see some of these policies embraced in California where they say we want to be at peak gasoline usage, and as a result, we're going to make more and more strict laws that require all of these other things that make it less and less likely for companies to want to invest in the refineries there. I mean, what you've seen is gas prices are much higher there than anywhere else in the nation, or with the exception of potentially Hawaii and Alaska. But what you see are these California prices that are significantly higher. If you see that carried out throughout the rest of the country, you will probably have a very unhappy electorate because every time they see gasoline prices up $1, they scream.
Of course. And I don't think you're going to see California taxes or prices carried out through the rest of the country because these are all done, as you say, on a state-by-state basis. California is unique.
But they're talking about the same things that you just talked about with biodiesel and other issues. If you spread those on a national level, you will have probably similar reactions.
Well, but a lot of the increase, a lot of the price gap for California, the significantly more expensive price per gallon does have to do with gasoline taxes too. So, I think, everybody knows, Becky, we are in this transition right now. It is, for consumers, significantly less expensive to operate an electric vehicle than an internal combustion engine vehicle.
Incentives.
With tax incentives,
with tax incentives that taxpayers pay for.
It's mass. There's federal tax credits that they benefit from if they are able to take it up, and if they're able to afford a lease, and a lease, of course, is cheaper than perhaps a monthly payment for a purchase. And these tax credits, $7,500 off of a lease, you can really have an affordable vehicle. It's much cheaper for somebody to operate that. So, we're in this transition. It is not going to always be smooth and easy, but on the other side of this transition, I think that people will come to love as people who drive electric vehicles have. 95%, according to the J.D. Power survey, have extremely happy with their electric vehicles because of cost and because they're fun to drive. I think you're going to see this transition continue to increase. I mean, it is at about 10% of the fleet right now, but that is going to continue to increase at the same sort of pace that we've been seeing it increase.
The only thing I'll add to that is you're right. Gas prices are higher per gallon in California. It's something like 51 cents, but gas prices in California are $4.71 on average versus $3.09 on the national average. So it's not just gas taxes. There's an awful lot more there.
Oh, there is. I mean, the refinery. There's no doubt that there are other policy issues in California that are affecting prices, and that's their choice. And that's why they have such a massive uptake in electric vehicles in California. But I just don't see, I don't see a massive rolling of the California policy framework in the other 50 states. That's just not going to happen.
Madam Secretary, you said we're in the middle of a transition here. One of the transitions we're in the middle of is this notion or the availability of charging stations. It's the number one complaint of people who buy EVs. Becky says she's not buying an EV unless the charging station is fixed, among other reasons, Becky, right? It's not just...
Yeah, well, that's the biggest issue. I mean, I drive a lot, and...
You had an experience, Madam Secretary, too, with the idea of charging your car. I mean, you can't tell people to go out and buy something if they can't charge it.
Yeah, no, it's a real chicken and egg question, right? So we've got about 170,000 public chargers available across the United States today. We're adding about 900 per week. The bipartisan infrastructure law puts $7.5 billion into expanding that further. We think that by 2026, we'll have about 500,000 publicly available charging stations across the country. By 2030, 1.2 million. And I will say the oil and gas industry many in there are seeing this as an opportunity to put charging stations at gas stations where you can have your choice, whether you have an internal combustion engine vehicle or an electric vehicle. But this is why you're seeing now 30 states have issued requests for solicitations for installation of these charging stations. All 50 states have now had plans approved for the rollout of charging stations that are from that bipartisan infrastructure law. It's very exciting. Ohio and New York in the past couple of weeks had ribbon cuttings on their first charging stations through the president's bipartisan infrastructure law. You'll see a lot more of this happening over the course. So Becky, I hope you'll feel confident.
Madam Secretary, what happened to you on the road?
Oh, on the road, there wasn't an available space when we were on the road. So, but this is what my point is, that we need more.
I mean, if the energy secretary can't get a charge, that's a problem, I think, right?
Well, but that's the point, is that we are fixing that problem. You can't snap your finger and have 500,000
The energy secretary should be able
but
to snap her finger, don't you think, Becky, to get a charge?
No, I don't think so. I don't think so. But Becky, I hope your range anxiety, your fear of not being able to charge will soon be addressed. And by the way, anybody
It's
who
not
gets
just a fear, it's just a reality. Like when you're a mom with a lot of kids and a working mom, you got to be practical and you got to be efficient. And EVs are not at this point. They are good for some people, not for everybody.
Depending on
They're
how
more
far you drive.
expensive, and again, we have tax credits that make things cheaper, but the tax credits are paid for on the back of taxpayers. So that's, you get down to this chicken and egg.
I think like $50,000 per car or something like that. What is?
I don't know.
Did you see that report, Madam Secretary, that there's $50,000 of subsidy per car?
Oh, no, I didn't see that report. I thought you meant that they were on average about $50,000 per vehicle to purchase.
No, but
an
there's a
electric
massive
vehicle.
subsidy in there. How do you justify that to the people who want combustion engines?
Well, no, the people who want combustion engines can certainly have combustion
but they're
engines.
paying the subsidy as well.
But here's the deal. We are in this moment. What a great thing it is that we as a nation are going to be building these electric vehicles that will be in demand across the world. And we are reshoring all of this manufacturing in the United States. And yeah, does that involve some policy? Sure it does. Does it involve policy on the part of other countries who are subsidizing their industries? Yeah, we've been competing against countries that have been really aggressive about it. And up to now, we have not been. But now we've got 350 companies across the country who've announced that they're going to open up manufacturing shops to do EVs, batteries, the supply chain for batteries. It's so tremendous that we are going to have a manufacturing backbone in this country again as a result of this. And when you take it to scale, as you know, prices will continue to drop. The price of an electric vehicle has dropped significantly because the price of the battery has dropped significantly because we're taking that technology to scale and we're building it in the United States. That is a good story for America and Americans and people who want to work to get good jobs in these industries.
Secretary Granholm, thank you. It's good to see you today.
You bet. All right, good to see you too.
Coming up, FundStrat's Mark Newton joins us to talk market technicals as we get ready to wrap up the first week of the year on Wall Street. And we're counting down to the December employment report at 8:30 Eastern Time. Economists expecting a gain of 170,000 jobs. Stay tuned. You're watching Squawk Box on CNBC.
asset.com.
Welcome back to Squawk Box, everybody. The futures this morning under just a little bit of pressure. Of course, we're waiting for that big jobs report that comes in just under 12 minutes' time. But right now, Dow futures down by about 43, S&P futures off by 6, the NASDAQ down by 33.
All right, our next guest has an S&P year-end target of 5175. It's about 10% above where things currently sit. Joining us now for a closer look at what he's seeing in the charts, Mark Newton, Head of Technical Research at Fundstrat. Mark, good morning.
Thank you, Mike. Good morning to you.
So we have what seems like perhaps overdue and somewhat controlled pullback, I guess, going on in the indexes. The S&P off 2+% from its recent high, had 9 straight up weeks. Everyone said market was overbought, overheated, it's got to cool off. Is that what's going on? Do you expect it to continue to be routine?
Yeah, I think the narrative had probably gotten a little too complacent heading into year-end. That's normally the case, seasonally speaking, but people were a bit over their skis in terms of the thinking of disinflation and the labor market easing. The bottom line is that the data has been inconsistent with that view. It's been quite resilient and strong. The pullback that we've seen hasn't been all that technically damaging to the market. We've seen a necessary mean reversion in some of the former leaders like technology. But meanwhile, we've seen other groups like healthcare, which have recently started to outperform. So I see this completely as being very healthy. And if anything, it's going to be a chance to buy for investors in the days ahead and potentially as early as today after the jobs report.
Yeah, there is certainly a lot of rotation within this index retreat going on. A lot of excitement, I guess, about the slight catch-up move in small caps and the broader list of stocks against the very largest ones. Do you expect that to continue? Or, we have something like Apple down 8% off its high. It's down a lot more than the market is right now.
I do like small caps for 2024, Mike. I think a lot of these groups which have been out of favor are slowly but surely starting to show evidence of coming back. And small cap certainly is a group that should do very well as rates start to pull back. And my own thinking is that the 10-year likely gets down to 3.25 this year, potentially as low as 275. So that certainly would be a good thing for the small cap arena at a time when they have really underperformed pretty dramatically for years and years. And so this will be a necessary period of catch-up, which happens this year.
I mean, that would suggest that you think treasuries are a pretty strong buy right here, right, with the 10-year at 4. Is that just based on the patterns that you're witnessing, or does that embed some rate cut assumptions or what inflation's going to do?
I don't think it's going to be a straight line. We've already seen over 100 basis points or so of pullback in the 10-year of late, and so it's not going to. I think in general in the first quarter we probably will see a little bit of a bounce in treasury yields, but. My own thinking is that is going to happen between likely the spring of this year, probably into the late summer. And a lot of that is predicated on cycles that I look at with 10-year yields starting to pull back pretty aggressively. So, I mean, the good news is, look, the U.S. is in much better shape than most of the world. And so that's obviously a very good thing. But my thinking is we are going to see a continued retreat in yields.
You've mentioned that the S&P might actually sort of run its course in terms of this pullback, even as soon as today after the jobs report. At what level would you suggest that this is showing itself to be more than just an orderly little pullback that you'd want to buy?
Yeah, that's a good question. Look, I think anything under 4,600 would be certainly a concern for short-term bulls. But, the bottom line is that we've seen such a huge period of catch-up in broad-based participation in many of the sectors which have lagged so substantially. And so it's really right to concentrate on the degree of which all these other sectors are beginning to join the rally and buoy the market at a time when technology has started to pull back. So if anything, it's a very healthy rotation. Look, we have, close to 80% of all stocks above their 50-day and 200-day moving averages. Things have gotten pretty overdone with regards to breadth. Momentum, though, arguably is really not that overbought, and that's the key.
Yeah.
So if anything, this pullback, yeah,
the breadth and momentum seem to give the bulls the benefit of the doubt in a pullback. Mark, good to talk to you. Thanks very much.
Likewise, Mike. Happy New Year. Thank you.
All right, coming up, former Fed Vice Chair Roger Ferguson. He joins us straight out of the December jobs report to talk about how the U.S. Central Bank will be looking at the data. Stay tuned. Squawk Box coming right back.
Still to come this morning, the big number, December jobs. The Labor Department report is next. Squawk Box will be right back.
.com.
Welcome back to Squawk Box. We are just over a minute away from the government's December employment report. We want to welcome our jobs panel this morning, Sarah Malik, who is Chief Investment Officer at Nuveen, Douglas Holst-Eakin, who is American Action Forum President, Stephanie Kelton, the economics professor at Stony Brook University, our very own Rick Santelli. Of course, Steve Leisman is here, so is Mike. And we've got just a minute to go. So, Steve, tell me very quickly what we should expect.
Looking for 170 and wages, big hopes on wages. That to be down 3.9%, down below the 4% threshold for the first time.
And Rick, we have seen an awful lot of action in the bond market ahead of this. Yields have started to rise back up, the 10-year back above 4%.
Yeah, and it's not only here. If you look at gilts in the UK, they're up 28 basis points on the week. Boons are up 16. 10s right now are up 16. It's been a big move. And Eurozone inflation has been much hotter than expected. I would look for the unemployment rate to be the key today. I think we could get it, a little bit up from these current levels. I'm thinking closer to 4%.
Okay, it is time for that December jobs report. We are just a few seconds away. Of course, Rick Santelli is going to have those numbers as soon as they cross. Rick?
Yes, December numbers and non-farm payrolls a bit stronger than expected at 216,000. 216,000. That would be the best since September when it was 262,000. I don't see all the revisions yet specifically, but the 2-month revision in a combined form is minus 71,000. Traders find these revisions very disheartening. Now, if you look at unemployment rate, it remained at 3.7. We've got no uptick in the unemployment rate. If we look at average hourly earnings, up 0.4%. We're expecting it to be a little lighter in the rearview mirror. It was up 0.4. If you look at October, it was only up 0.2. So it did pop, and it seems to be holding that pop. If you look at year over year, also warmer than expected, 4.1. 4.1 year over year, that's the best since 4.2. Also, that was from September. Now, if you look at average hourly work week, 34.3, 34.4 have been the numbers. Hasn't had a lot of movement. Labor force participation reverses. This isn't a good sign. 62.8 is what we had. That was the best level going all the way back to February of 2020 when it was over 63. Now we back it up to 62.5. That is the lightest going all the way back to January of last year. And just very quickly here to point out a few things that are very important. Much anecdotal evidence suggests that on the wage side and even on the inflation side and the push between the two, just look at some of the raises that are out there. It gets pretty hard to think that it's going to be as tame as many think. And once again, as I said, if you look at Germany's CPI, 3.8 versus 2.3, seems as though the globe is depressing inflation from a media standpoint, but it certainly doesn't seem to be disappearing as fast in the numbers. Becky and the gang, we see interest rates popped up near 420, excuse me, maybe that was 408, 410 in a 10-year, yeah, 409, 410, and you see the pre-opening Dow futures extending losses, getting much closer to the minus 200 mark, around minus 180 as we speak. Now, back to you.
All right, Rick, stay with us. We've got a lot more to get to our jobs panel for some instant reaction on this. Steve, let's start with you. Just what you see in the details on these numbers, because as Rick mentioned, futures sold off on this, yields picked up.
First of all, I'm very disappointed in the BLS and this consistent downward revision. These were some big revisions to, one of them was 150 down to 105. The other was 199 down to 173. Consistently downward revising. I wish the BLS would get on this and look at what's going wrong here. I don't think there's any particular bias in this, but if you keep coming out with a number here and keep revising it down here, I think you got a problem. I think this number is a little weaker than the face value of it. I'll tell you why. Only 142,000 on the private sector. We have two things that are happening in this economy. One is that the government sector remains, I have to check it now, came into this number below the pre-pandemic level. Economy's grown over that period of time. You would think that at least government employment would grow with it. To the extent it hasn't, it remains a bigger deficit. Government added 52,000 jobs, with a lot of those jobs coming in local government education and local state non-education jobs. That's one. Two is that the two big places we've gotten the jobs are in leisure and hospitality, still a sector that was running below pre-pandemic level, and the other is in healthcare. And we need and have needed and will need nurses and doctors and other folks in the healthcare sector for a very long time. So that's sort of normal. I don't see this as a particularly hot number. I think the participation rate is a problem. I'm not going to jump on that right away, but it's
the wage growth 4.1% annual.
With the private,
that's hot.
Yeah.
With the private sector being 142,000, that's the number I'm looking at for the how hot the job market is right now.
Rick sounded awful like Paris Hilton. Before we dig into deeper on these numbers, Sarah, I do want to get to you just to talk about the market reaction to it, because it's something worth watching, particularly when you're looking at the yields.
Yeah, this number is good for the economy, but it's not great for the markets. The two factors that have driven the market weakness this year are the Fed and market valuations. This number will continue to throw cold water on the narrative of 6 rate cuts for 2024. That needs to get priced out of the markets. I think 10-year yields continue to move higher. Those are headwinds for equities. And then coming into this year, looking at valuations, what happened in the fourth quarter of last year was we robbed Peter to pay Paul. That market rally was overdone. It pulled forward the returns from this year, and now we're going to have to keep unwinding those. So good for the economy, but that means less rate cuts this year and higher yields. That's negative for equities.
Stephanie, maybe we should focus on the good for the economy for a moment.
Yeah, I think so. I mean, this is the 36th straight month of labor market expansion, and I agree, Steve, the downward revisions aren't great to see, but this is the 5th longest expansion of the labor market on record. So no question, we are seeing some softening, and this is what the Fed's been after all along, right? The so-called better balance in the labor market. So we aren't seeing real deterioration. I think we're seeing a downshifting, and I hope it's a downshifting to what becomes just a more stable trend. And I think, from where I sit, that's what this looks like to me. I'm not too anxious about 4.1% wage growth. We were roughly running at 4% before this. That's essentially where we still are, a couple of percentage points of productivity growth and 2% inflation, and there's nothing unsustainable about 4%.
Doug, you agree with that? 4.1% inflation growth, or average hourly wage growth, is something that the Fed's certainly going to look at and think, wow, maybe we have not killed this inflationary boogeyman.
Well, I certainly think the Fed is in no position to start cutting. That's been oversold dramatically. If you look at the core PCE price index, it peaked at 5.2. It's 2/3 of the way to the 2% target. But that means there's another third. That's probably another year. So there's nothing about the Fed's position that's indicates it's going to cut soon. I think we should enjoy this report. I echo everything Steve said, but I think it's going to deteriorate going forward. Everything's been driven by supply in the labor market for a while. It's shifting to a demand-driven market, no question. Aggregate demand, business is flat. It's been flat in the third quarter, flat in the fourth quarter. It's been carried by households and government spending. I don't see the government spending changing, but the households are starting to look more fragile. So I think the first half of 24 is going to be very, very rough.
Sarah, earlier I was saying this, and this report and the market reaction is going to test this, but with inflation more comfortably in a downtrend, at least recently, it seems as if good economic news could be embraced ultimately by the market. I mean, do you really think that the big challenge to equities is going to be the economy holds up too well?
Well, we're definitely past the peak of inflation, but the question is, are we past the peak of monetary tightening? I think the conversation this year is going to shift from how high to how long. We're going to have an elongated pause in what the Fed is doing, and how does the economy react to that? I think there's great places to still invest within equities, but you need to be a little cautious. So segments such as REITs tend to outperform, not only during periods of rate cuts, but during periods of rate pauses. I think it's time to take a look at technology again. Software stocks have underperformed. Palo Alto Networks, a company that's outperforming its cybersecurity peers, moving from legacy hardware to the cloud. There's going to be areas of weakness. You need to be more selective, though, because in a world where we're not going to have that easy money coming back to us so quickly, we need to think about how we invest in equities when we're entering the year at 20 times earnings. And so I don't think that there's going to be much room for valuation upside for the S&P this year, but there's still room for earnings growth selectively.
I just want to chime in here real quick. The wage numbers, I want to remind people we've had this ADP number, which has a sample of 10 million people out there, and that's been coming down. So it's higher than this number here, but it's been coming down. I am more moved by that. But Doug, I just want to ask you this question, since you're such a smart economist. Are you really, I don't know, what's the right way to put this? Are you ready to separate this idea that, look, inflation's been coming down. We've had strong wage growth. We've had strong jobs, strong economic growth. What is the connection here between inflation and the economy? Isn't it really just been a supply story and a restoration of the supply?
Well, it's been a restoration of supply. We also got everything broke our way on inflation in 2023. We got a big bump in productivity. It was running negative for the first 2 years of the Biden administration, went to 2.3%. Huge supply shock. Energy prices came down dramatically. Oil's down 11%. Overall energy down about 6%. Grocery prices flat. So everything went right in 2023 on the inflation front. That doesn't happen every year. And going forward, I think we're in a position where we have to worry about traditional business cycle dynamics. Every business cycle after World War II, except the pandemic, was led by a downturn in business fixed investment. Business fixed investment is dead in the water, and will have been dead in the water for 6 months. I'm very concerned about that, because you can't have a household sector growing strongly and a business sector flat. They have to come together somehow. The good news is if business comes up, but I'm afraid that they're going to equalize at a lower level, and we're going to see a really slow first half.
And Rick, I just want to throw this out there that in one sense, this is a victory for the way the Fed has been talking about the data more so than the market, that it's not a straight line. There's going to be bumps along the way. You're not going to have a straight line down in any particular metric. And I think that's something that you have to acknowledge. The Fed has been saying that this is not a gimme, all of this stuff. And so I like the idea of the market just backing up here and taking more account of the idea that there is some risk in the forecast of where things are going.
Yeah.
I think the market's dealing with the numbers very well, but I think that the issue here, Steve, is that if you look at the Fed and you want me to give them a compliment, all they talk about lately is 3 and 6 month annualized rates based on 1 month inflation. I think that's leading us down the wrong path personally. And 4.1, okay? Let's put that in real context and take all the emotion out of it. Pre-COVID, Jan 2020, it was 3.1. Okay, in February 2020, pre-COVID, 3.6. Since then, the lowest it's been is 3.9 in December of 21. Okay, 4.1 is a bit high. We pick up the newspapers every day, or you go online, or you get your news from wherever, right? How often do you see, raises 2% or 3%? I don't see any of that. I see raises 18%, 20%, 100%. I think you can call that anecdotal evidence, but I do think that there's a certain amount of inflation and wage inflation and government policy inflation, and I don't see a lot of that going away in a linear fashion, period.
I will not disagree with that.
Stephanie,
I think he's right.
You want to weigh in on what you see the Fed doing with all of these numbers? Does this make the case for rate cuts much tougher?
I don't think it does, Becky. I mean, last week we were talking about whether inflation might be decelerating too rapidly, right? We got inflation numbers, we poured over them, we said, wow, you look at the last 6 months, you annualize, we're actually running below 2%, which triggered the whole conversation about whether the Fed would move in March versus May and how many rate cuts, and maybe we'll get more than we thought we might get because inflation is really decelerating quickly. And now, because of 1 month of new data, we want to change the whole conversation. I think we got to take a longer look. The trend is our friend. The labor market is coming into what Paul has called better balance for a long period of time. Inflation is decelerating. I mean, sure, anything could happen. We've got things happening in the Mideast, and God knows there are other things that could happen that could cause inflation to accelerate. But I think, leaving those sort of things aside, we're in a very good place right now.
Sarah, now there is a little bit of... yeah, go ahead, Rick.
No, this is Doug. I just want to remind everyone that from the beginning of this tightening cycle, what Powell said in 22 was the only mistake the Volcker Fed made was easing prematurely. We will not make that mistake. They have been on that page since, and so they're not going to ease in the first half of this year. They are going to stay where they are, and they are essentially effectively tightening. They're running down the balance sheet. They are letting real rates rise as inflation drops off, and they need to do that because of the risks that come with inflation being much more stubborn than people perceive. I think that's the right thing to do. I think everyone's way ahead of themselves talking about rate cuts at this point.
Hey, Rick, what did you get? They revised what, November and October?
Yeah, I see the revision for non-farm for last month from 193 to 199 to 173. I don't see the previous month, but I see the cumulative total at minus 71,000. I picked that off the wires.
Yeah, I just want to point out, and I'll put the numbers together in a straight way, but ADP has been well below these numbers the entire time. It's been taking some, what, from the street for being low.
Yeah, but then the revisions come.
The revisions seem to be in ADP's way.
Right.
I'll do a more statistical assessment of that, but it's kind of interesting.
Yeah.
All right. Thanks to our jobs panel today, Sarah, Douglas, Stephanie, Rick, and of course Steve, and Mike and me. We'll take it.
Yep.
See you guys later.
All right, coming up, we're going to have much more on that December jobs report and what the Federal Reserve will be focusing on the most. Former Fed Vice Chair Roger Ferguson will join us. And a reminder, as we head to a break, you can get the best of Squawk Box in our daily podcast. Follow Squawk Pod on your favorite podcast app and listen anytime. We'll be right back. Welcome back to Squawk Box. The economy adding 216,000 new jobs in December. That was above expectations, though the prior 2 months were revised lower. The unemployment rate unchanged at 3.7%. Forecasts, I believe, were for 3.8, so better than expected. Futures right now have backed off just a little bit since the number. Yields are also up. Seems like the reflex reaction right now.
All right, joining us now to help break down what the new jobs report means for the Fed and the economy is, as it considers its rate policy, former Fed Vice Chair Roger Ferguson, also TIA's former president and CEO, and of course, we are lucky to have him as a CNBC contributor. Good morning, Roger.
Good morning.
Nice to have you on right after this number. I know we'd all like a little more time to think about it, but here we are, the market's reacting as we speak. Where does this put in the context of what's going on in the economy, especially in light of the fact that this number has been revised quite a bit lately?
Well, look, Steve, I think this report has 2 or 3 complete elements in it that support different stories. I think the overall story the Fed will take from this is they have been right to push back on expectations of a quick pivot towards cutting rates. You know, the rate cut story of, starting in March and maybe 6 this year, I think this sort of knocks the legs out from that from the standpoint of the Fed. So I think you'll continue to hear some pushback there. And I think that's probably right. They'd also look at that 4.1 number and say, okay, things are still moving roughly in the right direction, but not moving as quickly as maybe some had thought. Point 2, one that you've put your finger on just now is, wait a minute, there have been some revisions. You've got to be really pretty careful here. We have been keeping monetary policy fairly restrictive, and so there will be some voices. Austin Goolsbee from Chicago comes to mind. That will be pointing to that as saying, let's be a little more cautious here. I think that's a slight contrarian point of view versus the majority point of view. All of that means that you'll hear them continue to use words like cautious, too early to declare victory, preparing to move nimbly if need be. So I think this leaves them roughly where they were before, pushing back on the notion of mini rate cuts this year, starting early, but in no sense yet declaring victory on soft landing, because there's some things here that do suggest potentially a hard landing might be ahead of them as well.
Roger, when the number came out, I focused on the private sector number. Is that the one you think that the Fed is maybe a little bit more focused on for what it says about the economy? We've had this surge in government hiring as government, it appears, is trying to catch up with where it was before the pandemic. Is that a better way to think about this number? And in light of that, don't you sort of come up with a less or a cooler job market than you would if you look at the top line number?
Well, look, I tend to look at the top line number, and here's why. The government is an important part of the economy overall, along with healthcare, along with tech, along with other things you talk about. It's a reflection of different kinds of supply and demand imbalances. Remember, one of the questions that is driving inflation is, well, how much fiscal stimulus is there put into the system? That gets reflected in the government number. So I would be a little cautious about saying, private sector number is where we should put most of our weight. The government is an important part of the economy, and it's a reflection of fiscal policy, and it's a reflection of a different kind of supply and demand. So I tend to look at both, but I would be a little cautious in saying, all weakness or more weakness in one versus other.
Yeah, I'm only saying that because local government just pretty much got up to the level it was at before the pandemic, so maybe some of that eases off. Let me turn to another issue that was brought up by Doug Holtz-Aiken, which is the idea of productivity. We've had fairly strong productivity. Is that another reason to look maybe less cautiously or be less alarmed by the wage growth numbers? If productivity is high, then wage growth should be higher.
No, I agree with that completely, but you also hear some of these anecdotal stories come into play. So, you're a Fed watcher, you know what the beige book is, which is basically all the anecdotes. And I think they're trying, and you've heard them talk about supply and demand coming into better balance in the labor market. And so, yes, don't put too much weight on the 4.1 because productivity is an important part of that story. On the other hand, they're looking at the whole question of job openings. I think they may be a little concerned about the labor force participation rate pulling back, which means, the supply coming in may be a little more constrained. So again, I look at this and say, the cautions they've been talking about, the pushing back on let's cut quickly, all of that I think is validated by this report.
Roger, I've known you a long time, and you've been cautious that entire time we've been that I've known you. Tell me just quickly, if you wouldn't mind, would you be cutting rates this year, and when and by how much?
I think I would be very much in a watch and see mode, prepared to cut rates if things look like they're getting too bumpy. You've heard me occasionally talk about a worry that I have about a hard landing being too quickly discounted. But right now, I'd be in the let's wait and see, probably rate cut in the second half of the year. So call me sort of in the meeting of the dot plots as they showed up most recently, but prepared to move more quickly if things look like they're falling.
But it would take a really rocky economy before you would say go ahead and cut sooner.
I think so, yes, Becky. Now, look, we have some concerns, and I've heard, I think Doug or others talk about what exactly is happening with the household sector. Are they running on fumes, so to speak? No evidence of that thus far, and unlikely with a strong labor market. There are some concerns about the business sector and business fixed investment. So there are places to look for softness, but right now I think the major theme is the economy's holding up pretty well, getting back into balance, and so far so good, and let's hold on to where we are with the discussion of rate cuts towards the end of the year, not the beginning of the year.
Roger, thanks for joining us. Squawk Box will be right back.
Government employment report showing a gain of 216,000 new jobs last month. Futures were lower off that, yields higher, but actually that has unwound a little bit. You've seen the little bounce in the futures, and yields are off their highs as maybe the number is not quite as hot as the headline makes it seem. Joining us to talk markets is Brenda Mangello, Chief Investment Officer at Sandhill Global Advisors and a CNBC contributor. Brenda, good morning. So we came into this year, the market seemed pretty confident of a pretty idyllic soft landing scenario. How does this data feed into it, and what do you make of the market's rocky start to 2024?
Well, I do think, if we look at what this data and what it means, I think this continues to support a strong consumer. which in our view is really key to the economy maintaining its health as we move through the year. But I do think if we look at what happened during the fourth quarter of last year, it really was a stunning move across the board, both in equities and in yields. And I think we're just digesting here.
We're not digesting, we're overbought.
I still think that the fundamentals should be relatively healthy if we look at earnings growth for this year. If we continue to have a strong economy, we have inflation easing. We also have an environment, I think, coming into this year where...
Okay. I can only take so much lies. I really can't. She had one thing right, that this is the biggest run I've ever seen, and it's and the market's not predicting what's going to happen in the future. It does have to digest and consolidate, that's for sure, but no, like I said, 20 years, I've never seen anything like it, and it's unprecedented. It's all about government spending, and they're looking for that stimulus that hasn't been spent yet. Like $6 trillion they put in this market in the last 3 years. $6 trillion the government has printed. Not 1 trillion, not 2 trillion, 6. And we already printed 4 or 5 trillion because of COVID and the government lockdowns, and this is unprecedented times. So I just can't stomach listening to these people today, but I'm going to, because I'm going to buy everything they call out. I'm going to buy a put. And we could get us a nice little bounce, because this is really a big time pullback. It's really not that much from 477 high to 466. I mean, it's only $10. So I'm not really too concerned about the pullback. I'm concerned about the lies. I've been in rooms where they pump, there's a lot of traders out there that trade the 52-week high, and I've never been good at that, because I always figure, you know, double top, triple top, we're going to pull back. And we always, mostly 8 out of 10 times do. And then we end up pulling back eventually again, like this LLY, man. I listening to him yesterday when the market was real red. I'm going, you people. I wish I'd really loaded up on that one too. So that's their number one baby right now. It's not showing on the something funny. They're pumping this mark 112 to 113, and well, here, look at that pump right there. Somebody bought 2 shares at $1 above 6-7 ticks earlier. So somebody's throwing in the pump scene here. Somebody's stuck in this trade.
Like that. Yeah. I mean, the OK camp just says, wow, I can't stay in the Mag 7. I better go into the there was a great piece this morning. Got removed from the journal. It's like, the amount of money going into cash is extraordinary, because cash is extraordinary. You get like 5. You can make a lot of money with 5 and not have to worry. Of course, if they cut rates immediately, they would, but they're not going to.
The flow data today is interesting. B of
What's
A,
that?
biggest purchase of money market funds since November. Another 57 billion, right?
I thought that was incredible. Very little in stocks, a little more in bonds, which again, that's just Mag 7 sell, buy, rest.
So you think the jobs print is a push, more so to speak?
I think it's more of a push than people realize. I think that what we're going to do is get away from the camp which says there's multiple cuts, which is good because that's not Powell's camp. I don't know whose camp that was.
It's the wishful thinking camp.
And wishful thinking camp. And those people, they should just go somewhere else. They should do some other game. I mean, they really shouldn't. I mean, you got to deal with reality. The economy's not that bad. And the only thing that happened is we got rid of higher for longer. Then we had the job plot. I mean, it's like, geez, we had these jolts. And I find this up tiresome because all they're really saying is, look, if it's weaker, we're going to cut, but we don't want to cut too fast because that's the big mistake you can make.
36 months of job growth.
Right.
I think 20 plus of sub 4%.
Apple came within 10 cents.
As we stay at 3.7.
Apple came within 10 cents of my support level. We got a double bottom at 180.18. I had 180.08. Piton was alerted yesterday. It was a nice little trade. Piton. Then Sophie. I'm kind of believing that the article that came out on Sophie was not all that true. So we're back down here again. They're going to we got day traders trading this now. Amazon's took a nice little tumble. $10 on Amazon. Yesterday was a pretty good flush out. And then Coin came real close to hitting my support level on a double bottom yesterday at 143.06. So I'm still going to stick with that. Actually, I'll raise my alert to the body of that candle right there. Mike posted in here, it might be a good idea to look at your discretionary spending stocks. Got Walmart off the 200 on the 1 hour time frame. My bottom support is 156.34. Eli Lilly, I come within $9.84 of hitting my support here. I think we'll still go down on it. In fact, let me put this on this side. I want to watch time and sales, and I'll put the level 2 over here. One day I'll talk about how to trade the tape in the level 2. These are 3 things that I like: is the tape, level 2, and news. Dr. Scott Gottlieb. Weight loss drugs, side effects, hair loss. Best weight drug there is out there is not to overeat. Don't go for seconds. I think it was Reba McEntire would eat only half her meals. That's why she always looks so fine. It's hard not to overeat because when you're around good food, like some of my chicken soup. So come real close to that. I still think we're going to hit 600 on this. They're pumping the crap out of a stock that's had too big of a run. I'm surprised. Well, they said NVIDIA was going up to 1,000 here last week. And I said, are you serious? Are you at this again? So you want to look for this here is an expansion pattern. Not much of an expansion pattern, but it's definitely a bear flag. And we'll clean this up and get a new picture, new view of it. Yesterday, I was really pissed off at myself. I just wanted to quit, walk away, and just start a new day. Yeah, this is a Darvis box. We could be in a Darvis box for years. We're already been in a Darvis box for what? 7 months? But it is look like it wants to break out here with an ascending triangle, but we kind of broke below support. We got bear flags. So the pivot point, the two pivot points would be this previous high right here. That would be one support right there. And your second one would be the bottom of this channel here. And the intercontinental divide is right there. So I'm going to change these out here. Oh, damn it, Jimmy. I really like the way these spreads are, though. It's a $100 spread. So I'll just set an alert off this, well, it's off the wick. Right there. Go ahead and set an alert there.
Show that he missed the number and he wasn't prepared, didn't have the number, just I missed the number, I feel really awful, what's the number? We're going to have David Ricks on Monday for our show, and that's not going to be like that. I think Karen Lynch is doing a remarkable job at CBS, remarkable, and I can't wait to speak to her.
One thing we got sort of from some analysts yesterday, looking ahead to the conference, is that some don't expect M&A to be as big a part of the conversation there as in prior years.
And I think that's completely wrong.
Really?
Yeah, because almost every company has a patent cliff. So they have, I mean, look what Bristol Myers did. They bought like 3 companies right at the end of the year because they have this bad patent cliff. And they can solve the patent cliff by actually buying companies. That's what Pfizer did. Merck bought this Prometheus. People don't talk about it. It's an irritable bowel. I think it's terrific. I think Rob Davis is doing a terrific job. Bristol Myers might be turning here. It might be turning. I mean, they bought a lot of companies. And remember, a lot of these companies, a good piece in the FT today about how venture capital is having trouble raising money. A lot of these biotechs were out of money or they couldn't raise enough money. And you've got companies that are doing really aggressive things in neuro. Like,
80 cents.
After neuro, and I was the spokesperson for the American Brain Foundation. You go after neuro at your own risk because no one really, we're just starting to realize what's in the brain. Vegas nerve, really kidding. I'm not kidding. The vagus nerve. And the first time I went to see a migraine doctor, he said, "Look at your vagus nerve." And then I went, I said, "I have a tinnitus problem." He said, "That's your vagus nerve." I said, "What the hell is this vagus nerve?" Like, Jim, look at the map. Get the triptych out. There's a AAA map. People know the brain a little better than they used to.
Right.
I'm not kidding. Brain is really the next frontier.
Oh, that's interesting. Yeah,
It's
well,
the next
watch
frontier.
the pace of innovation in medical science.
Oh, why don't people realize? I mean, geez, you got to go to your doctor. The pharma is well ahead of the doctors. I was speaking to someone in pharma the other day. I said, "Do the doctors know about this great drugs?" Not yet. I said, "Oh, build some awareness. Run some NFL ads."
That's where the marketing and the free patents come from.
Yes, and they got to run in on Peacock with the wild card game. You know,
not in the fourth quarter though.
No, not in the fourth quarter. Fantasy stunt. Yeah. What daily things?
When we come back, Red Sea concerns, the attacks, the impact on oil. You'll hear what Chevron's chief had to say about some of these geopolitical risks, in addition to what McDonald's said in that blog post yesterday.
Yeah, what was that crazy talk?
Some weakness in the pre-market, but not as pronounced as earlier. As the
I can't believe McDonald's said that.
Second look, more squawk in the street straight ahead.
Now Pepsi is getting boycotted by stores because the price is going up so high. I don't drink. I don't. I don't participate too much Pepsi at all. I mean, I drink maybe if I'm lucky. I don't think I've had a soda all year. I remember when I was a kid, my dad took a Pepsi or a Coke and threw it on the battery to wipe off all the battery acid. And from then on, I said, "I ain't drinking this shit." I was just a little kid when I saw that. My eyes opened up big, and I said, "No, all right." Then everybody in my family has diabetes because that's all they drink is soda. They don't drink water. I mean, that's it. That's, if they don't got a soda in their hand, they're not happy. It's like an addiction, kind of like cigarettes. They say cigarette addiction's worse than heroin. Intel is the one that we got to keep a good eye on. And Google can fall more. Irrational exuberance. And Baidu, I nailed that Baidu on the 1, 2, 3 shoulder line. I think we can come back and hit the 200 on the 1 hour time frame. PLTR to the penny. Yes, this morning. Yesterday, PLTR. And now we broke below it. No, we're still there. We broke below my support level on the minute. People asked me to get in PLTR yesterday. I said, my best advice when the market is going in a downtrend, don't try to buy anything until we see an uptrend. And this could be over this week. We come in Monday, it'll be a new week. Earnings are going to start taking into play. So you got the banks. If there's been any pullbacks in the banks, I'd be looking at the way they've been talking about them. Pull up that 20-day 1 hour and set you an alert off the 200. Right now we're holding it up real well with these moving averages. JP Morgan, that's my number one bank. And here's Chevron. Now the Lady Energy came out. The Secretary of Energy came out this morning and was boasting about America's oil production. And in the same line, she was pumping EVs. That's her agenda. Okay. 2025, we'll have 50,000 charging stations in the United States. And you, the taxpayer, are paying for it. Even if you'll never own an EV car in your life. And we're giving $7,500 away to the rich to buy one. I asked all my liberal friends one day, I said, anybody in here going to buy an EV car? No, not one reaction. I'll have a Tesla. I might have a Cybertruck. But I feel like I don't want one now because of child slavery. I really don't want to buy something that's been produced by children. In the Congo. Oh, mama, I'm excited. I'm almost out of breath. So I'm going to look at gap ups and see what's gapped up this morning. I got the hammer scanner on. I want to check hammers and see if we got any daily hammers happening from yesterday. And I want to look at the gap ups. See if I can get a gap up trade and pull and ride the pullback. I'm surprised I don't have another. Also be looking at the Russell micro cap and mid cap. I think pennies are so cheap now that these stocks can run up and take some of the resistance off of these tech stocks that'll still be in play. So we've got a gap up scanner here. We've got QS. Where's mine? Huh. There we are. No, I can't see it. Come on, you dingleberry. QS. Golly, look at that. No news. Well, yesterday it had news. QuantumScape, 44% on pace for the largest percent increase since 2020. Upbeat results, therapeutic. If I saw this yesterday, I'd probably shorted it too. We're pulled back to 68%. So, see if we get a double bottom. If we don't hold the double bottom, we'll short it. Maybe OMGA. Here's another one. We've got a symmetrical flag. It's failing. So it can drop to the 51. Here we've got a triple top on SAN. Could pull back on a triple top on the 20-day. MU's on here. No, that's not a gap up. That's a gap down. NOK is another one they were pumping. Nokia. What about PG, Procter Gamble? That's on our watch list. Sudden alert off the 200. On the 1 hour time frame. Now we'll look at the gap downs. Volume high. I've got Apple. That's definitely on watch. Apple hit my support within 10 cents. So really pay attention to Apple today for a day trade. You could get probably a couple bucks out of it. Got a gap in here. So anywhere around 183.46. MBLY. I got to see if it had any bad news. Outperform rating. Still, price target has been lowered by RBC. Needham says maintains a buy on the stock. Lowers the price target. Everybody lowers the price target and maintains a buy. So they're pumping that stock. Nike. LFMD, and what about FSR? I'm waiting to get into this one, but I'm not ready yet. We're definitely at support today, FSR. So if you're in this one, I'd keep a close eye on it. We hit that yesterday and we hit it today, so that's a double time. Let's move this to the 3 minute. Descending wedge, no, yeah, maybe. We'd have to come down farther if we don't break the 200. I don't know. I'll wait on that. It could be ready. Weight Watchers. This is one that I called out. I figured would get a good bounce, but it's not the case. We are definitely down here at support level, though. We hit it yesterday. And I haven't took the trade yet, so basically, look at that. I mean, that's a good spot. 656. Keep a good eye on that. Then Bank of America, if we get a pullback on it, I'm going to go long. Right now, it's holding up well. Goldman Sachs. What time is it? We got 3 more minutes. Airlines. I always like to go through the sectors. Airlines is at UAL's at the 50. Bounced off of it twice. So we're squeezing. And Verizon, they were pumping Verizon yesterday. We did break resistance. They always pump the ones that break out of a resistance. So the gap down. Let's go with descending. Mara. The rumor mill says that they're just hoping that one of these ETFs pass. Mara was a good trade yesterday. Mike called that one out. Boeing, I've got real close to hitting my support on Boeing. I had 243.34. No, we didn't. 243.34. We hit 243.60. So I'll still keep that in mind if my alert triggers. FAS and FAS. These were the first two companies that I used to trade. FAS and FAZ. They just work as the opposite. And X has had a good run. It's held up my $48 real well. Everything's breaking out. The SPY broke out, the IWM, the QQQ. So we're going to break up to the upside. Resistance to break on the SPX 47.12 with a pivot point of right around 47.04. I was so distraught after yesterday. I shouldn't have been. It could have been one of my best days ever if I just stuck with my trading plan. I think it's a lot of things I don't do. Sometimes I call these trades out and I don't go back and look at them and I say, damn, Jim, why didn't you take it? You nailed it. Here we go. Lily's getting pumped. We're at the 200 now, so I'm going to get my put ready. They're probably going to run this up a little bit. It's the biggest pump out there right now. Look, LLY. I'm excited. I'm surprised it opened flat. The SPX. So we got to break the 50 on the SPX on the 1 minute. And we're squeezing between the 9. Yesterday I did very well out of the gate. That's when I got in, stuck in that call is what killed me. And today we're going to do the 8th. So if I was thinking like these fat cats have been calling this market out before the year started, I'd be very eager to get in this trade right now. But but I'm not going to do it. Because we broke support. I don't know what the deal is with this monitor. I think this weekend I'm going to move monitors around. I'm going to buy me a new 32-incher. That big drop right there. Am I right? Or is it a big run? Yeah, it's a big bounce. Okay. Mare's about to my support level. But I'm not going to trade it yet. Tesla, it's up from my 234. We got 3 white soldiers out of the gate on the SPY. Got Honeywell on the scanner with a hammer. See, there's the hammer. The scan's pretty cool. And Zim. Someone mentioned Zim the other day. I had a 1482 resistance. An NV8S. There's NVAX, or what is it? Invax. Invax pulled back to support. We had a good run on this one yesterday. Called this one out when it started to break resistance. And and PLTR pulled back to the penny. This is very, people are looking at the $16. I want to scalp this baby for the put. Let's break out under the 9. 467. Get my beach trade out of the way right now. Oh, what day is this? Oh God, I'm glad I got January 8th. I don't want the same day on a call, on a put, or anything. Same thing happened yesterday. I got all excited because we had a nice little breakout in the market, and then we tanked. This time I'm thinking a little different. I want to take us back to the 51. If we don't stop, I'll stop right at 116. That don't look too positive, but that looks better. Drop down there. No. I know why. I think Lily's earnings are going to be coming out soon. Maybe that's why they're
Interesting
pumping
to
it.
see, on a morning where people, the thinking was, oh, we got to rethink rates. Names like Pulte are up 1% or better.
Look, I think that you posted a very good point on X.
From Fitch?
Yes, it's not a hot number, which means that housing will continue to be good. They're not building as many homes as they did before. The raw costs are down. They're making a lot of money. Toll Brothers bought, I have like Toll Bester. Toll Brothers bought a huge amount of stock. I mean, this is not your grandfather's home builders where they'd be putting them up like mad and they have no buyers, or even the 2008 period when I literally went out to the Imperial Valley to see if I shouldn't just buy land and become a home builder, which of course I should have. Instead, I watched my daughter play field hockey.
I was surprised. Goldman put out a forecast for the mortgage rate, the 30-year fixed, and ending the year still at a 6. I mean, a low 6. But it's not like that's going to collapse.
No,
in their view.
Remember, the mortgage rates are going to stay there, and the price of housing is going to go down a little. Don't look at Manhattan; that is a separate area. You're going to be able to. I think you're going to be able to do well because I think there's going to be a glut of apartments that were all started at the same time. Now I know I say ignore Manhattan, but anybody who wants to see Venice, the Gowanus. The Gowanus, the number of apartments that are being built along the Gowanus, you would think it's the Riviera.
Really?
You really would. I mean, thousands of apartments are coming in. They all start at the same time. And I know that's anecdotal, but believe me, if they're building them around the Gowanus, which, by the way, sometimes is blue, sometimes is green, it's like the river in the movie The Fugitive on St. Patrick's Day. I mean, sometimes it's bubbling. I'm always afraid someone's going to be smoking a cigarette while I walk over the bridge.
Yeah, well, the new supply online is definitely a story in the Southeast.
Stay close to that story. People are not talking about the number of apartments that were started after COVID that are now coming on. And they don't talk about it because a lot of them are these private developers, but there's going to be a glut of rent, and therefore there will not be that wonder of where you can stay in your rental or get a rental and be very expensive. That drives home prices down.
We're going to watch shelter, especially given CPI on the way.
Oh, absolutely. And I know that
CPI?
PayPal's not happy that housing prices are up 35% from 2019, but he can't be happy about the grapefruit's doubling. There's some things that don't have anything to do with the Fed funds rate. You planters peanuts.
Yeah, can't change the weather.
No, you can't. Thank you.
Quick reminder, you can always get in on the CNBC Investing Club with Jim. You can sign up and find out more at cnbc.com/join the club, or just use the QR code on your screen. If it gets out of the way from the tape there, and it takes you right there. As we go to break, watch bonds. We are going to get a little Fed speak today, Barkin at 1:30 p.m. Eastern time. For the time being, though, watch the 10-year, the S&P holding 4,700, Dow's marginally positive. Don't go anywhere.
Do-do-do. Meta.
Take a look at some S&P laggards for the week to date. Jim mentioned this call out of Wells today where they do upgrade Carnival, but cut Norwegian, saying they prefer CCL's deleveraging path, valuation, their EBITDA growth upside risk. We'll watch that. Enphase as well. VF Corp, kind of a mixed bag. With semis in the mix as well. We'll get stock trading with Jim in a minute, and the Dow up 31 points.
Same start as yesterday.
Washboardjim.
Let's get to Jim and stop trading.
Now, I did make a joke earlier about a stock called How I Met Your Mother, Hal Met. But here's 4 recommendations for it. Now, what people don't know is that this is a $21 billion company that used to be the screw, the fastening business of Alcoa. And 4 recommendations, the most recommended stock so far this year that I've found.
Really?
Yes, and it is a very good company. It does forgings for aerospace, and GE's up a lot. I mean, people are saying, well, listen, I should go and be in How I Met Your Mother, HWM. All I can say is that Elliott Partners was right. There was money within Alcoa if we broke it up, but it was all in this company, How Met.
Wow. I guess it's sort of a comment on the need for airline capacity.
2 million screws in the 747.
Jeez.
Yeah.
And you heard Eunice, our correspondent in Beijing, yesterday talking about the prospect of opening up more U.S. flights.
It's got to happen. Look, I think that there's. If you want to buy, remember Macy's is the one to play. They used to send the Chinese junkets to the U.S. were 10 times what they are now. They need more aircraft. That country is in. I just don't know what's going on in that country. But that was the way that a lot of our retailers did well in New York was because of these huge Chinese travel ventures that are now 1/10 of what they were. They need planes.
So tonight, what do we look at?
Okay, Constellation. Let's find out whether, other than Kim Crawford, it's been good wine.
You're going to do your M&A consulting.
Yes, I am, and I do think I know Bill knows, like everybody else, that the decline in bourbon and whiskey is really extraordinary. We've never seen anything like it. Again, some of it's cannabis, some of it's GLP, but these were the greatest cash cows in the world. Now they're not growing at all. Very interesting.
And then I imagine you'll look ahead to, as we said, the busy week we get next week.
Oh my, we have so much going on in healthcare. Never forget that while all this stuff is going on, that Amgen is doing incredibly well. That Regeneron's a very inexpensive stock. These companies became inexpensive. Why? Because of the Mag 7. These all became sources of funds. And, Syncora by the Mercer's program.
How many interviews are you doing in 2 days?
I'm doing 17 interviews.
In over 2 days?
Yeah, last time my wife said, she looks at my schedule. She goes, I count that you're doing 17 interviews. I said, actually, there's one more I just added. And she said, you're insane. And she went to bed. What else?
You might get out of this.
Busy, man. But good for the viewer. Well, thank you, Jim. We'll see you tonight. And, of course, Jim will be at JPM Healthcare next week. When we come back, NEC Director Lel Brainerd with White House reaction to the jobs number and a lot more as we got the Dow hanging on to some modest gains, 18 points. Don't go anywhere.
It's going to be a flat day, it sounds like. We got the IWM still respecting the 9. The SPY is disrespecting the 9 right now. And we've done it 2 other times. So this is 3 times the charm. The 50 SMA to hold up on the SPX. Meta should hold 347, 348 at the lowest. 348.14 PLTR. I've been fired up on this one here. I missed not much of a run. Well, not bad, 60 cents, but I didn't take it. Now, if we don't hold the 21, we'll bounce back up here on SPY. Do. Damn. Back to even again. They're buying into this dip. Just got stopped out. Watch the market. They're buying in the dip.
NBC.
Good Friday morning and welcome to another hour of Squawk on the Street. I'm Sarah.
That was a huge buy right there.
We are live for you, as always, from Post 9 of the New York Stock Exchange. David has the morning off. Take a look at stocks this morning. Reaction to jobs is a little bit better than we initially saw. S&P 500 up 0.25%. NASDAQ up 0.2%. Dow's rising about 19 points.
Yeah, somebody just bought a ton of it.
In groups like financials at the top of the list today, up 0.5%. Consumer discretionary,
Watch the spy here.
communication services. What's not doing well? Well, more defensive groups like real estate and healthcare at the bottom of the pile. For the week as a whole, though, we're down 3% on the NASDAQ, 1.5% or so on the S&P. Treasuries, in reaction to jobs, the gut was to sell treasuries, pushing yields higher. We see that continuing with the 10-year note yield above 4%. We got there, actually, after the European CPI numbers, which we'll talk about. But it's backing off a little bit. Look at the 10-year. It just went below 4. We're 30 minutes here into the trading session. Here are some movers we're watching right now. Fresh numbers out of beer maker Constellation Brands, posting better than expected profit. Those sales did fall short, and the company had to lower its full-year guidance. Berkshire Hathaway buying more shares of Liberty Media.
Was it lower or higher? The CPI or the job numbers? Sound like they said the job numbers were good.
Voting tracking stock for about $82 million. Now holds a 20% stake in that name. And a number of top picks from the street this morning. Nike, Boeing, Occidental, and more. We're going to break them all down for you. They're all in the move, and they're all higher right now.
Yep, they're pumping it up.
They
want to turn this market around.
Hey, Rick.
This is a nice trade right here on the calls.
I'll try to go slowly here. Factory orders for November expected up around 2.5%, up 2.6%. You have to go way back. You have to go back to Jan of 21 to find a bigger number. I call that 3 years. That's pretty good. But once you strip out transportation, you can see where all the horsepower came from. It drops from 2.62 up to 0.1, which is still better than the down 0.1% we expected. And if you look at durable goods, now these are final numbers, so you're going to look for less movement. 5.4 remains at 5.4. That's the best since July of 2020, by the way. And if we look at durable good orders,
I can't see it on that.
Transportation, we can see what happens there.
Man, look at that.
Drops
150.
0.4. Once again, same dynamic. Transportation, aircraft really kicking in there. Up 0.4 isn't bad, though. That's the best level going back to May of last year. Now let's look at capital goods orders, non-defense, ex-transportation, the proxy for capital spending. It remains up 0.8, and shipments down 0.2. That's 0.1 worse than our mid-month read, which was down 0.1. Now, let's go to those ISM services. The headline index, 50.6. That is indeed a miss, 50.6. We're looking for a number to be at 52.5. That was expected, and 52.7 in the rearview mirror. Prices paid, 57.4, pretty close to expectations. Lower than 58.3 in the rearview mirror. That's a good thing. If we look at employment, which we just had that report today, of course, 43.3, that is a big miss. And of course, that goes into contraction territory. 43.3.
Okay.
Weakest since July of 2020. And finally, new orders expected to be around 56. Is a miss, but still in expansion territory at 52.8. So 3 of the 4 are in expansion. We had some disappointments, but the big disappointment seemed to have been December employment read. We see that interest rates have backed off on those data points. We moved from basically 404.
Might be a fun day today.
398 now, folks. We're under 4%. And do keep in mind that we see big jumps on the week in terms of yield, Sarah. But of course, as we dip below 4%, we're going to take some of that back to you.
And the equity market follows suit. Likes the yields moving south. Thank you, Rick. Rick Santelli With a miss there in services, may be important for the market to see, as we know that's been the hot part of the economy. But if you add that onto the jobs report, I think we should talk about it. There's a number of factors to highlight. First of all, overall headline was much better than expected. More than 200,000 jobs added in the month of December, 216,000. That was better. It closes out what was an extraordinary year of job creation. 2.7 million in total employment for 2023. I think that was better than most people expected the year to go. The strength was somewhat offset by downward revisions that we got in the prior 2 months. It left the level of payrolls in December only 145,000 above the previously reported level for November. So it takes a little bit of shine off the number, but it was still a good number. I think we should also talk about wages, because that's what the market initially reacted to in terms of that spike in yields. They came in a little bit hotter than expected. Of course, good news for Americans, maybe unsettling for the Fed, which is trying to target wages and inflation. Average hourly earnings increasing 0.4% in the month. So from last year, that's about 4.1%. It was a little bit of a step up from the 4% that we saw in November. I think that the reaction, Carl, on the street from economists is this is not a number that's going to want to make the Fed cut rates anytime soon, urgently. It plays into the let's keep rates restrictive for longer to make sure that we have some progress coming down in inflation, which we have seen, but a number like this makes you wonder if there's a risk that it sparks back up a little or stays high.
Although household survey was so weak, we got these negative revisions. We just got ISM services employment. Nick Timros of the Journal looks at the 3-month average on private sector, 115 in December. That's the lowest since basically the economy reopened in 2020. October, 44K, given all the revisions.
Yeah, there have been a lot of downward revisions lately, so it makes you wonder whether this one's going to be downwardly revised too. Also, December's always kind of seasonally and holiday. But, we're also seeing real wage growth. We're seeing wages grow above inflation, something we did not see.
Yeah.
And that's good. That bodes well for the consumer. It's something that the Fed is definitely going to be paying attention to. I think that on top of did you see the European inflation numbers overnight? Eurozone, highly anticipated. They were expected to tick up a little bit. We did get that. Headline number goes up to 2.9%. That was a little bit more than expected. Although on the plus side, core was a little bit lower. Core was 2.4%. Sorry, core was 3.4%, and that was a little bit lower than November. So that was
probably 3.6.
Yeah, so it's still above target, but people are wondering if maybe it was too aggressive to price in 190 basis points of cuts for the ECB. That's where we were last week. Now we're down to maybe 140 basis points of cuts. So it matters in that the market is trying to figure out how many cuts we're going to get next year and when those cuts are going to start. Are they going to happen in March? Those odds are definitely decreasing for the Fed after this date.
I mean, Europe's a complicated story. Germany, in particular, where retail sales fell almost 3 times the estimate, down 2.5. The construction PMI there is under 40 for the 4th month in a row. I mean, Germany's got some issues, which, of course, is not the only thing that's driving ECB policy.
No, but the economy there is in worse shape, no question about it, than it is here, which is why the market was more aggressive in terms of pricing the cuts for the ECB. But, when energy prices go up, then the headline inflation numbers go up, and that's something that the ECB has to pay attention to. For every week number, how about the consumer, the Costco numbers that were reported last night? I saw a big jump in December, both in same-store sales and in overall sales. Big jump over November. And then the only other thing I would highlight is this soundbite from the Royal Caribbean CEO. He was on with Brian Sullivan last night on Last Call's great interview. And I know that cruises are having a moment, but here's how he describes the consumer. It really stuck with me.
Well, I can tell you that the consumer is very healthy. And when we poll our customers and we look at credit card data, they're sitting on a lot of wealth, a lot of savings, and low credit card balances. And so we're very encouraged by that. But what we have seen is about a 30% increase versus 19 on onboard spend.
Very bullish. Let's talk about the economy. The jobs report coming in better than expected. Just to review, U.S. employers added 216,000 jobs in the month of December. Unemployment rate holds at 3.7%. Lael Brainerd, National Economic Council Director and former Federal Reserve Vice Chair, joins us now first on CNBC. It's great to see you, Director Brainerd. Welcome. How surprised are you by these strong numbers at this point in the cycle?
Well, I think the data that we saw this morning really confirms 2023 was a great year for the U.S. economy. The economy entered 2023 with a lot of strength in the labor market, and it carried that strength all the way through to the end of the year. So we are up 2.7 million jobs over.
I don't want to listen to you. Oh my gosh. So far I'm green in 2 trades and I just want to stop.
Productivity growth over the previous year, and inflation is actually coming down. Core inflation down to that 2% range on a 6-month basis. So that's a very good picture for American workers, the American economy.
But, you know, financial conditions have loosened a lot over the last month on hopes that the Fed is going to start cutting rates, and it does make you wonder, especially when you see mortgage rates drop and the stock market up, whether we're going to have stickier inflation or potentially another flare-up in inflation after all the progress that's been made so far. How do you assess the risk of that?
You know, I think we just got the numbers on the supply chain index, and that shows that supply chains are actually all the way back down to normal pre-pandemic conditions. So biggest drop in supply chain pressures I think that we've ever seen from very, very elevated levels. That is really what's been driving inflation, and that's why you see that core has come into the 2% range much faster than a lot of forecasters expected. So I think the picture is much better balanced than any forecaster had predicted just a year ago. We're seeing those wage gains on the back of strong productivity.
But the inflation is not in the supply chain as much, or the goods sector. Now it's in services, right? And it's in housing as well.
Yeah,
those are the sticky parts.
Yeah, so I think in terms of the core inflation numbers, we did
I'm watching
see
the
those
9 here.
come
We're getting ready to
down
squeeze
last
for another
month,
pop or
2%
drop.
on a 6-month basis. So that includes
They'll keep up this here, what they call good news. But it's good news can always turn into be bad news, like Sarah's pointing out, because they've all been about the Fed, right? That's how they've been driven, was with the Fed. They've been calling out the Fed. The Fed, okay, we dropped rates, so we're going to run the market up. Now the things are too good, in their opinion. So I think we're going to keep breaking out here. We sold off real hard. And we're getting to reach the 200 on the 1 hour.
months. But the general trend, I have to say again, below 4% unemployment every month for 23 months at a time when inflation has come down into its pre-pandemic benchmark range. Those are the kind of underlying trends that we are seeing month after month in this data.
Headline today, Maersk, one of the biggest shipping companies in the world, rerouting Red Sea ships for foreseeable future. We've seen container rates spike on this, on the back of these Houthi Yemen attacks, even with the U.S.-led coalition to try to ensure more security in the region. How threatening is this to global inflation?
So I would say this is something that our national security team is very engaged on. This is unacceptable, and they are working with a broad coalition of partners and in close contact with shippers on this. Now, as you know, some shippers are diverting. That adds days to delivery times, and it also adds to delivery costs. The U.S. is somewhat less subject to some of those because we are less reliant on those. You've seen very little effect actually on prices at the pump. Americans are seeing a gallon of gas. The median is at just a touch below $3, so down $1.90 over the course of last year. So in terms of Americans' pocketbook issues, we are still seeing very good progress on gas prices, and we're actually seeing progress at the grocery store as well. These are things that really matter to
That
Americans.
I saw last week.
Right, well, I know you must be frustrated, along with the administration, that the president.
I mean, I've been paying double for my hamburger what I usually pay, and it dropped like $10, $7 overnight. I'm going, what? So I loaded up on a hamburger. Spent $50 on hamburgers. I wanted to get, in case they spike it up on me again. I was really shocked. And then first thing popped in my head, election year.
Incredible supply shocks that we have had to navigate through, starting with the pandemic, continuing on with oil and gas prices. I mean, the president's done an incredible job of addressing supply chains. Again, this morning we saw supply chain pressures are all the way back down to pre-pandemic. They were at a record high.
CCO got an upgrade.
During these supply shocks that he has taken policies to address. And if you look at inflation, inflation follows that supply chain index.
Target $22
with a few
Wells
month
Fargo
lag.
wagon.
So really, all the work that's been done, trucking, shipping.
God, I can't stand politicians. Okay, we're going to try to find support here. Now watch this trend line I'm going to draw in here. We might get a little rebound here. Yeah, we're right at support. So look at the call. The 470 strike or the 471. Or we could drop to the VWAP. I'm going to make some coffee. I'm not going to make the same mistake I did yesterday. Goes the bounce, and we might get to the double top and we might not. You seen how I draw that support line in, right? Actually, I'm going to change it up just a little bit. We're stalling out. Okay, right about, we still got to get to that line. Now, it could be the fake out right there, so 88 cents. Let's go, baby. And then we'll look at Tesla here. Oh my. Break it. This is an exit idea if you're in this trade. We hit a trend line, but if we break it, we'll have a nice little pop. You take profit if you're in the trade.
That far?
Yeah, I'm not super excited. I've said this repeatedly. I'm a big fan of the enterprise business and what they're doing there. I've not been as excited on some of the feature sets that they're adding around this area. So we'll see. But I think ultimately Microsoft is
Apple's flagging out.
Reinvigorate Windows. They're trying to effectively get everyone to stick around on that platform, and I think maybe this will be a good helper, but I'm not as excited. Some have called it, remember the Clippy paper clip when you ask questions, and everyone just wanted to deactivate Clippy and shelve them.
It's gonna move.
So we don't know yet, but again, I think across the products that we've seen, we're encouraged by the progress they're making on broader enterprise AI, which will be a big driver.
Martin, what's the case for Apple over Microsoft?
I was just looking at Apple, baby.
The case for Apple is we believe 2024 will be the first year we see mass adoption of consumer on-device AI.
and then Apple will be the single source of trust for a lot of currently what perceived as a very fragmented consumer-facing AI apps.
What about on the, yeah, I mean, what do we know about the AI apps or the AI story for Apple? It seems much clearer for Microsoft as Brent laid out.
Yeah, I think there are twofold stories. Number one is we're already seeing implementation of
110.
large language models for a correction of the inputs on iPhone starting from
We got a
iPhone
higher low here in the
17.
pattern.
And over time, I think, especially for this year in June by WWDC, we'll see likely to see more enhanced AI functions that enhance photos, and then there are journal and personal
112 spy.
that'll be assisted by
Another
large
$100
language models run on the device. And the second layer will be, running other apps that use on-device machine learning functions provided by Apple that will open to a much wider third-party developer ecosystem.
Pretty interesting. Both names have given us a lot to talk about with the flip of the calendar. I look forward to chatting with you guys in the coming weeks. Thanks, Brent and Martin.
Thank you.
As we had to break, check out the biggest gainers on the S&P to start the year for the week. Again, the S&P itself is down about 1.4% for the week. Moderna,
Wow, Moderna.
one of the biggest losers in 2023. Also, some other healthcare names on there like Merck and other laggards of last year at the top of the list. Verizon on there too. More on some of the market movers, plus this little bit of a buying we're seeing here. Post services coming in weak. NASDAQ up 0.6%. All the sectors go positive in the S&P. We're back in a moment.
Sit them. If you can't stand politicians, sit them. I was in student government. With Delta Epsilon Chi. I was a politician once, and I ordered all women not to wear bras. And I got lashed for it. They did not like that. And I ordered all men to have their penis cut off. There's a lot of good buys coming right in here on this dip on the SPY. So I'm going to still look. I'm back here at the 471 again. Apple. Beautiful little flag here. We're going to squeeze probably another bit. We're holding above the VWAP as of now. But that 471 strike was just at 91 and I didn't pull the trigger. Well, I thought about running for Congress. I'll probably get assassinated the first week I was in. I think you guys want me to be around a while, so I'll decline. Especially here in Missouri with all these crackheads. Ain't that what we're calling? Ain't that what Missouri's called? The state of crackheads?
Years from now, the world will be using more oil and gas than it is today.
More, not in 5 years, more.
5 years from now, we'll be using more than it is today. We meet demand. We don't control demand, we supply demand. And so we will.
This is Chevron CEO.
Over the next 5 years, we'll also grow our lower carbon energy businesses. We'll grow renewable fuels. We'll grow our hydrogen business, and we'll grow our carbon capture business. So we need to reduce the emissions from traditional energy, which we're doing, reducing our carbon intensity of oil and gas that we produce today, at the same time as we invest in new technologies to grow new sources of supply as demand for all forms of energy continues to grow.
That was Chevron CEO Mike Wirth last night on Last Call explaining his bull case for the business as energy stocks go from laggards to leaders this week. That's been a theme for stocks as we kick off 2024. Let's get to Dom Chu with more on what's moving. Hi, Dom.
It's still, Sarah, really kind of early in the new trading year, but there are those three sectors that are off to that better than expected relative start here. You've got healthcare, utilities, and as you point out, Sarah, energy. Each of those is up at least about 1.5% to almost 2% here, just again in the first few days of 2024, but it's still an outperformer. Now, within that energy trade today, the traders are watching three of the bigger names, including ExxonMobil, Chevron, and Occidental Petroleum. Each of those stocks is being tagged as a top pick by analysts over at Bank of America. They cited, amongst other things, positive momentum for growing cash flows and risk-adjusted values at current levels. Separately, also, ExxonMobil said it would take a...
These guys, they get me. They were downgrading oil last week. Now, all of a sudden, me and Mike, you know, there's an issue here in the Red Sea. There's an issue here with supply and demand if we keep escalating with Iran. There's a lot more oil going to be used because they can't ship through that channel, so they got to go around it. And then you hear that America is the #1 producer in oil right now. Again, you know, we were lied to.
What it may mean for some potential rate cuts ahead when we're back in a couple of minutes.
But Oxy's not moving. If it got an upgrade, we got a 1, 2, 3 starting out today. The 9 maybe might cross the 21. Let's go to the 5-minute. We got 3 black crows. Rolling pin with a weak candle right there. Buffett's average price is around 56 something, 57, and he's got 27% stake in this stock. Occidental Petroleum to neutral announces 63 price target. Mizuho. No. That's the AI watch list from Tasty Trades. Snow is on there. I haven't looked at snow and we're going to get some snow, so this might be a good trade. Oh, shoot. Yeah, it hit my support level. I haven't looked at this in a long time. Since I called the bottom down here. That's a good looking chart. That is one sexy chart right there.
Welcome back to Squawk on the Street. I'm Bertha Coombs with your
FSR.
CBC update. The FDA just gave Florida the green light to import drugs from Canada, where medicine is less expensive. Regulators also said they were committed to working with other states to make similar approvals, despite fierce opposition from U.S. pharmaceutical companies. Florida officials have estimated that the savings in the first year alone could add up to $150 million. Former Paralympic standout Oscar Pistorius is out of prison nearly 10 years after he shot and killed his girlfriend at his home in South Africa.
Why is this in the
Pistorius
news?
has maintained that he mistook her for an intruder.
I remember that.
The board approved him for release back in November. Prison officials say he will be under constant monitoring until December
I'm a fucking
2029.
idiot.
And the United Nations says global food prices fell in 2023 from the previous year's record highs. According to the UN, international prices for commonly traded food commodities fell nearly 14%, with only the prices of sugar and
I haven't bought a head of lettuce in almost 2 years. And I went into the store the other day and it was at $2.50. And I said, yeah, I'm going to grab me 20 heads. I mean, for 2 years it was at $5 a frickin' head.
These numbers in context. Steve, good morning.
Sarah, yeah, this stronger than expected job report, I think, offers markets a lesson in what the Fed has been trying to communicate. Improvement on the inflation front and the slowing of the economy are not going to be a straight line. But beneath the hood, there's actually some slowing, I think, is worth noting. I want to look at the 3-month average for total and private payrolls. The current total number is up 165,000 over the past 3 months, but that's down from 334,000 a year ago in January 2023. Private sector also, more importantly, 115,000, down from 221,000, more than half of the number from last year. Private sector gaining just 164, but that's because government's up 52,000. Government is trying to recap or recoup the employment levels it had from before the pandemic. It's just barely reached it now, but that doesn't account for any growth in the economy. There's leisure and hospitality doing well as it's done, along with healthcare. That's just going to do well no matter what's going on in the economy. But transportation and warehousing and temporary help, perhaps that last one, a leading indicator, also softening and softening now for several months. Construction and retail both up 17,000. Wage growth was a tenth higher. Work week was down, and worth noting, by the way, the ADP.
Okay, I'm going to get out of these spy calls.
Bigger data set, like 10 million.
We got an
It is
ascending
showing
triangle
consistent
here.
Cooling. Other cooling signs, yeah, the ISM service sector came in. The top line was below expectations, and the price and employment indices both fell. All this data creating tons of volatility in the outlook for the Fed. Take a look here. Before the jobs number, you had a 65% probability of a March cut. After the jobs number went down at least as low as 57, maybe lower than that. And now post those ISM services numbers back up. We're now pretty darn confident it's going to happen in March again. On balance, what you have, economic and job strength, it should make the Fed less likely to cut. I got a lot of commentary that says these are not the kind of numbers that the Fed is going to cut with. But there's 2 more jobs report before the March meeting, 3 more inflation reports. All that's going to be the most important to figure out what the Fed does. The best hope here, guys, is for the market is that the 2023 trend continues. Good job growth, and yet surprisingly, that falling inflation. I just want to say, Sarah and Carl, you guys are having
Out of the
entirely
SPY
too
at
much fun
110. Although this is a bullish pattern here.
We're just getting started.
We're getting ready to
Steve
squeeze.
Leishman this morning. In fact, speaking of which, let's get some reaction from the street today. Goldman Sachs chief economist, head of global investment research, Jan Hatzius, is here in Post 9.
Here for the party.
Yes, Jan, it's great to have you.
I definitely want to participate.
Are you, well, great call at 190. We were not far from the actual print. Are you leaning toward the softer elements of this or the nice print itself?
Probably more the softer elements. I mean, I think it was a little bit more mixed than the unemployment rate and the headline payroll number suggested.
I like this
with
guy's
some
accent.
of the factors that Steve just walked through, and also the ISM on the softer side. So I think it's a bit weaker. So I don't think it's necessarily
I gotta remember
a
this.
roadblock to cuts from the Fed relatively soon.
Fro-
But the main driver of cuts
The
from the
line-
Fed in our
the line.
forecast is weak inflation. The inflation numbers have been very soft, and if that doesn't unwind, then I think we'll be at a point before too
Unwind.
long, maybe by the March meeting, where they say inflation is now sufficiently close to 2% that we should start to reduce rates.
That said, you have not been seduced by all the talk of March cuts or June cuts, right?
We do have a March cut in the forecast.
You do?
Yes,
Okay.
we do, basically because Chair Powell said at the press conference in December that they want to get moving.
Has anybody in here been seduced by the Fed cuts? I hope not. That's kind of kinky.
By the end of the first quarter. And I think in that sort of environment, with more
Media
deceleration
pumping.
expected, what they have said is consistent with cutting, at least gradually.
But the other thing that the job report showed today on is
Exactly.
that we're really seeing some
Yoko
real
has it right.
some real wage growth, which I know has been part of your soft landing scenario. But now that wages are rising faster
I'm in
than
agree with you.
inflation, that bodes very well for consumption, which also might make it harder for inflation to come down.
Well, we certainly agree that the economy is pretty solid, and
Man, she's a
strong real
cutie.
income growth is an important part of that, but it has not stood in the way of very significant disinflation in the United States and really across the world. And we think
Tesla
that
had a
will
nice
continue
little
to be the
bounce
case. There will be additional disinflation
off Jimmy's
And
support
as
level.
there is disinflation, even in a healthy growth environment, I think the Fed's likely to say
Today's the scalping day.
for the fund.
Jimmy waited for this support level. I was asked many a times about, and I said 234. 234. 234.11. We hit 234.84. 87. Hey. We're getting ready to squeeze again. Any second, we're going to pop or drop. Should have grabbed that one there. That would have been a nice trade. 92 to 110 again. So we break this resistance. We have a double top resistance. And if that breaks, I'll get back in the call. If not, I'll get in the put. 470.18. It's send, ready, set, go. I like the way that guy talked. I like to know where he was from. Through November elections, yep. Pump the market up. Now, I nailed it when they thought that Hillary was going to win the election. Does anybody remember watching the market after that happened? Wall Street was very disappointed that Trump was elected. It was the funniest thing I ever seen. She was supposed to win by 99.9%, because it was all rigged and it didn't turn out that way. And all Wall Street was all braced for the big run up. And it ran ahead of time, and then when she lost, boom. I kind of really want to. And the same thing happened when Bill Clinton got reelected. He listened to the polls, and the polls said, you know, you're not bringing the country in the right direction. So he started thinking like a GOP, and man, we had one of the best runs ever. He did, what did he do? He did welfare reform. And that was a very tough thing for him, for a Democrat to do.
Mega cap stocks suffering a sharp drop to start 2024, with AI darling Nvidia down 3% this week so far. But that said, it's not stopping the street from naming it a top pick. Our next guest forecasting $100 billion in free cash flow for the chip stock by 2025. 45% upside from here. Joining us now is Bank of America Senior.
They're bringing in that idiot again. Last week it was going to go to 1,000. They've lowered it.
On Nvidia, is if
650 is my target.
Be a point in the near future where they reach sort of peak growth when it comes to this big AI leap that they're taking.
Yeah, good morning, Sarah. The point we made in our note is that the free cash flow generation, which, to be sure is 24 plus 25 combined based on our projections, is just the cherry.
They were right at resistance.
A very delicious cake. So what are the layers of that cake? Number one, we think generative AI is still in very early stages. These cycles don't just start and end in 1 year. These can be decade-long cycles. And there is at least 3 to 4 years of upfront hardware deployment, and we are just in year 2. So number one, generative AI is still in very early stages. Number two, NVIDIA's competitive position is exceptionally strong, all the way from chips to systems to software. Number three, towards the end of the year, there is a new pipeline that they have with the B100 and Grace Hopper and other products, which will have much higher ASPs. So I think that promises more growth in 25. And then top of all that, they're able to generate very strong free cash flows. And that's really the key point made in our research, that if I look at the free cash flow generation between this and next year, it could be close to 100 billion. That leaves 60 to 70 billion dollars of ammunition for NVIDIA to go and look at inorganic opportunities, right? Because NVIDIA is a very strong company from a hardware growth perspective, but generally hardware companies are not awarded the same multiples as software companies with recurring revenue engagements with their customers. And that, I think, is the opportunity that is not being recognized, that the cash flow that NVIDIA can generate can help them look outside at engaging and partnering, or even
Mike, we're at resistance. You think we're going to go higher?
That are adjacent to their AI business,
NVIDIA?
And really take them to the next level.
Or are we going to pull back here?
And get the price to earnings multiple that the stock deserves for this kind of very strong growth rates.
Although it's interesting, you guys have also done some work on the software side where you are raising the possibility that AI-driven revenue might fall below expectations over the next 5 years. And I'm wondering if those concerns migrate into things like hardware.
Carl, I think it is possible that, look, we are in early stages of what is a brand new technology. Not every thing has been sorted out. There is a lot of process of discovery that is ahead. But you have to realize that technology is its own growth driver, right? In that the cheaper and more accessible you can make technology, the adoption of that technology. And that's an important role that NVIDIA can play because they are very well aligned with the cloud providers, but they're also well aligned with the enterprise customers. And enterprise AI adoption is really the next leg of growth. But what enterprises require is a way to make this technology more accessible, right, easier to use. And that's where we think NVIDIA's broad range of partnerships, right, their ability to deploy this technology on premise, and their ability to then go and partner and potentially conduct M&A can help provide a greater level of engagement with the enterprise. So that's why I think it's in some ways a little too early to forecast where this technology could be 4 or 5 years from now, because we are in early stages, and I think NVIDIA has the opportunity to drive much broader adoption than what I think consensus is projecting right now.
All right, Vivek, thank you for coming on and stating the case. Appreciate it.
Thank you.
Still ahead this morning, a pretty volatile ride for crypto investors as this SEC ETF deadline nears. Can Bitcoin hold on to its gains? Until then, we'll talk about it when Squawk on the Street is back in a moment.
SPY wants to break too. Just kind of hinging on this little bitty resistance here. We did try to pull back, but it said no. I'm gonna go turn on my water.
Checking in on the markets as we close out the hour, we've continued to push higher here, especially in the wake of that data we got at the top of the 10 a.m., which showed ISM services a little bit weaker than expected. So treasuries rally, although they were already rallying a little bit off the initial reaction to the jobs report. Now we've got a broad-based rally. Bob Bassani here to break down the action, as well as what's going on with Bitcoin. Bob, good morning. What are you watching?
Good morning. Good morning, Sarah. Yeah, you're absolutely right. The ISM service is weaker than expected. S&P futures moved up 20 points. Remember, we want slightly weaker, but not really weak data. That's helping. It's been a rough start, though, to the 2024. I mean, some big sectors are down here. Just take a look here. Kathy Wood's ARC, which was a big speculative tech sector, had a huge year last year. It's been down 6% this week. The Russell 2000, great November, December, been down. NASDAQ 100. There's mainstream tech down 2.5%. The only thing that's up is defensive stuff, healthcare, utilities, and consumer staples. So We had a rise in yields this week. It looks like some people are questioning whether the Fed really is going to cut 5 or 6 times next year. That's, I think, healthy. So we're working off some overbought conditions. I'm not terribly worried yet. Hey, speaking of Kathy Woods and ARK, and we are finally hopeful we'll get some ruling on the Bitcoin ETFs. This has been 10 years. We've been waiting for them to do something here. The important thing is there are 13 companies that have filed for a Bitcoin ETF, including Kathy Woods. She's first in line. They're supposed to give her a thumbs up or no next week here. There's a wide range of fees here, and it's a rather complicated approval process. Let me run it through you real quickly here. Basically, this is a new thing. We've never had a spot Bitcoin ETF before. So there's 2 steps here. There's what's called a 19B4 filing, where the exchanges have to file with the SEC how they're actually going to do the trading. So NYSE, NASDAQ, SIBO is involved in negotiations about how this product is actually going to work. That's the first thing. And then we have the normal S1 filing. Everybody with a new security has to file an S1. It describes what's the security, how does it work, who's in it, who's running it. That's normal. So this is a 2-track process. We don't know how it's going to work. The industry is hoping that they will approve the 19B4 filings and the S1s all at the same time. Now, we don't know if that's going to happen or not. They may approve the 19B4 and only approve some of the S1s, saying they don't like the application process. We just don't know. We're expecting something maybe as early as this weekend, but likely Monday or Tuesday here. The important thing is, remember, guys, they've got all sorts of games going on here still with the SEC and legal issues. Here's the fee structure. A lot of people are interested in this because, look, people are going to put a lot of money into this. So ARC 21's going to try 80 basis points, Fidelity's 39. We have Invesco in a different fee structure here, 0.59. They're going to waive that for the initial 6 months and the first $5 billion in assets. So there's going to be a lot of competition for the Bitcoin dollars here. As for Bitcoin itself, you saw the minute that we had an announcement there from BlackRock, it rocketed up at the end of last year. So 30 to 40,000. And guys, I guess the question is this a lot of pull forward? Just like you get companies going to the S&P 500 that get pulled forward. Look at that Bitcoin price, pulled forward in anticipation that this is going to be happening. Guys, we'll have Kathy Wood on Monday, 12:35 on Halftime
Kathy.
And on ETF Edge at 1:10 p.m. Get an interesting little discussion with her on Monday.
Good stuff, Bob. Thank you, Bob Bassani this morning.
Now, Mara might be at my support level here.
Street this morning. Money Mover starts after this break.
No. Now, we had opportunity the other day when it was almost hit 20. I'm going to wait. We got the QQQ at a triple top on the intraday. We've got a bullish flag on the SPX. And we're squeezing still. I mean, we've been squeezing for a while in the SPY. And we are now at my lunch break at 10 o'clock where things start to kind of pan out a little bit. So let's see if we get a pullback. If we get a breakout, we might have a continuation run. We've really got to watch banks next week. They're leading the trade, leading out with earnings. How's everybody on YouTube doing? Anybody stuck in a trade or need any help in a trade right now, or has any kind of idea what they want to do or something they want to get in? I'm eager to say we've had a nice flush. 4 days. I mean, they said 2 days, and I'm going, it's been longer than 2 days. Oh my. Peloton, Sophie. Is Sophie on here?
.com.
Good Friday morning. Look at Money Movers. I'm Carl Quintanilla with Sarah Eisen live on the floor of the New York Stock Exchange. Today, J.P. Morgan's chief U.S. economist reacts to this morning's stronger than expected jobs number. Does it officially take a March rate cut off the table?
Plus, the largest producer of natural gas in the U.S., the CEO of EQT, is with us. How's the conflict in the Red Sea impacting business? Nat gas down more than 4% here in early trade.
And despite the strong jobs print, some companies are still struggling to fill openings. We're going to take a look at how one industry is turning to high school labor to fill that void. First of all, look at the markets topping the tape for us today. A bit of a seesaw between the jobs number and then this reaction out of ISM, where we got the employment index in the 40s, which took some of the pressure off of yields. They reverse course. Market hangs on to gains. Let's bring in CNBC Markets senior markets commentator Mike Santoli. Mike, I think one put it, choose your own adventure kind of jobs day.
To a degree, and maybe if you blend them together, you have something that nets out toward, yep, we're moderating, we're slowing. Maybe the soft landing scenario, still you can check off the box, we're on pace for it, but you need constant replenishment of confidence that we're on track for it. I don't think the March rate cut is the make or break thing, but the Fed being in a position to cut, if necessary, if inflation cooperates, I think that's part of the premise. 1 year ago today, 3,900 or so on the S&P 500. You started to have Fed funds futures price in cuts at the end of last year. And there was a big talk of, oh, the Fed says they're not done tightening and all. And we didn't get the cuts because the economy did better. And the S&P ended up at 47 and change.
I feel like the market has to choose between which is worse, right?
Yeah.
Weaker economic data.
The market has to
stronger
choose.
economic data, where the Fed doesn't cut as much.
I think
I wish I could understand what they're trying to say when they say that.
Economic data, because the other part of it is it's more of a temporary. We can alleviate
that weaker services number today.
When it came as a counter.
They were wrong for 2
I also would point out that the
years about the market. And they're still saying it.
I mean,
because it's
slicing
that
it
weakness
pretty
in
fine.
the jobs numbers.
Sure, we're slicing it pretty fine here. I still don't think 4% 10-year Treasury. Investment grade corporate bonds went from 6.4 down to 5.2. It does make things a little more accommodating for the market. We're a couple percent off the highs in the S&P. I don't think anything much has happened here that changes the overall story, except that we kind of went a little nuts at the end of last year, and we've retraced everything back to the moment of the Fed meeting in December. S&P went back there, 10-year Treasury went back there.
Right. Not the only thing going on, though. There's the risk of a more regional war, wider war in the Middle East. China's recovery still not happening. Bull bear B of A today, still elevated levels of sentiment, right?
Yes, elevated, but it's interesting because it feels as if it's kind of a shallow reservoir of bullishness. If you look at the put-call ratios in the last few days, they picked up. Money market flow is really heavy in the latest week, so it's not like people have sustainably chased this rally. So we had definitely over-optimism to have to cool off at the end of last year, and the process is underway. Also, sell-side strategists, in aggregate, are expecting almost no upside at the median. So to me, it says, yep, we got a little ahead of ourselves at the end of last year. We'll see if this remains an orderly routine pullback or something more.
All right, Mike, we're talking a bit. Thanks. I'm Mike Santoli. Following the jobs number today, this is what NEC Director Lil Brainerd told us last hour.
Economy entered 2023 with a lot of strength in the labor market, and it carried that strength all the way through to the end of the year. So we are up 2.7 million jobs over the course of 2023, more than the best year of the previous administration, and that took place at a time where the unemployment rate was consistently below 4% throughout the year, and inflation, core inflation, came down close to that pre-pandemic benchmark of 2% over 6-month basis. So that's a really very healthy economic picture.
What does it all mean for the Fed moving forward? Let's bring in J.P. Morgan's chief U.S. economist, Michael Feroli. Michael, always a pleasure. Our thanks to you. Good to see you.
Good to see you.
Is it fair to say that the print reduces expectations for at least a Q1 cut?
I think so. Certainly, I think to get to Q1, you'd really have to have kind of a panic situation or a steep downturn in economic activity. It doesn't appear that that's a near-term prospect. So I do think this takes Q1. Should, well, barring any big surprise over the next 2 months, I think this really should reduce the odds of that kind of thing.
Can you bundle household survey, negative revisions, ISM services employment, temp jobs down into a more pernicious narrative?
You can if you're inclined to. I think if you take the average over the fourth quarter, what you see is both job growth and wage growth in the fourth quarter was the slowest in the expansion, but still pretty good. As you mentioned, there are some indicators that we'll probably see further slowing in job growth in the months ahead. Whether that actually turns into a negative number yet to be seen, but I don't think that doesn't look like a prospect for January or February at least.
Your counterpart over at Goldman Sachs, Jan Hatzius, was with us a few minutes ago, and he sees a March cut because he says core inflation is powerfully coming down, and that's what the Fed is going to want to see, and it's going to be enough for them to cut and not be so restrictive. Why do you disagree?
So I do think they're in a position to eventually cut. I don't think what we heard out of the minutes earlier this week suggests that that's something they have a plan for as soon as March. I think given the wage number we saw today, they probably want to be a little more comfortable that labor costs are moderating in a more significant way before I think they're comfortable to declare victory, which I think a cut is essentially declaring victory given their well-known reversal aversion. I think they want to be pretty confident that when they start, they're going to keep going.
What is happening on the wage front? Because we got a little bit of a tick higher, 4.1% now growth in December. We're seeing real wages really start to move up, which is good for consumption. Where do you think that goes?
So as I mentioned at the outset, if you look at the quarterly average, it's 3.7% annualized, which is the softest since 2020, but it's still a good number and probably a little bit above what you would want to see to be comfortable that inflation is on a path to 2%. So, as you mentioned, this month we were a little higher than expected at 0.4. There's a lot of revisions to these numbers. That's why I kind of prefer to focus on the quarterly numbers. And as I said, those are moderating, albeit still probably a little bit too hot for the Fed just yet.
So what do you think the path of cuts looks like this year?
We have them starting in June, and then cutting once per meeting, every meeting thereafter for the remainder of the year.
Wasn't ready. I probably took that.
Pretty comfortable with that after this morning's number. Certainly, it doesn't feel like, as I said, January or March looks particularly likely. Whether they could go in May, that's a possibility. But I think June, feel pretty comfortable with that right now.
Help us understand, Michael, what's on the line for CPI next week, and whether or not some of these international jitters are going to move sort of supply chain thinking in the weeks or months ahead.
Yeah, so we're probably looking for 2 or 3 tenths on the core number for next week. I would say the one of the concerns here is that a lot of the improvement we have seen in the last 6 months, which Lael Brainerd mentioned, has been due to softening in goods prices, and that a lot of that reflects the improvements we've seen in supply chain performance. If some of these international tensions cause disruptions in shipping and so forth, we could see a reversal in that. We haven't seen it just yet, certainly in most of the measures we're looking at, including some of the supplier delivery numbers that we saw this week. But it does remain a risk, and again, one reason why we might not want to jump on or take a victory lap here on inflation just yet.
Right. Although we've spent a fair amount of the morning talking about the nice position for the moment that the U.S. consumer is in, given wages versus inflation, and I imagine you're probably, I don't know, to what degree is disposable income a focus for you right now?
So it looks good, right? So after this morning's number, it looks like in the fourth quarter, nominal incomes are growing, nominal labor income is growing around 4.5%. Against 2% core inflation, you have real income growing at around 2.5% last quarter. That should support pretty good consumer spending even without any movement in the saving rate. So right now the picture on the consumer we think looks pretty good. balance sheets look good. We don't see a lot of problems, broadly speaking, in consumer credit. So I think the picture for the consumer looks, you know, pretty well supported right now.
I know the consumer matters most, but what about manufacturing, which does continue to point to weaker numbers? Transportation was a job loser this month.
Yeah.
How deep does that pain go, and can the overall economy withstand it?
Yeah, so manufacturing has basically been going sideways for much of the past year. Surveys have looked terrible, much worse than the actual production figures. Now, if we do get the rate cuts that people are anticipating, I think that should help demand for durables, things like autos, which have been generally pretty depressed, though had a good month last month. Should also help housing, and housing, when you see demand there pick up, that should help the manufacturing sector more broadly. And finally, capital spending has been, you know, generally kind of lackluster given the high rate environment. If that, again, moderates some here, I think you actually do have a path for a little bit better outcomes for manufacturing activity this year.
Well, at least the news flow is going to pick up next week, including some bank earnings from some well-known banks a week from today. Michael, good to see you. Thanks.
Good to see you.
Michael Ferrelli.
From Wall Street to Washington, where the government is preparing for the potential of a partial government shutdown in the coming weeks. Emily Wilkins in D.C. with more. So what is the state of negotiations, Emily?
Sarah, the negotiations are happening, but at this point, it's not looking good, because despite all the work that Congress has done on the spending bills over the last several months, they still don't have the most important component, the overall amount that they will spend for this fiscal year. Now, House Speaker Mike Johnson, Senate Majority Leader Chuck Schumer, they've been continuing to talk about what that top-line number needs to be. But if they can't reach an agreement soon, 20% of government funding will lapse on January 19th. Now, this includes bills covering the Departments of Agriculture, Energy, Veterans Affairs, and Transportation. It also includes military construction, the FDA, and housing and urban development. So a really wide swath of the government here. And it could mean fewer air traffic controllers, reduced food inspections, and delays in grants for farmers. Now, although Speaker Johnson has vowed to have no more short-term stopgap bills, Tennessee Republican Chuck Fleischman, one of the House's top appropriators, told me that it could still be a potential option.
We could see the potential, if the parties are close, for the olive branch of a continuing resolution, maybe from the 19th to the 2nd, as a stopgap or something like that. That's not beyond the pale of reason.
Johnson is also looking to negotiate with the White House on potential overall spending levels. And of course, if they do figure out the January 19th deadline, they then still have to figure out the February 2nd deadline to deal with the rest of government funding. Back to you guys.
Emily, I know Kevin Brady was on Squawk yesterday. He did say that it's not like there's been no activity. There have been some spending bills passed on the House and the Senate side, not to discount the difficulty in reaching a further agreement, but would you argue there's been some traction?
I mean, the problem with that is that you're absolutely right. There have been, but they're not the same bills. And of course, the House and Senate need to pass the same bill for that to actually get to Biden's desk and get signed into law. And part of the reason that they have been different is because the House and Senate are working with different top-line overall spending numbers. So that's why this has really been a really important point in the debate, a really critical thing for them to get done. Only when they get the top-line spending numbers can you really begin to make sure that the House bill and the Senate bill are reconciled so they can pass through both chambers and get to Biden's desk in time.
One more thing to worry about. Thank you, Emily. Emily Wilkins. Appreciate it. Up next, the largest natural gas producer in the United States, CEO of EQT, with us ahead of the cold front that's expected to hit the East Coast this weekend. And we'll ask him about the conflict in the Red Sea and what impact it could have on prices.
Plus, Bank of America naming its top energy picks for 24. Chevron's among them. We'll get the full list when Money Movers continues.
want to go long in this PLTR so bad. We're definitely at my nailed support level. We broke the anchor. Oh, is that the anchor? No, it's 9. There's the anchor. McDonald's. Probably ain't going to be selling any Pepsi. Coins flagging out. But it's still a nice run. Boeing flagging out. Home Depot squeezing, they're all squeezing. That's the anchor VWAP.
%50 off. Welcome back. B of A naming its top energy picks for 2024. The firm predicting that it will be another challenging year for energy investors with expectations that oil will remain volatile. Oxy, Exxon, Chevron are their top ideas. They say all three represent some of the greatest absolute upside in the sector this year while avoiding exposure through outsized commodity volatility. We'll see. It's been a tough space.
Well, we'll stick with energy and take a look at natural gas. A warmer than expected, warmer than average start to the winter has been weighing on prices over the last couple months. But could the cold front we're expecting this weekend across the Northeast kickstart a turnaround? Our next guest runs one of the biggest natural gas producers in the world and joins us with his outlook. EQT CEO Toby Rice joins us. Toby, good to see you again. Welcome.
Hey, thanks, Sarah.
What do you expect for prices this year?
Well, we've seen a dramatic move down. Really what started in the beginning of this winter. We entered the winter season with storage levels about 5% above.
No, man. Oh, nasty woman on here.
Too concerned about. But since the beginning of this winter, we've seen prices go
Oh my gosh, sure it is.
Production levels have
I
been
knew it.
higher. As you mentioned, the weather has not just been below average. We've had one of the warmest winters since 1950 in December. But that's looking to turn around. We think, as you mentioned, we've got some cold weather coming in here in America and also in Europe, and that should get us a little bit more constructive on gas prices. Then on the production side of things, you're going to see activity levels respond to these low prices.
Spy.
And I think the point for people to understand is we look at the marginal cost of production in the United States for natural gas requires around a $3.50 price to hold production levels flat. Prices lower than that should lead prices to being to lead to lower activity cuts, which should balance the supply-demand fundamentals.
So lower production this year. What are you thinking, and what does it mean for your own business?
So
Sarah, that's kind of a personal question.
But rig counts have dropped 20% over the last 12 months, and as we're looking at the tape right now, Cal 24 pricing being around 275, 280, well below the cost of supply for the marginal producer. So we do think that you'll see activity reductions coming. We've seen it, indication from some of the private operators, and as we're going through budget season right now, you'll see from the public's activity levels, that should be more moderated to reflect the current commodity price that we're looking at in this year. But, you know, a lot of people are looking at the constructive setup we have, you know, a little bit longer term for natural gas with the build out of LNG. And there's lots of things to get excited about looking longer term for natural gas.
Pretty interesting milestone this week, Toby, as the U.S. overtook Australia and Qatar as the #1 exporter of LNG. I wonder how big that spread could get, do you think?
We're certainly excited about what we've done to date, but you know, we certainly celebrate that. But let's understand what our potential is. And in this country, we have the resource, the workforce, and the potential to quadruple our LNG exports.
I'm looking at the BWAP here.
Today, to over
Got an RSI crossover.
That is our potential, and that's really where we really start celebrating is how close to our potential.
471 strike.
And the world certainly needs it. You know, to replace foreign coal, which is the biggest source of emissions on this planet, would require an additional
At 81 cents.
of natural gas production somewhere in the world. And if we care about energy poverty and eliminating that, to give people more modern fuels and improve their quality lives, getting them off the wood and dung that's being used in this world as a primary source of energy would require an additional 130 BCF a day. So there's tremendous market opportunity for natural gas to play a more significant role in providing energy security to the world and providing a cleaner environment.
So what do we need on that front? Better regulation? Do you see that happening?
It's real simple. We just need to let the markets work. You know, I think one of the things you're seeing, you know, when you're scratching your head, we have such an obvious solution to eliminate some of the major
It's real
problems
simple,
in
he
this
says.
world. Why isn't the market solving this problem? And the reality is simple. Political forces have overridden market forces, and there's no truer sense of that when you're talking about energy. But if we take a step back, understand what we've learned over the past 5 years, natural gas is the solution. And let's allow these solutions to get on the playing field and let the markets work. We can do some really amazing things. And as you mentioned, it is going to take a little bit of regulation. Really, the lack of
They say the market predicts everything, but they don't want to let the market do the work.
So anything we can do to get
They'd rather have the government
infrastructure built is the key to letting these markets work.
guide their way.
Can you point your finger directly at the Biden administration on that?
Well, this is a really big issue, but I think we need to look at some of the things that have actually taken place. I mean, pipelines have not just been canceled under the Biden administration. This is something that's been happening for a very long period of time. Ever since around 2017, we've seen a wave of pipeline cancellations. So this is not, I'd say, affiliated with one party, but you know, I think we need to take a more practical approach. And understand what we've done in the past towards energy has not worked. Energy emissions are still skyrocketing in this world. Energy poverty is growing. There's more people this year that are living without access to electricity. That's never happened in the past 20 years.
Yes.
So let's take a step back. Let's look at what works. Natural gas is the key to lowering emissions in the United States. With our LNG, we're able to lower emissions on the global stage. And as you've seen, the energy security that we provided to Europe, we can do that on a bigger scale. So I think it's a good opportunity for us to step back and really lean
Who
on
is this guy?
the winners, and that is natural gas.
I love this guy.
You were big on that. You were at COP28. We talked to you after that about
EQT.
how natural gas is part of that transformation. Before we let you go, Toby, did want to ask about the Red Sea attacks by the Houthi rebels and whether there's any impact you see on the gas market and transportation.
Yeah, Sarah, I think one of the key points that we talk about American LNG and the reliability of American LNG. You know, there's a lot of places that can deliver LNG, but none of it will be as secure as American LNG because American LNG is backed by our military, can help prevent some of these disruptions to shipping that we've seen. So another thing to consider when getting your energy security from the United States, American LNG is going to be the most secure.
All right, Toby. Thanks for joining us. Appreciate the insight. Toby Rice, EQT.
When Money Movers comes back, I'll look at the tactics some industries are taking to fill voids in their labor force. Kate Rogers is in Half Moon Bay, California with more on that. Morning, Kate.
Good morning, Carl. The construction industry added 17,000 jobs last month, but there is a shortage of talent in the pipeline. We'll tell you much more coming up after the break.
FITB is a bank. It's too high. Come on, SPY, run. McDonald's and Walmart. Walmart's pulled back to my support channel. I've got Walmart on watch. Definitely at a support level, but I don't know. Macy's, Target. Macy's up a little bit. Target bounced off the 200 yesterday and today on the 1 hour. I'm trying to scalp the SPY off the VWAP. I don't know if it's going to work. Could go ahead and have another big sell-off. Where's the 5 minute? I'm missing my 21. 21 crosses the 9 crosses the 21 for a buy signal. This is an old strategy I used to trade with years ago. Congressman Steve Cohen tells DEA to reschedule marijuana as swiftly as possible, says, I urge you, is the strongest possible way to follow through on the HH recommendations to move cannabis to a Schedule 3.
Through the next few months with a multi-year margin story still intact. Price target 134. Barclays sees a wholesale recovery ahead, better margins, the company leaning into innovation, target 142. And finally, UBS argues Nike has the best growth outlook and that has yet to be priced in, target at 138. A lot of those looking past some of the structural challenges that others point to, Sarah, regarding China and so forth.
Yeah, I mean,
Target, they mentioned Target right after I did.
By analysts that clearly they stepped out in front of the big post-earnings sell-off when Nike warned about the overall macro environment, because that's all Nike did. It warned about softer consumer spending, but said that they're going to ratchet up their.
Then they're talking about Nike, they're talking about all the wokey.
Investors, or analysts, I should say, clearly paying heed to that. Let's hit European markets. They are lower this morning after a choppy week. The British FTSE, German DAX, French CAC, all posting losses in this holiday-shortened trading week. Retail the big drag this morning as German retail sales come in well below expectations for November, falling 2.5% month over month. On top of that, we got the Eurozone CPI, rising 2.9% in December, and that was a little bit up from the 2.4% in November. Food, alcohol, tobacco, they made the largest upward contribution to prices while the fall in energy prices moderated. The data will, of course, add to the debate over the trajectory of the ECB's next move, with markets expecting rate cuts to begin this summer. They pushed it back a little bit when it comes to the ECB cuts, earlier expecting it to come
bigger and faster. And that's really the debate with the Fed as well. With the ECB on its single mandate for inflation, these reports weigh even more.
Yeah, good to keep an eye on them. We're off the session highs here. Dow's now up 57. Let's get a news update with Bertha Coombs. Hey, Bertha.
Hey, Carl. New York City subway officials say they expect service to be partially restored following a train derailment that left roughly 25 people injured yesterday. None of the injuries are considered serious.
Financial sector looks real good. Technology looks good.
It collided with an out-of-service train.
Consumer defensive is not looking too hot.
Firefighters battled a 4-alarm fire this morning at a historic industrial park in Elizabeth, New Jersey. It was once the home to the first ever Singer sewing factory in the U.S. Someone passed by the area, reported the fire around 5:30 this morning. It eventually grew so large the plume of smoke was actually visible from nearby Manhattan. And David Soul, best known for his role as Detective Kenneth Hutch in the TV series Starsky and Hutch, has died.
Oh.
Confirmed the news today, too, as you can see. The Chicago-born actor was also known for roles in Here Comes the Brides, Magnum Force, and Yellow Rose. He was about 80 years old. I remember Starsky and Hutch. That was an amazing show. And that car. We all thought that car was so cool, Sarah.
All right, Bertha, thank you.
He looks nothing like he did in the show.
This morning's jobs number could change the outlook for equity prices. Deutsche Bank's chief U.S. equity and global strategist joins us, lays out his case for betting on the materials sector. We're back in 2.
Yeah, all the earnings stocks are up good. Morgan Stanley, even Morgan Stanley's up. JP Morgan, Dow, WFC. I used to trade that, called out H-band yesterday, and FITB. Tesla calls.
possible.
This morning's jobs numbers showing the economy added 216,000 jobs in December, 56,000 more than economists had been expecting. But some industries are still struggling to hire. Our Kate Rogers joins us from Half Moon Bay, California, with a look, Kate, at the construction industry.
Good morning, Sarah. That's right. The construction industry is certainly searching for workers right now. Job openings stood at about 500,000 workers as of the end of November. That's according to jobs analysis from trade group Associated Builders and Contractors. That group says the number is up more than 100,000.
The IV looks cheap too.
And it expects that will pick up over the course of this next year as funding hits the street from three key areas: the CHIPS Act, the Infrastructure Bill, and of course the Inflation Reduction Act.
It's hundreds of billions of dollars over the next 4 or 5 years. It's going to be coming out, and that's going to have a big impact on skilled labor and the shortage we're facing right now.
And as with many of the trades, it is skilled workers who are needed, and recruitment techniques need to change. At South San Francisco High School, a course that was designed as a traditional woodshop elective has now been transformed into a 2-year trades course for the construction industry.
Really going from building a birdhouse to learning how to, form walls, put, roofs on buildings. So it was really out of just understanding what is it that students will need to be competitive in the work environment, and what can we do to help support them get there. We really focus on trying to ensure not just that students are prepared for college, but also career.
Now that's really at the heart of what the industry says could be impacting the workforce. There's a lack of recruitment, particularly of younger students, teens, early 20-year-old workers that could get into the industry, fill that pipeline.
Real close to my support.
And of course, take the place of baby boomers who are aging out of the workforce without enough workers to fill their place. Guys, back over to you.
What about college degree? What is pay like with or without? And do you need it?
So Sarah, that's a great question, and ABC says you don't need it. They call this earn while you learn. So you could start in a high school course like the ones that we just showed you. There's another one we'll tell you about later in the day. You can move into an internship, and then you can move into positions that do have some competitive wages. You can see there, power line workers making about $40 an hour, and once again, no college, no bachelor degree required there. So it is a good option for people who may be thinking about college or on the fence about it, not sure if they want to make that investment. There are opportunities, of course, in the trades, not only in construction, but also in manufacturing. The two industries very closely aligned, and that sector is facing a big shortage as well.
Kate, appreciate that. Great logo on the hard hat as well. That's our Kate Rogers this morning. For a closer look at the December jobs number and the read-through from markets in 2024, we're joined this morning at Post 9 by Binky Chadha, Chief U.S. Equity and Global Strategist over at Deutsche Bank. Binky, it's great to have you. We got your 24 outlook a couple days ago. Roughly,
Me and a friend of mine wrote a song.
That's correct. That's the baseline view.
Years ago.
What do you think moves? I know you talked some materials
And
here, some financials as well.
Yeah, so I would argue.
It was kind of reminding me of yesterday, how I traded yesterday. I wrote a song about when you're down and out. We called it. I've had days a whole lot worse. Was the title of the song. So when you think you're really having a hard day or it's not going your way, you just always remember that you've had days a whole lot worse. Everybody's had a day a whole lot worse. Might not have something to do with stocks, but so I added on to the VWAP here, and we're going to see if we can hold the VWAP up. If not, I'll get out. Says it's ready. Stays a whole lot worse. We almost showed the song. Who's this? You got an Indian or Asian person here?
I think that's very possible. I think, as you said, the most important catalyst is really earnings, which start next Friday. And I think the thing to keep in mind here on the earnings is that if you look at the bottom-up consensus for what it expects basically for earnings, it would be one of the worst quarters of growth outside of a recession.
What?
And if you juxtapose that against basically what's happening at the top-down or macro level, what you see is the consensus still a little bit over 1% in terms of GDP growth. The direction of the consensus is getting basically, is for upgrades. And if you look at, nowcast indicators like the Atlanta Fed GDP, it's at a solid 2.5%. So I would argue, just like we've had for the last 5 quarters, we're likely to have a 6th quarter of, at or above trend growth.
But at the same time, that might mean fewer rate cuts than the market is expecting. And the market is seemingly focused more on that than the better data.
Absolutely.
But the market's always right, Sarah.
Is that it's easy to talk about
like they were last year and the year before.
12 months, but there's a lot of water that flows under the bridge, and I mean by that a lot of data, a long time for people to change their minds. I would argue if we continue to have at or slightly above trend growth, I would be surprised to see more than a couple of what I would characterize as basically fine-tuning cuts. I see the cuts if we get a very significant slowing in growth. That's what we have in our house economics view, but I would say that's been the consensus view, and it's been the consensus view for quite a while.
You do raise the specter of you call it the 1970s experience, kind of coloring maybe some reticence to cut as much as the market hopes.
Yeah, I think the question is, I think the pivot basically in December was a surprise, I would say, pretty much to everybody outside the FOMC, especially, sort of a 180-degree turn in 3 months. And so, like I said, 3 months is not such a long time, and we're having a lot of discussions about what's going to happen in 6 months and 12 months. It's the season to have those discussions, so it's completely understandable. But a lot of things could change by then, and the call for rate cuts is predicated basically 6 and 12 months out on a view on what's going to happen to growth. And I'm just simply pointing out that the consensus has had this strong, almost unanimous view that growth is going to fall off a cliff. So it makes logical sense that they're calling for rate cuts. But we shall see what happens to growth. So.
It's a good roadmap for at least the next 12 months.
Yeah.
Vinky, thanks. Good to see you again.
Pleasure. Thank you for having me.
Coming up next, Jeff Bezos backing an AI startup looking to challenge Google's search dominance. We're going to hear from the CEO on how they plan to take on some of Silicon Valley's giants.
And we're keeping our eye on the financials, as Carl just mentioned. The sector hitting a 1.5-year high. Bank of America, Wells Fargo, JP Morgan, all in the green. JP Morgan hitting an all-time high. This ahead of the bank earnings that roll out next week. We'll be right back.
La 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 la.
All
Schwab. We talked about that one yesterday. Mira still going down.
Perplexity. It's an AI search engine startup looking
let
to
me
take
try
on
this.
Google, raising $74 million in a round led by some big names. Our Deirdre Bosa spoke to the CEO for today's Tech Check segment. Deirdre, tell us about it.
Well, Sarah, one of the biggest questions since ChatGPT exploded onto the scene has been the future of Google search. Does its dominance continue in the generative AI age, or will search be rebuilt from the ground up by upstarts like Perplexity, which, as you said, just announced a $70 million plus Series B round to do just that? Now, its cap table, it is a who's who of tech moguls, prominent VCs, and existing Gen AI leaders like NVIDIA. There's Jeff Bezos and Shopify CEO Tobias Lütke, who participated in the round, along with high-profile former and current Google execs like Susan Wojcicki, who led YouTube for years, and current AI head Jeff, and the founder of Gmail. Still, Google casts a long shadow, guys, as we well know. It has left many challengers in its wake over the years. There's smaller players like DuckDuckGo, which is pitching better privacy controls to even Microsoft's Bing, which has billions of dollars in capital to use and harnesses the power of ChatGPT itself. Neither have made a dent in Google's 90% market share in search. So I sat down with Perplexity CEOs Arvind Srinivas earlier this morning, and I asked him why this time is different.
Search has been about 10 blue links for the last 20 years, and 10 blue links was always a hack. At the end of the day, people just wanted an answer. The concept of answer engine existed even in the late 90s when the internet was exploding. Ask Jeeves was an answer engine. In fact, many Googlers used to come from Ask Jeeves and join Google at the time because the 10 blue links was the concept that actually worked with the technology that existed at that time. So what Perplexity does is a paradigm shift in search. It's moving search from links to answers.
So even though Google's already working on this and it is rolling out a similar product in that existing search, Srinivas says that it is still too cluttered. Perplexity, he says, is being built in this new AI era, focusing on a core user experience that is clean, minimal, and simple. Sort of, guys, like how Google built search in the early stages of the internet. And there is this sort of outstanding question here in Silicon Valley, whether you need to build the next generation of AI apps in this era, or whether sort of the legacy companies are going to build the next consumer-facing apps here.
So is this one? This is clearly one to watch, Deirdre. What are the top AI startups that are going to rival some of the big players that we should be watching?
I will say, though, that it's an interesting one because it's targeting search, which has just been this big sort of existential question for Google over the last year. But in terms of generative AI startups, it's actually quite small valuation-wise. It's worth about $500 million. I realize that's a lot of money, but you think about an OpenAI that potentially is reaching a valuation of $100 billion, or Anthropic, $20 billion plus, on $1.5 million of revenue per year. So this one is actually relatively small, but it is so interesting because the CEO has worked for Google, has worked for
IWM
and,
at 200.
About his start. He comes from Chennai, India, and he says that
SPX 200. The SPY at the 200.
And the idea that he thinks the moment is ripe to, ultimately displace Google or do something that Google's doing right now is such an interesting one and so relevant for Wall Street. That is why Google has sort of been under pressure somewhat over the last year. I mean, its stock price has gone up because it is building the foundational technology, but there's still this question: how does search survive and in what form?
Yeah, key for Google investors, no doubt. Thank you very much, Deirdre Bosa. The CEO of Edgewell Personal Care is ahead. What's the breaking point for consumers when it comes to those price hikes? We'll discuss. Don't go anywhere.
She says don't go nowhere. Where in the hell is that chart? I keep losing it. Oh, messenger. Spy needs to hold the VWAP here.
Let's do a deep dive into the state of the consumer in the new year. Our next guest is bullish, at least at his own company, noting that the consumer has remained resilient and that despite expecting some wage and materials inflation, those can be offset by greater productivity. Joining us now is Edgewell Personal Care CEO Rod Little. Brands of Edgewell include staples like Schick razors, Banana Boat sunscreen, Playtex, Wet Ones. Rod, it's great to see you. Welcome back.
Morning, Sarah. Great to be with you.
So what are you seeing from the consumer? Because I gotta say, lately, Conagra, Nike, we've seen some big revenue misses and warnings.
Yes, sir. The consumer has been remarkably resilient. As we look at the state of the consumer today, I don't have December data yet around our category growth rates here in the U.S., but if you go back through the end of November and you look at that October-November period, the growth rate of our categories, so total category, very similar to what the past 52-week growth rate has been here in the U.S. So we're not seeing a slowdown in our categories. And importantly, outside the United States, with about roughly half of our business is done outside the United States, we're seeing that trend continue as well, with particular strength in Asia and Latin America.
It's not being reflected in the stocks, Rod. Clearly, something was worrying staples investors, whether it's the dividends aren't as attractive with high rates, or the idea that price increases have just been too high and now we're seeing volume declines. Are those concerns overblown?
Yeah, I tend to think the concern's the latter, Sarah, and you're right. Consumer staples has lagged. We've lagged versus other industries. And so when you look at what's in there, I do think there's some concern around where companies can price from here. And unit volumes have been down, and revenue increases have largely been behind the pricing gains that have occurred.
I do think we're in an environment now where we're not going to be able to price at the same level as we have in the past. We don't plan on that basis. Last year, we grew 4% organic. Roughly half of that was price, half of it was unit volume. In the fiscal year we're in now, we expect to grow in that same range with both unit volume growth and some price growth. Again, less list price increase, but good revenue management work.
Might have to go back to getting my trade ideas scanner.
Efficiency can still drive revenue gains for us above unit volume, and that's what we're focused on.
Although, Ron, we've seen some examples.
That way I can at least tell what
food, for example, where
direction the market's heading. Right now, I can't tell.
Flip negative, and I wonder, do you think that becomes the norm across staples?
I don't think so. Again, if the consumer changes, if that dynamic changes, but as we look at it, again, as I said, our recent period.
I'm not surprised about the breakout today because we've had such a real good little sell-off, but it ain't really been that much.
Feminine care, the category growth rates are there. Now, will they slow?
$10.
We're prepared for that if they do. But I would expect that what we've seen we'll continue to see, which is category growth rates. Sun care growing double digits, for example, shave growing low single digits. But every category we operate in is growing both here domestically in the U.S. and globally as well.
And just on pricing, if you could just distill it a little further, Rob, are we talking about back to 2019 levels? Are we talking about deflationary pricing?
Yeah, there's no pricing coming out. We're not reducing price per se anywhere. But for example, in the United States, we don't anticipate taking any meaningful list price increases this year. Everything that we have taken has been sold in, it's in through retailers, they've accepted it, and it's there. We do have some incremental pricing still happening outside the United States, primarily in some Asian markets and Latin American markets as well. So there is still some pricing power there, and I think we're in a period where it looks like it used to look pre-pandemic, where if you have great innovation, product benefit and experience, something that gives incremental benefit to consumers, they're willing to pay for it, and you can price for it. But you have to have the innovation, and you have to have the improved product and experience behind it.
All right, Rod, certainly appreciate it with the update on all the big things we're watching: inflation, consumer spending, volumes. Rod Little of Edgewell with an update. I do think, Carl, for whatever it's worth, the concerns are greater in packaged food than in household products and staples that Rod makes, as far as the pricing growth and the volume declines like we saw at ConAgra this week.
For sure, interesting. Yeah, the innovation conversation is really fascinating, and not the end of that discussion as well. As for next week, it's going to get really busy between CPI Thursday, PPI Friday, bank earnings, including JP Morgan, BofA, Citi, Wells Friday, CES, and JP Morgan Healthcare Conference. There'll be a ton of news.
I think there's a 10-year auction in there too, somewhere in the middle of the week, which we're still watching that issuance in those auctions.
You'll definitely keep us honest on that stuff. Meantime, we are holding 4,700, 4,705 in the wake of the jobs number today, which of course has some pretty interesting internals when you mix in some of the ISM. Have a good weekend. Let's get to the judge in the half.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, life after the streak, as stocks pace to break that remarkable 9-week run. Now the investment committee debates where the markets are likely to go from here. Most importantly, how you should play that. Joining me for the hour today, Jenny Harrington, Jason Snipe, Jim Leventhal, Steve Weiss, everybody in the house. Here at Post 9, let's go to the markets. We still are green across the board, but as you see, we are not nearly as strong as we were hour and a half ago or so. Jimmy, I'll turn to you first. So we're going to end this 9-week winning streak. It's the NASDAQ's worst week since September. You got the strong jobs report. Wages were slightly above. And then the ISM services was squirrely. It was weak. Barely hanging on to 50. Yeah. What do we do with this week? What do we learn?
I think we're going to come back down here on SPY.
To answer the question about, the 8-week streak, 9-week streak coming to an end, good. All right, because we needed to come to an end, right? What are we going to keep going, 10, 11, etc.? No, this is the pause that refreshes. And my take on this week, everybody, is that this is noise. This week, the downturn the first 3 days, the upturn today, it's noise in what's going to be a very noisy year. I think it's going to be a very positive year, and I can't stress this point highly enough. The tone has changed from the last 2 years of how high is the Fed going to hike rates
to now we're not talking about rate hikes. And I don't care, I'm looking at you, Scott, not that you're coming at me, but I'm just looking at you because I want to have a focal point. I want to have a focal point here, okay? I don't care.
Just show us.
I don't care how long it takes them to cut. I don't care how many times they cut. That's irrelevant. The fact is we're no longer talking about rate hikes. Why does this matter? It means that good news is good news. It means 200,000 jobs being created is good news. It means that, now listen, I'm not all that happy with a 4.1% wage growth year over year, but it's not going to provoke the Fed to start raising rates again. And absent that, it means it's good for consumption, which is good for the economy. Look, I don't like the ISM number, and I don't like the way that labor force participation went down, but there's noise in every data series. I think we've got to strip out the signal from the noise, and right now the signal is inflation is coming down, the economy is strong, profits are growing, and this should be a good year in the market.
All right, so Jenny, my distillation from all of that is that Jim says the story's intact, right? He gave you all the reasons why he thinks it is, but that's what I take away from what he said. The soft landing, inflation down, economy good, stock market good, story's intact after this week.
I agree. And so, while the story's intact, it doesn't mean necessarily that we have the right now to go to new highs. And I don't think we do. I think when Jim said, you know, hey, we're backing off a little bit, good, I agree, good. It was too much too fast. And so what I know we'll get to later is we've taken some money off the table. And usually when I take money off the table, it's paired with the immediate buy, right? But right now, I don't think things need to pair. And so everything's not moving in tandem. The market got kind of frothy into year end. The story's intact for this year. I feel good about this year. I know within a month or so I'll be back to fully invested, but right now I'm sitting on a little cash, and I think that's okay. When I'm thinking about the story being intact too, I think the story gets better and better as the year goes on because we have all these nasty things that are going to be out of the way. We're going to know if it's 6 rate cuts, which I don't think it is, or 3, or 2, or none. We're going to know for sure. We're going to be done with the presidential election. We're going to have way more clarity on if inflation stays like a little sticky or if it's done. But this is a year where really like clarity comes in a way that we haven't experienced for the past 4. And so I'm actually feeling not good in a raw markets going to new highs way, but I'm feeling as good as I've felt in at least 4 years because as an investor, I can make decisions and invest and think about investments and think about forward cash flows in a functional way without distortions and disruptions in a way that I haven't been able to before. So to me, the investment picture is intact.
So Jason, I'm watching yields, and you know the market is clearly tracking where yields are going and reacting as such. I mean the equity market, because if you have the 10-year, you know, you get the jobs report and rates move up a little bit and cut expectations go down a little bit. Then the ISM report comes out and rate cut expectations go back up. Interest rates, the 10-year yield comes down, but I'm watching the 10-year right at 4%.
Yep.
And the equity market is clearly a little uneasy about where yields are ahead of the CPI next week. Fed meeting's not for several weeks till the end of the month, but we have earnings too. What's your great takeaway and outlook for this year? Because we haven't heard from you. By the way, Happy New Year. It's good to see you back.
Man. Yeah, no, so what I would say is the biggest thing I paid attention to this week was the Fed minutes, right? So what was evident and very clear to me was, hey, look, we are pricing out a March cut. That's really what's going on in the market. And I think there's a fair amount of digestion as well. Listen, we ran a lot over the last 9 weeks. And to Jimmy's point, you know, it is time for a little bit of digestion going forward. There are a lot of variables that will affect the market. We have earnings that are starting in earnest next Friday, this time next Friday, which I think is going to be great.
And by the way, I'm going to let you finish your comment too. If we have rate cut expectations, if we guys can, in the control room, please, can we show that? It'll show you if the Fed was trying to get the market to price out a March rate cut, today's economic data didn't do the job because, as I said, you know, jobs report comes in stronger, wages come in a little bit stronger, rate cut expectations actually go down a little bit, but then ISM comes in weak, and then you're going to see when we show it what happened next, because you were, I don't know, hour and a half ago, you were like 70+% for a March cut. So anyway, we'll show that. I want you to look at that. I'm sorry to interrupt you, but please carry on.
I think it's an important point, but let's also pay attention to the dot plot. Dot plot, I mean, Jay Powell Jerome Powell has talked about 3 cuts. He did not talk about 6 cuts. The market's been pricing in 6 cuts. I mean, for a lot of us on this desk, I'm sure this seems a little bit out of this world, right? So the idea that we're also pricing out a March cut, you know, and kind of letting the market, let's let the market play out. Let's see what.
Well, when they say that, it just annoys me. The market is counting in 6 cuts. How can you say that? I mean, that's what they've been saying on here. And now they're doubting cuts at all? Again, they got it wrong. I'm not even thinking about the cuts. Right now, it took them taking a loss on the SPY, that's for sure. Again. Just stopped out. Probably be another big mistake. If I was right with my first opinion about getting a put, I'd be good and holding them. Just like yesterday. Now we're at the 200, so we'll probably reverse here. I got to get my money back. It annoys me. Calls. Traded it 3 times, then I got in puts. Traded it once. I got in calls. Thinking we were going to bounce off the 21.
My money, so I'll be looking to rebuild those positions. I still have core positions there, but not the size they were, because I sold before the end of the year. I still think that's the place to be, because I don't have as much economic sensitivity as some of the other areas.
Jenny, you said that you agreed with Jim that the story is still intact after this week, but I look at some moves that you made and I see what feels to me like a little bit of nervousness about where we're at. Look at stocks that have gone up a bunch, ones that you own, and now you're trimming Uber for the 3rd time, right? You've sold Iron Mountain, you sold Seagate. Tell me about these moves.
Don't forget United Rentals, Iron Mountain, Seagate, Uber, as you said. So
you trimmed United Rentals.
Right, and this is not a macro call. This is literally like portfolio management 101. You look at your portfolio, you look at the positions, and you say, what's the opportunity cost of continuing to hold this? How much more upside is there from here? So United Rentals, for example, we first added in 2017 at 77. It's up 600%. It's 10 times, now it's at 13 times. So we take it down from the 5-ish% position that it grew to, down to 3%. Ditto for Uber. On Uber, it's a little like more of a fun story. We can get back to that debate that we had with Brad Gersner, where he's saying, look, there's way more long-term potential there. I think I agree with him.
He's not the only one,
No,
right?
he's
There are
not.
many on this show who own it and say now's not the time to get out, that this thing may be just getting started.
But then there's also analysts who are out there, like putting $62 price targets on it, $66 price targets on it. And as a portfolio manager, you need to say to yourself, if I only have 10% more upside in this, am I doing the right thing by my clients, continuing to hold that? If I think in short order, I can buy something else that over the next year or 2 years has 20, 30, 40, 50% upside. Now let's go to Iron Mountain and Seagate, where those were full exits. Seagate we bought a year and a quarter ago at 56 bucks. Seagate is really interesting because when I bought it, like, everybody hated memory. This is my third time owning Seagate and making a decent return on it. You buy memory when everybody hates it. You sell memory when everybody's positive on it. So the stock goes from 56 to 80, a 5% yield to an under 4% yield. You take your money, you get out. There's limited upside from here. The valuation's right. The yield's down to under 4%. I am quite certain that within the next month, I'll have something in the portfolio that replaces it with a 5.5% or better dividend yield, because the objective is in this portfolio, right, the equity income one, not the one that has the Uber and the United Rentals, but in the dividend one, it's maintaining this 5% yield or better, so you need to recycle. Iron Mountain, I actually bought in 2015, and it kind of languished for a long time, had a really juicy dividend yield, so I could sit with it. But Iron Mountain, which you all know from the document storage, right? Just like you send your boxes of legal documents, they put them in their warehouses. They've also very quietly, and this was always the investment thesis, in the background been building up these data warehouse centers. Well, this year when data warehouse became extra hot again, this share price was up, what was it up? It was up over 40% this year. And now I've got a real estate investment trust with an under 4% dividend yield in the portfolio. And don't forget, that's not qualified dividend income. So even though it's under 4%, it's really worse on an after-tax basis. Same thing here. Maybe there's upside in Iron Mountain. I'm not saying either of these are bad, but they don't fit the strategy. And I think my upside, even just from sitting in cash for the next month, is probably better on both of these. I've got a nice short list of potentials. I don't know which I'll own, but there are things like UPS, which I've talked about, like Wendy's, like Ford, KeyBank, which I mentioned last week. I don't know which of those will make it in. Maybe it'll be something different. But when I buy those,
Riot's
I
getting
will
close
think
to my
myself,
support.
There's more upside in that new investment than there was sitting in these.
All right, tell us if you make a move there, of course. Jason, you trimmed ServiceNow.
I did.
Which was a huge winner, and I know how much you like Bill McDermott. But why trim that now?
Yeah, so, I mean, for me, listen, the stock was up 82% last year. Had a very difficult 2022. But what I know is enterprise software spend is slowing, right?
82% is a good return. 20% is an excellent return. And these people are getting 100, 300, 600%, like NVIDIA and Eli Lilly. In 1, 2, 3, 4, 5 days, it went from 569 to 636 in a week period.
So, no, let's just make sure we're talking about inflows into the equity.
Inflows, yes.
Okay. So, look, I mean, the tone has changed. I'm sorry to repeat myself, but the tone has changed from the last 22 months. The last 22 months has been, how high is the Fed going? How badly will the economy
What's this,
react?
Nightbolt?
How badly will profits drop? We're not talking about that anymore. We're talking about when will cuts occur? How many of them will occur? And certainly there's a great debate about it. By the way, Steve, totally agree.
During market
6 cuts
hours
is
on the left
ridiculous.
chart.
But the tone is completely changed right now, where people are rotating to be back on the balls of their feet in terms of investing, instead of rotating to their heels and saying, okay,
What's
I'm
going on
comfortable
here?
with cash. Look, cash still yields whatever it yields, 5.25%. But people recognize, just look at the last 2 months in the stock market, that you can make twice that in 2 months. And so I think it's as simple as saying FOMO, fear of missing out. And you know what? It's right. There is something to be missed out on.
Yeah, I mean, and it's all going to come down, I guess, Weiss, to earnings, right? Next Friday with the banks really kicks things off.
You got the wrong screen
Chris
up.
Harvey is talking about a reverse hat trick.
No, it don't.
And he's talking
Damn,
about
I'm tripping out on LSH.
Overwhelming guidance to start earnings is likely to remain a near-term net negative catalyst. We're just talking about all the catalysts. Jimmy gave you a list of all the catalysts to keep this thing going and why he's so positive. Are we taking into consideration what might happen with earnings season?
I don't think we are. I think purely what we saw this past week has been people that have been looking to sell for months and just said, I'm going to ride it, number one, and then I'm going to delay paying taxes on my gains. So I'll wait till the first week in January, which is why I saw the last day of 2023. And that's what we've seen happen. So I don't think you've seen any displacement in the optimism. And people are not focused on earnings at all. As a matter of fact, when you hear a lot of strategists talk, aside from what you just mentioned, earnings are an afterthought. It's the Fed cutting, it's that the economy's strong, et cetera, et cetera. And my view is that the economy is not that strong. Services, sure, but otherwise, no. We've been in a manufacturing recession for a long period of time. I don't see that change.
I agree with this guy 100%, but the earnings is going to be the catalyst to turn this negativity around. But he's right. I believe that this economy is not as sharp and as, I mean, from what I hear from everybody I know, and business owners, they're struggling. But that's a small sector. That's a private sector. It's not these Metas and Googles and Amazons and that have billions and billions of dollars. As a small business owner, we barely make it week to week anymore because of the cost of goods. My accounting fee is up $50 a month, where it used to be just $100 for years. That's just one of my offsets that I have to really think about. Do I want to keep my business open anymore? Is it worth keeping open anymore? If I do, I'm not a spring chicken anymore. Don't want to go out and look for a lot of work to make up for the stagflation that we've got with this administration. I mean, I was taking home a couple grand a month profit. Now it's dwindled down a lot. So it's a big difference what it was 3 years ago, owning a small business compared to, like a Bass Pro or
CapEx reduction. We had to pull levers to get there. Earnings are made, but not because the economy is so strong in the beginning of the year and revenues were good and that supported earnings. But what I think could be really interesting and support not just the consumer but corporations, which we're not really talking about too much, is as interest rates come down, as energy prices have come down, and they have. Don't forget, this time last quarter, oil was at $90 a barrel. Now it's at 72, 73. So I actually think that these quiet little things that we're not really highlighting put the wind at the back of earnings and get us to that 11% total growth on the year. I don't think that's that spectacular. I think it's a mathematical equation that plays out. I think one of the things we
go
need
make
to
some
focus
coffee
on
and I'll be
with
right
more
back.
My enthusiasm, right, is actually where to be invested next year.
Right.
And again, I really don't want to be at the broad macro level. So when you see me actually having a spring in my step for the first time in a long time, I'm enthusiastic because of the have-nots. And where I want to focus next year are the companies that don't need 3 rate cuts to get there, right? The companies that don't need to pull levers to get there. And
She's
I think
just
there's
saying
a
what
lot
I
of
just
those out
said.
there. When we take out that narrow sliver that performed last year, valuations are fine, earnings growth is fine. I think there's a lot to do with
The comps are easy for the first 2 quarters. You had negative earnings for the first 2 quarters in 2023. So they should recover somewhat. But here's what keeps gnawing at me, is that you can't go through that massive tightening cycle without it really severely impacting the company. You can delay it, but you can't avoid it completely. So last year was driven by multiple expansion. This has to be the year of earnings expansion to support that multiple expansion.
Exactly.
Otherwise, that's where you could run into trouble.
That's why I'm
my
important
concern.
on
I'm not
watching
favorites.
earnings.
I'm going to play the names on.
Earnings are very important this first quarter from the last quarter. I think it's very important, be a very important catalyst for this market to keep going. And I agree with him compared to the other guy.
Right? 3 trillion in market cap. It's down 5%. As I said, worst market cap. It's made up nearly 20% of the NASDAQ 100's losses this week alone. You've gotten a couple downgrades. this week, which you don't often see. Maybe you see one here and there. You rarely see two in the same week.
Yeah.
We ask this question all the time. As goes Apple, so goes the market? Question mark?
Right. So I think with Apple, as it pertains to Apple, it's always a narrative shift. I think, to your point, the largest company in the world.
Apple's about to my support level.
You know, revenue growth has been
Off the
declining,
200,
right?
one more candle down,
You
boom, I'm
have a
long.
multiple of 30 times forward. You know, with a long-term growth rate of almost 10%. I mean, this is a spread that's troublesome for a lot of folks. And I think all the time when there is volatility in the market, that's when we start to talk about the multiple. Right, so the multiple's a problem anytime we start to see some volatility.
Well, I mean, when the stock goes up, you know, near 50% last year,
right,
when you could make a credible case that the fundamentals of the current periods didn't justify a 50% move. In other words, if I told you at the beginning of the year, you know what, Apple's going to have 3 consecutive quarters of negative revenue growth, but the stock's going to be up 50%, you say you're crazy.
Yeah, I would have.
100%.
Based on what?
100%. And I think last
Apple's
year,
a lagging indicator.
Last year, Apple was a defensive play, right? So
See, they turned Apple into a leading indicator, and it's a lagging indicator in my book. Since I've been trading for 20 years, they never used Apple as a leading indicator before in the market. Never.
multiple, you look at the long-term revenue, you look at the revenue growth, and you look at the long-term growth rate. Yes, of course, it plays right into what's happened.
I mean, Jimmy, now Foxconn guys,
NVIDIA.
Yeah, is that another warning?
Different story. But Apple had too much exposure to China.
Well, I always hear too that Apple doesn't matter to the overall market as much as it used to. It doesn't matter. I hear that from you know, when I raise the question. That's the comeback from many. Is that in fact true?
That's where I am. So, I mean, first, just the math, right? Stock's down 9% from its recent high, more or less. S&P 500's down 2% from its recent high. Now, the S&P is down as Apple's down. I'll give that correlation. But it's not down to the same degree. And look, the simple math, we know this. If the Mega 7, the Magnificent 7 are 28% of the S&P 500, that means there's 72% that's not those names. And I think, actually, you're not only seeing it in the last week, but you're seeing it over the last 2.5 weeks, that there can be a catch-up trade. And it certainly doesn't help. You don't want Apple going down another 10%, but folks, it could happen. And I said this yesterday, I'm going to say it again. When you get the sort of return, Scott, that you were just saying, what, 48% last year for Apple, or let alone the 200% for NVIDIA last year, you have to accept the volatility that comes with it. There is no free lunch. And I know we're talking about Apple, but I think the comment I'm making is more writ large with NVIDIA last year. July, it goes to 500, promptly sells off 20%, 20% down to 400. People are saying, oh my God, we're going to fill that gap. Then it pops up. I'm not going to talk about the gap. It pops up 25% to 500, comes back to 450. If you want to play this game of those sort of multi-double-digit returns or triple-digit returns, you have to pay for it in volatility. My advice to people in this regard is not to go say Apple's broken or sell these Magnificent 7, but as Jenny would say, because you said it earlier, it's about portfolio management, it's about risk management. Choose your sizing. I'm underweight in Apple because I do think there's a little bit more downside. If it goes down 10%, I'll probably add to it from there.
I'm watching Microsoft wise too because it's, you know, $2.75 billion, so it's near $3 trillion in market cap.
Yeah, look, those are great headlines, great things to talk about, but what I see with Microsoft is a permanent compounder. I love permanent compounders, number one. Number two, AI is going to be huge for them. It's going to allow them to increase pricing, which, by the way, they've done on a couple of products already. It's going to require new subscriptions to get full access to their AI toolbox. So, to me, it's the premier AI play out there.
Trillion, I meant to say, obviously.
Yeah. So why not? So is the multiple a little stretch at this point? Yes. Do I see the earnings growing into that multiple near term? Absolutely. And by the way, I'm not going to trade around this. The gains are too big. I'm too much a believer. Where would I put my money in? What's the next best Microsoft? Well, for me, that's Meta. So those are two of my largest positions. And I think there's, again, the permanent compounders, not they permanently go up every day, but over any time frame, you're going to see stocks higher.
But that's not necessarily true, and I keep dragging us back to
true with
this.
Microsoft.
Okay, but not really. You can look at Microsoft from, I think it was 2001 until 2013. The stock was totally flat, and it had that huge run going into that. So what I struggle with,
why, right?
Well, yes.
AI.
What I struggle with now, and I mean this like literally as a question, not as picking a fight. what is the realistic return potential of Microsoft next year and the year after that?
She's so right. Microsoft with a lagging indicator was the last one to run during COVID. As you can see, it just kept going on down. And I'm saying, what the heck? All these others are pumping up, running up big time, and Microsoft ain't doing crap. Same with Apple. During COVID, it didn't do crap. And then all of a sudden, boom, $6 trillion was printed. $6 trillion. And I've never seen any that money that printed like that before. And we already had 4 trillion, 5 trillion already printed. So you're looking at $10 trillion printing machine just in about 2 to 3 years, 4 years. She's 100% right. These were like lagging indicators. Those are the two companies I would not want to invest in at the time, but because they just kept going down, they weren't holding up. Tesla, different story. This was probably one of my favorite trades of all, Tesla. It's when I made the most money. I ran that thing all the way up to $2,000 a share from 158. That was an incredible run. I've never seen anything like Tesla. It was new. It was an innovator of EV cars. It was getting into, nobody else wanted to invest in EV cars, but Tesla did. They're so negative about Tesla back then. Well, I don't want to drive no EV car. I'm a gas combustion engine. I mean, now everybody's kind of changed their groove about it. GE was one of the best running stocks there for years. General Electric. Here's another one that I traded like hotcakes and swung it for years. Didn't have to worry about it. AutoZone, man, is another great one. And then you had the failure of Intel, which was the number one. Everybody wanted to hold Intel. I was looking at the wrong time frame, damn it. Even back then, it was a big deal to have Intel. Boom! What was it? Microsoft? Well, I don't know. Looks like it's had one heck of a run. But why do I keep thinking it always hung around this 150 area for years? Something more fishy about that. Jimmy, are you losing it? God, it's just scary to look at this chart. Everything just looks very scary. Verizon looks very cheap. And I always loved Verizon.
At this huge, like 5-6% free cash flow yield. That's down to 3.7%, trading at 46 times earnings. And so here you have, it kind of goes to Steve's point on Microsoft. You kind of have like, on the one hand, of anything out there, Palo Alto should be a permanent compounder because we know there is no end in sight ever to cyber threats. And they are at the heart, at the center of cybersecurity protection. So you're struggling with this like valuation, this huge run-up, but on the other hand, you have endless demand for their services. And it's just a struggle right now. It's the reason we didn't, you know what? It's exactly the reason we only trimmed Uber and didn't
See,
sell
as you were
all of
describing
Uber.
that, I'm thinking Uber.
Yeah.
It's like endless demand.
Right.
You know, all the other things that you said as well. Yes, it has an elevated valuation,
Yeah.
but you're paying up for that.
I mean, like check back in a week or two. I wouldn't be surprised if it leaves the portfolio, but it's just not that expensive.
I don't want to talk
you know?
to you.
Okay.
Uber had a double top, all-time high. That's why she trimmed it.
Does it grow? I'm not sure.
Jimmy, ExxonMobil and Chevron named top picks at B of A. A lot of people are trying to figure out where energy stocks are going to go this year. These two stocks among them.
Yeah, and to say the least, energy stocks and these stocks were disappointing in 2023. We know that. I do think that energy prices and these stocks are going higher.
Really?
Now, why is that? For one thing, China. Look, it's hard to imagine, famous last words, hard to imagine Chinese growth getting worse. It could, but it's hard to imagine it getting worse. The government there is talking about things to stimulate the economy. That will be good for global oil demand. What's probably more important is the Strategic Petroleum Reserve, which we're going to spend at least the next couple of years refilling. It's at half the level it needs to be here in the U.S. That's going to place an upward demand on energy prices and on these stocks.
We're going to get the headlines with Bertha Coombs. Hi, Bertha.
Scott. Biden administration announcing today that it's preparing military support and aid to Japan after that devastating earthquake on New Year's Day that killed nearly 100 people. Military logistical support, food, and supplies are being sent. So far, Japan has rejected offers of aid from other countries, including China. The former Capitol Police officer who came face-to-face with that violent mob on January 6th is running for Congress. Harry Dunn announced that he's running for Maryland's 3rd Congressional District on a platform of infrastructure, mental health, and crime. He called the January 6th protests one of the biggest motivators to run for office. And Tokyo's Toyosu Fish Market started its first auction of the year with a pricey bid of bluefin tuna today. The 238 kilogram, that's 525 pounds, tuna sold for 100 million yen or 788,000, I think, there, dollars. That's more than 3 times the highest winning bid at last year's first auction.
You gotta be kidding
Makes
me.
you want to have a little sushi, doesn't it, Scott?
Yeah, it's going to cost you more, though. Bertha, thanks. Bertha Coombs. All right. Yields are ticking up. Stocks
I might
are
go
ticking
back to
down.
fishing.
When we come back, betting on a big surprise. The committee laying out their top contrarian ideas. We continue that series next.
$700,000 for a fish. Better, better have a good cook behind that one. Feels like a rug pull is coming. The way they're talking. Again, you know, if I stuck with puts didn't pay like they did yesterday. but I was in the SPY. Go get my coffee. I'm going to go over my watch list here and see if I can find anything that's worth trading. I had a call here, traded 3 times and looking good. I bought a put.
As you know by now, all week long the committee's been giving us their contrarian ideas for 2024. We want to continue that today.
Sold it for a small profit. Then I got in calls thinking we were going to bounce right here. Instead, we dipped. So I took a loss. I'm up today on the SPY. NVIDIA, traded it. And I wanted to trade in PLTR this morning. XOM's at a double bottom right here. Now they're calling this the trade of the year. If they're calling it that, I don't think you want to buy it here. Maybe under 100 or even less than that. 99.30 maybe. I'll set an alert right on that bottom here, or on that shoulder. See if we create a shoulder. I'm drinking my crappy coffee right now. I'm out of the good stuff. Blue Mountain Jamaica coffee is the best. So let's go over my watch list. Now, in turbulence, I think the market is overbought on speculation. If the market's telling me anything, like it's not telling them, it's overbought on speculation. We were at the same position when COVID came, and everybody just went nuts over anything that had to do with work at home. The computers ran like a Dickens, the Zooms, the COVID vaccines ran 400% or 500%. And I didn't recognize it. I didn't recognize the pullback. Now when I'm seeing something that's irrational exuberance, like what we saw here in the last 9 weeks, I'm thinking, no, this is just, and you got NVIDIA and you got all these AI stocks that are peaking out. And they're still pumping them like they were pumping them Zooms at 500 and back during the first of COVID, when everybody was going to stay home and work at home. Now the narrative has kind of changed a little bit. People want them back in their office, because I couldn't be there's no way I could be a CEO of a company that would allow their employees to work from home. I just couldn't do it. There's no way I could manage a company like that. I'm too much of a control freak. I'd be constantly wondering, what are they doing? You know, are they working? Are they playing with their little baby? And now the rumor is they want to have a 4-day work week in America. That's what they're trying to work into. 4-day, have 3 days off, work 4 days. I've worked 7 days a week for 20 years, since 2004. But I like the freedom of working 7 days a week compared to working a 9-to-5 job. Coming home, eating supper, watching a little bit of news and going to bed. Waking up the next morning, 6 o'clock in the morning, get an hour, get ready to go to work all day, come home, cook supper, watch a little news and go to bed. Now I can get up at any time I want, being my own boss. I can leave any time I want, as long as I get the job done at a certain time. Then I got all day to play. And I go to bed any time I want at night, which is usually early. But I have a lot more time to myself than I ever had. I've been a sole proprietor since 1994. When I had my picture frame shop, I had to open the doors at 9, so you know, there I go again, 9 to 5. But I loved it. And this has probably been, it's so weird that you call pullback and then you don't trade it right. So here's my watch list. We're going to start off with Mara. Mara, I did a video and called the pullback on this one. I'm still going to wait for the pullback, and then I'll probably jump in the trade. This channel right in here, we come real close of it yesterday, and I should have recognized one thing that I did not recognize, and that's this gap. If I'd have recognized that gap, I would have set an alert right there. Instead, I set it just a little bit below 20 bucks. But if I'd have saw that gap, that's where I would have put that alert when I did that video, and I might go back and watch it and see if I did talk about it. And boom, we pulled right back to that gap. So that's called a gap play. Now Baba has the same thing going on right now. We got the same thing, but we fell into the gap. We could probably stop at that wick and bounce up off that wick, or we'll finish a strong buy down here at 72.47. So I'm waiting for that. I'm going to go ahead and put me a little alert there. And I'll probably start a position there for next year, for this year. 72.63. So we got Tesla next. Tesla called a 234 pullback, 234.11, and I was off just a few cents today, about 60, 70 cents. And that's talking about the 200 EMA. Then you got the 200 SMA. So I'm going to take the easy moving average over the long lasting moving average. And it'll be a double bottom on the body of that candle. So I'll still wait for it. You got Piton with that news yesterday, teaming up with TikTok, which I think is an excellent idea. I really do. I really think that could be a good catalyst, and it did bring it up some. So I'm going to set an alert off this previous high. Where are we now? 675. Let me see if I see a pattern in here. Not really. We'll take it off this previous high right here. 640 would be a, I don't know. I'm so chicken to trade this anymore. SPY it's going to be my daily scalper, and so far I'm up real good on the SPY. But today and yesterday I sour caked on the SPX. AMD, these are volume highs. Here's another one that's had an outstanding run. So maybe take it to this previous high right here for a support level. And we did pull back pretty close to it yesterday. And I'm going to go ahead and set an alert off that previous high at 132.76. And we come real close to hitting that. It's holding up the trend line. Sophie, I talked about this last week, said I was waiting for a certain support where the millionaire got into the trade. He's still probably green on this, and it was at 750. We came back and hit my support level that I had on here, which was this previous low yesterday. Almost hit it. So I'm still waiting for it. NVIDIA, I'll keep playing this Darvis box. We are wanting to break out, and I do believe it will break out at earnings. And we'll break that resistance and get to that 650 this year. But I don't like the run that's already had. It scares the hell out of me. 140 in 1 year all the way up to 505. It's just not normal. And this could be another gotcha, I told you so. But there's people calling this to go to 1,000. 45% increase from today. 1,200. I've heard 650. I just can't see it happening. Maybe 10 years down the road if we don't get nuked. Apple has always been, I'm not getting involved in that pump, but we are at a support level, which is the 200 SMA. We did hit this previous high, which I called off the SPX and the SPY. So, it could start to bounce right here. This is very strong support. Very strong. If I was an investor, I'd probably start in small right here and accumulate as it started to go up, or if it pulled back and hit the 200. Bank of America, I called this out at the very bottom. I don't like trading something that's way out of resistance. I traded this one here and took it to the 200 and got out. And look at it. It's up another $5. Nile is getting some downfall on BYD. Nile is a first-class automobile where only the rich will be able to afford it. BYD is an economical car where the middle class might have a chance. Amazon are going to be bullish when earnings come out. We've had a nice little pullback to the previous high right here, which is support. Would I get in it now? Probably not until Monday. I'm going to pay focused on the bank's earnings. I think they're overbought right now. This girl here, she's talking up a storm today. Intel, called the bottom on Intel off the 200. We had that news come out on it, and then earnings. Everybody was pumping Intel to be the next, to get back up to the legs of AMD and NVIDIA. Riot. I like trading Riot over Mara sometimes. I used to think Riot was a better trade back in the day. But it turns out that Mara has took a leg up on them. But I have traded Riot a lot. I traded Riot around $6 down here. Riot was a good trade over Mara. I remember trading this around 5 or 6 and running it up. Rivian, they came short of sales, so this might have to take some time to rebound. I just got through talking about Baba. Baba just is ridiculously cheap. And I haven't said the word cheap in a long time, since last 2 Septembers ago, when things were cheap. Baba now, I mean, this thing will rebound unless China does not invade Taiwan. If that happens, we could lose 50% more on Baba. But Baba's worth 10 times as much as it was when the IPO came out. And it's $20, $30 less than the IPO. $20 less, $25 less than what the IPO broke out at. So that's really something to think about. You got a company that's earned 10 times as much, worth 10 times as much, and it's down $25 from the IPO. So, I mean, that's, K-Web was mentioned yesterday as a strong buy on CNBC. And I kind of agree with him. We do have a nice little snake here into an inverse head and shoulders. And we're at that shoulder line. So if we have a J-hook, we'll create another head and shoulder right down here. And that 2213 would be an excellent place to position yourself on K-Web. It's the internet company of China. Google. You look at Google right now and you say, okay, we're clissing up there on the double top all-time high. We need a pullback, maybe around 122. PayPal, involved with Bitcoin. Here's another one that took a big run during COVID. Got a little ahead of itself, just like what NVIDIA has done. Soon these guys on CNBC are going to say, well, we were wrong. Kramer threw a fit when NVIDIA got down to 400. And then we had a nice bounce back up to 5. XPEV is my number one, besides BYD. XPEV is my second favorite car company in China. Micron Technologies, very volatile stock. I'd like to see it come back and hit the 200, little under 70, and take it. Coin, had one beautiful little run in the Bitcoin run. Now Bitcoin's pulling back. We could see it bounce off the 9 or the 21, and I'd be more obliged to get it at 115. JD is something that I have high hopes for. It's also been oversold. China's in bad shape. They might need a war to pull it out. JP Morgan double top. This was probably one of my best calls of the year besides HUM. Inside harmonic candle. Boom. Nike. I thought we were going to have a little bounce on Nike, and we did off the 1, 2, 3. Now she's pulled back. So we got an inverse head and shoulders right here at 157. I'd just make sure to see if that held. If that held, fine. If not, we could see the fourth dot down there just above 90. Another $10 drop. Now, percentage-wise, if I look at the red, Mara is definitely waiting for that pivot point area. Riot, XP, Hum. I went to Florence yesterday. We were at a good spot, I thought, in the chart. I said, we just got us a headline here that said some guy is selling his Humana, and we've had a $20, $15 drop. I can see it bouncing off this here trend line again and squeezing back up to the 9. Right around back to that 173 area. Sophie, watch the videos come out with the people that have been calling this trade out. We definitely pulled back to my 811 support level. The millionaire likes it down here at 650, $7. Someone lost over $200,000 in this trade Friday or yesterday, whenever it sank. And then we go to percentage highs. Today on the list was alerted to us yesterday with that TikTok news, Piton, and I think that's excellent news to bring this up a little bit more. Because that TikTok, think about it. I mean, that's, you're going to have people on there that are going to be so unhealthy riding the Piton, and you might see lives change. It might be on TikTok. You might be able to get paid working on a Piton, losing 300 pounds, 200 pounds, and watch everybody watch it on TikTok and get rich trading TikTok. I mean, being on TikTok and also losing weight. People love to see stuff like that. They actually made a TV show about people losing weight. And I met a guy the other day at the IRS, a skinny guy, and he showed me his driver's license. And he weighed 280 pounds during COVID and lost all that weight because he had nothing else to do. And he looks beautiful. I mean, I was shocked. I said, God, I've never seen anything like it. So I'm really excited about Piton again, but Piton went down on a triple top because this last time it was up here, we had a death of a child to do with some kind of Piton thing. So it caused the stock to go on down. NVIDIA, we've talked about it. AMD, I run this thing all the way to $9 to 30, and then scalped it all the way, day traded it, and swing traded it all the way up. And one of my favorite companies is AMD and the story behind it. Vegas and I traded the heck out of this stock. I mean, all the way from $9 to 164. Bank of America, we called the bottom on all the banks. PayPal is oversold. I think PayPal is a very big deal. But it's not looking too good right now. Airbnb is another one. I waited for this pullback and I didn't take the trade. I called it out. I said, we're going to go to 132. Now we're at 135. I had 132, 33 support on it. I ain't touched this chart in months. I just waited for that 132 and never took the trade. Now we kind of got the 9 crossing down over the 21, which is bearish. Look at SPY. More drama. I had the same game plan today as I did yesterday, and then I got back in them freaking calls and screwed it all up twice in a row now. 2 days in a row. I've done that. And I told myself I wasn't going to do that today. I was just going to take the puts and run it on down. But the excitement in the market just got me going again, and I've really screwed that up today again. It's 2 days in a row, and I can't do it 3. So yeah, Boeing, we called resistance on Boeing. These things had one hellacious run, $100. Since a couple months, that was just a little bit too much. It did hit my long resistance, and if you look at the bigger chart, you can see why. The previous high, double top. There's the W. Snake breakout, pull back higher, low, boom. So it's got to get back into this lower channel support right in here, which I think it's already done it. Yep. So this is going to be on our watch next week. FedEx. Here's another one that I called the bottom on. We had a nice little bounce. Now we pulled back to a double bottom. MTCH. We're at a resistance high. It needs to pull back. Dash. I like this Dash. But then I don't like it. It's up over 100%. JP Morgan is one of my favorite calls of the year. We're at a double top high. They're pumping this up to 220. I'm going to buy it at a cheaper price. TSM's another one that I've traded off Kathy Wood's sell. Kathy Wood sold this and I bought it. You go back, I think it was 4 or 5 years ago. Let's put 6 on here. She sold it right in here at 110. on this last run. And I said, what are you doing? Everything's popping. It went all the way to 140. Now we double topped. Double top. You see how often a double top is a hard resistance? No matter how hard they pump these stocks. That's why I get pissed off about Apple. And MU. And they've been talking a lot about CVS over Walgreens. Walgreens took that knife yesterday. And CVS jumped. And it's undervalued. COVID brought this price up. And then the one that I regret not taking is that mRNA during the upgrades. It was down here. 3 black crows. Boom. So when this comes back down to a head and shoulders, inverse head and shoulders, I'll take the trade again. Somewhere right in here at 96 bucks. Now $14 dip. In fact, I'm going to set an alert right there on the bottom of that candle. Right about at 100 bucks. And I'm so pissed off about this. And calls 460. Oh my God. The calls are at 140 now. The puts. The 467 puts that I had right here. And I chickened out because the thing broke my resistance. I was going to hit the 21. I sold it and it bounced. And then you got the double top again. To me, it's all about chart patterns. Just got to keep focused and play them chart patterns. I do my best. A 1 bis, 2 bis freebie. Boom. Bear flag. Ascending triangle, actually. But actually, it's a bear flag because that's a rising wedge. And a rising wedge, see, if I'd have took the candlestick on that, it would have been an ascending triangle, and it should have broke out. But if you take the bodies, it turns to be a rising wedge, which is a bear flag. Many traders will just take the wicks, and they just hardly ever line up, like they did here. But I could call that a triple top, too. And that would be an exit idea. So I'm going to watch this here, SPX right now. Let's see if I can get a reversal play. Oh yeah, look at here. New day low. Damn, Randy. Randy! Tesla reversing, broke out of the linear regression channel to the upside. Whoa! Any chance we see 464? I'm going to check this here. Oh, type in 464. I'm going to watch this SPX. I think we have a better chance of seeing the head and shoulders. See if it holds 466.53. Did you get puts? $466.56, somewhere in there. Damn good job, buddy. I'm impressed. See if it don't stop at this shoulder line here. At 466.50. If it doesn't hold that shoulder line, then yes, we could double bottom right here at 465.70. I'm impressed. Think that's a good call. That is smart thinking, Rick. Ricky. Inverse head and shoulders at 466.50. See it? That's another day. I had 20 contracts of the SPY, and it went up 80 cents. That's $1,600 I left on the table on the put. Yeah, I'm going to watch the reversal here. SPX. The 46.75. $46.75 call. Now the market's scared that the numbers were too good. Just like what Sarah said. Oh, she kind of turned pale face. So we're going to do this intelligently. We had the double top, where Jimmy called the put. And we went below, so we're trading ahead. We've got a shoulder right here, and it touches that shoulder, so we're going to raise that up just a little bit. And it's got to break the 9 to be bullish. And I got in this trade. $46.75 put. I'm going to scalp this real fast. Right there. It's $50. Now I'm going to run over to the call. See if there's anything in the news. Oh, my sweetheart's on there. So that was the 46.75 put. And the 4,700 call at 36,000 in contracts. There's no. I'm going to draw my snake out. Well, here there's two ways of doing it. Go this way. Fuck. Went up another $30. So we're at the 200. We're at the 200 right here. Let's do it. I'm gonna take a risk. 3 black crows on the 1 hour time frame. So there's my pattern. There's this, color this in, see what happens when I color it in. Now this is a real nice trade here. Let's see if we can hold this support level. Change this to 1 minute or 5 minute. There's the bottom of that crow right there. Okay. That's a good call, Rick. I'm impressed. I might have to upgrade you. I think I will. You have now become a trusted and a volunteer, well, not a volunteer, trusted and a contributor. So Ricky got upgraded. And he's a newbie. Do I got the right? January 5th, yeah. Whew. Don't want to make the mistakes. I'm looking at the 4,700 strike. Get in here. Magnificent, get ready to give me a good grade for once. I got to try to see if I can get this a little bit down. Right now it's at 225. I should have grabbed it at 2. Come on. Damn it. This is the 3-minute time frame. Yeah, I'm going to jump in this thing here real soon. I'll get 2 calls at you got an RSI indicator. This is what I like about the RSI when you retest. So let's see what happens here. $2.35 when I could have had it at $2. Okay. When I'd like to trade the RSI, I want to see this one a little bit more divergence than what we've got, but we've got plenty of right now, just enough to get this thing to move up a little bit. There's my 225 I needed. Sue's on this too? Yeah, I know it. CYTX, unbelievable. CYTK. I got out of that trade, but man, it's just for having no cash. Can't wait to see an offering come in on that. Now let's make $1,000 a contract. Doubtful. Zippity doo dah, zippity day, zippity doo dah. $3. Zippity day. Oh, what a life, a beautiful day. Betty, Bam Jam, Betty had a child, Bam Jam, everything went wild, Bam Jam. Oh, Black Betty, Bam Jam. Yeah, baby, go. Why the chips are so strong today? Because they've had such a hard sell-off, and that they're pumping AI. That's the first thing they're going to hit. People are stuck in them people are long in them chips. If you heard the way they talk, you heard some of them today saying they're cutting out. They like Uber. Who in the hell would hold Uber at a double top? Josh Brown, Stain. He would. Does anybody know where resistance is? That's resistance. So you could take and scale some out here if you think we're going to go up. Right there, 420, baby, it's time. Break it. 420. If you're in the trade, take it to the limit. One more time. Take it to the limit. One more time. $420, baby. Oh, woo! $460. I mean, 600. If this thing goes to 1,000, I'm gonna be tickled pink, Sue. That makes me feel so much better. Especially after having two bummer. It's funny. Sue's a good trader. I did notice her little. Magnificent. You can give me a good grade. Ricky, did you get out of your trade? Exactly. Exactly. I'm gonna go get my coffee going here and I'll be right back. This is something to learn. What we created here was an inverse head and shoulder. We had the left shoulder from the day low, at the opening, and the day low yesterday. She came right back to it, created a head, broke out of the head. Now this thing can pull back and hit the top of this here trend, this triple top, 2 bits freebie. It can continue up, but this would be your next resistance. But I'm very glad. Someone in the room yesterday, franchise, said, "Oh, you make that back into scalp." Well, I did yesterday. Oh. I had to get away from this negativity on here. It's not worth watching this thing in the morning. For one, you got that commie Steve Leisman on here. And then you got the snob Sarah, which today she was asking some decent questions. I got very irritated with Steve Leisman this morning when he said Obama was a uniter. So are you kidding me? He started more racial tension in this country than I've ever seen. Wonder why it didn't pull up there. This thing might run up to $1,000. What did Lily pull back today after that breakout? Yep. We got an alert. SPX going up. So I've got you hear that ding? It's my scanner alert on Ready, Set, Go. And I get these alerts.
Welcome back. It's a choppy start to the year for big tech. Piper even saying the Mag 7 has become the Lag 7 and saying they've underperformed SMID cap since the October low. But our trader isn't giving up on big tech, and she's looking ahead to earnings in a few weeks for names that could see pre and post report boosts. Joining us with her 3 buys into bail.
Say that 3 times in a row.
President of options at Simpler Trading. Danielle, great to see you.
She can't say it. That's a tongue twister.
Get to your bail, which is interesting. And the first buy is Meta. What makes this one you want to hang on to, coming off what's been a relatively hot streak?
So I like this stock, Kelly, because the long-term trend looks great. The pullback here was relatively soft into the 21 EMA on the daily chart, but most importantly, they've done really well and they've reacted really well to earnings the past several quarters. So when I'm looking for stocks that may rally going into an earnings report, that's exactly what I want to see.
21
so
EMA.
I like this one.
I said the 21
SMA.
SMA.
Demonstrating today. And I'm going to be trading this one ideally up into about 365, 370.
Okay, so we're at about 352, so that gives people a feel for it. Next one is Amazon. And all of these, are these names that you would buy going into the report and then wait and see, or you think the charts work either way?
So, Kelly, what I do with these is I buy and I hold them in long-term accounts where I'm not getting in and out, but also for earnings specifically, I trade them in the options market. So with Amazon, if I'm going to buy this before the report with options, what I would do is when it triggers to the upside, I would buy those options and ride those options for an increase in implied volatility going into the report, but then sell them to capitalize on that rise in price before a vol crush comes through. So
how does she know this? Girl, you've been listening to Bobo?
They buy it here, targeting about 150, 155. Get out before the report, and then
Finally, somebody with some charts.
Okay, so that would be about $5 of upside from where we are now. I like your optimism on these because not everyone's feeling it. Although Microsoft is a little more consensus, it's only 3% below the November all-time high. You'd be owning this one as well. Why?
She's
why
doing a
do you think
double
this one,
top.
But also, some of the others are going to experience better momentum in the next few.
See, I mean, she's reading charts. She knows that the exit's at 155 at a double top. And she's bouncing it off the 21, which I call all the time. Well, hey, that was the other one, Meta. I gotta listen to this girl.
The problem here is that Microsoft has been a little bit stagnant, and that's the number one criticism that I'm getting. People are saying, Danielle, Microsoft's not moving. And so I'm looking at it and I'm thinking, I'm still going to trade it. I'm still holding it. I would like to see it back up at those previous all-time highs, but I'll tell you that, if this stock does start breaking down, that'll be the biggest canary in the coal mine for this earnings season.
And what would that break down? This is kind of a dumb question. So maybe the upside is 380. That was kind of the late November.
352 at the lowest.
How much downside before you bail?
Let me see. So
before
checking out Microsoft
or so right now on the chart.
So I look at the 50 simple on the daily charts. That'd really be below 365. Let's give it 363. That would be a key line in the sand where I'd say, you know what?
Look at that girl.
To the downside.
Right where I got my alert.
And at that point, I'd be pretty cautious about continuing to hold this on a
I
short
love this
term
girl.
long, but I'm still absolutely going to hold my long-term stock.
All right, that brings us to your bail, which is Apple. It was the mystery chart we showed before the break. It's off to a bad start with a couple of downgrades this year. What do you see going on here?
200
So when
SMA.
you look at Apple, I don't like the way that it reacted to the last several earnings reports. So first of all, that's a bad sign. And when you have that, the stock typically isn't going to rally as well going into an earnings report. So for that reason, I'm not eyeing it for a bullish trade prior to this report. But then also you have some critical breakdowns in this stock. So if you look at the chart, on the daily chart specifically, it's broken down below the 50 simple moving average. That's a critical support zone, and it broke
Do I
down
not have the
by volume
50
as
SMA
well. So
on
whenever
here?
a stock does that, it tells me
God
that there's
damn it.
something wrong with the technical aspect here. So that was one sign, but I'll tell you that the next zone of support is going to be around 180. So
This girl's smart.
breaking that 180 price point, that is a key line in the sand, and that's where we could really see this stock break down. So I've been
Go ahead.
I've been
Who is this woman?
stock, and I
Danielle?
haven't shorted it yet, but I would short it if it breaks 180.
Whew, we're just under 182 now, so that gives you the stakes, people, as we watch that stock as really still a barometer in many ways for the market. Danielle, as always, thank you so much today. We appreciate your time.
Thank you.
Danielle Shea, Simpler Traders VP of Options. This week's losses, by the way, push Apple's 14-day relative strength index below 9. It's the most oversold name by that metric, and for the full list of Wall Street's most oversold names, you can go to cnbc.com/pro. Still ahead, a jolt of construction job openings. We have over 100,000 more of them now than a year ago. To help close that gap, One Trade Group is looking to high schools, and Kate Rogers is just south of San Francisco with that story today. Kate?
She had every one of them right compared to what I
That's right.
have.
17,000 construction jobs were added last month, but as you mentioned, there is a talent shortage that will impact the workforce moving ahead. We'll tell you much more coming up after the break on The Exchange.
I can't believe I didn't have the 50 on here. That was stupid. But this girl's got it right. Very seldom do I see somebody that has it, well, not right, but I mean in sync with how I see a trade. And she's the first chart reader we've had on here in 2 weeks. Let's see where she works at. Shay. I'm trying to think of the name of Shay. I knew somebody with that name. I've subscribed to her. So I've picked her up before.
can change your life.
Welcome back to The Exchange. The construction industry is actually one of the highest paying fields outside of the business world, but it is still struggling to attract workers. As we learned this morning, construction added another 17,000 jobs last month as it remains one of the steadiest growing parts of the economy. But could that number be even higher? The industry is now pairing up with schools to try and fill more roles. Kate Rogers is out in California with those details today. Kate?
Hey, Kelly. Well, you said it. The construction industry is certainly searching for workers. As of the end of November, there were about 500,000 open jobs. That's according to JOLTS analysis by Associated Builders and Contractors, a trade group. That number is up 100,000 from the same time last year, and it's also at the highest level since 2022. Now, one way to fill the gap, of course, get younger workers interested while they're still in school. Southern Nevada Trades High School opened in August of last year, looking to do just that with its first cohort of 75 students. They'll take a full curriculum of classes including English and math, but they also take career technical education in construction.
It's been very popular with families who are saying that the students are maybe not interested in traditional education or potentially not necessarily wanting to go to college. And so it offers an opportunity for those students to come and get hands-on learning. We have an integrated curriculum so that students are constantly being reinforced with this is how what you're learning will impact your future in your workforce and in the trades.
Now, they're certainly going to have options once they graduate from school, as construction and manufacturing spending is continuing to grow, in part thanks to funding hitting the street from the CHIPS Act, the Infrastructure Bill, and the Inflation Reduction Act.
It's hundreds of billions of dollars over the next 4 or 5 years is going to be coming out, and that's going to have a big impact on skilled labor and the shortage we're facing right now.
Now, Kelly, this is an issue we've talked about for many years now, not only in the construction industry, but a lot of baby boomer retirements are taking place, and there just are not enough younger workers moving into the workforce to take those positions as they open up. Back over to you.
And this is, you're at a residential site, but obviously we know huge government spending in construction as well. It seems like roles of all kinds they need, right?
That's right. Yeah, they certainly do need roles of all kinds, and the best news for younger workers who may be considering college but aren't sure if it's the right fit is that a lot of these jobs do pay well. There are technician jobs, welder jobs that start between $30 and $40 an hour, Kelly, and you don't need a bachelor's degree to fill them up. And as you mentioned, this is a residential site, but obviously non-residential construction and the government-funded projects have been a lot of where these openings are turning up and will continue to be opening in the future.
All right, Kate Rogers, good to see you. Thank you so much. We appreciate your time. Coming up, analysts at Bernstein have a warning for Airbnb bears. They say they're looking at the wrong metrics. The bull case for a stock that's already up 55% over the past year. That's next.
Hey, are you sleeping? No, I'm sitting here. What was going on? Man, I got that trade. What one? Posted. What one? Oh, this SPX? What? No, I didn't even notice that you were in it. I wasn't in it. I didn't see it. It's bounced up. It pulled back to the daily double bottom.
Welcome back to the exchange. Bernstein is calling out the Airbnb bears today, saying worries about the company's future volume growth being too optimistic are just flat out wrong. Instead, Bernstein argues Airbnb has outperformed on volume and will continue to do so. For more, let's bring in the analyst behind the call, Bernstein's Richard Clark. Richard, it's good to see you. Welcome.
Thanks very much for having me.
So I'm curious how you, on the one hand, sort of saying, look, the bear case has begun, and yet you remain bullish. What's behind that?
I guess, as we've come out into 2024 and people are very aware of what performance has looked like over the last few years, we've had a few people question the fact that Airbnb has only grown room nights by about 8% on a per year over the last 4 years. And that's a lot less than what the market expects it to grow at over the next 4 years. And so we wanted to have a look at that and say, well, actually, rooms or properties maybe have grown at 8%. But what's really happening, what's the real volume measure we should be looking at is customer numbers, and that's grown more like 10% because the properties on average have got bigger. And so therefore, looking just purely at property numbers is not showing the true volume growth that Airbnb has delivered.
And so how, I understand fundamentally why you need volume growth for the stock to do well, but there's still an argument to be made for, profitability. So just kind of balance those two factors. How important is volume growth? Why do you think that's the real metric people need to be watching?
Yeah, I mean, I think there's a lot of operational leverage in selling travel. I mean, it's a business that doesn't have a very large cost of sales, particularly for Airbnb, because it's very low in its marketing spend. And so if you do deliver that volume growth and price growth, but people tend to prefer volume growth, you will deliver the margin expansion on top of that. So I think it's always been the key metric. That Airbnb needs to show that it's gaining share of the lodging market, and we believe it comfortably has been and comfortably will continue to do so as we look forward.
What do you think is behind the kind of bear case on the stock? Is it that Airbnb has gotten too expensive, that the growth rate has peaked, all of the above?
Yeah, I think that's key. I think one, the stock does trade on a reasonably high multiple, so the bar is set quite high. And I think there's a concern that Airbnb maybe is a value product and needs a value proposition relative to hotels that means that customers will keep using it. So because your average Airbnb on a property level is 40% more expensive today than 2019, that brings about that concern. But actually on a per customer level, it's more like high 20% more expensive, which is much more in line with inflation. So we don't think that value proposition has meaningfully changed.
How can that be the case that the property is 40% more expensive than it was 4 years ago, but the customer is only paying 20% more?
Because the properties have got bigger. So the Airbnb supply growth over the last 4 years has been much more in 4, 5 bedroom houses, and actually the number of private rooms, shared rooms, kind of the origins of Airbnb, that part has actually shrunk over the last 4 years. So the number of 5 bedroom properties on Airbnb is up north of 60% over the last 4 years. So you've seen the average property get bigger. It's housing 8, 9% more customers than they were going forward. And I don't think that's a metric that the company discloses and probably is being missed when people are thinking about the volume and price growth that Airbnb has delivered over the last, through the pandemic.
It's interesting because that kind of goes back to the other question I would ask, which is we've seen crackdowns in New York, a lot of other major cities, which seem to get right at the heart of the offering of Airbnb in the first place. Hey, come, stay in my apartment for a week or something like that. How much of a threat are those kind of regulatory responses?
And less of a threat now than they would have been 4 years ago, because Airbnb has become much more of a rural, suburban, small city product. That's where the business has grown. It's much more international, much more diverse than it was. So New York was less than 1% of sales. No individual city is more than 1% of sales. Very diverse business, and really where the growth is in areas where there isn't incremental regulation coming to bite.
166 price target, $30 of upside, and I think it was in the Internet Mag 7 that we talked about with Mark Mahaney the other day. So it has been on a good run. You're sticking with it. Richard, thanks for joining us. We appreciate it today.
Thanks for having me.
Richard Clark. That does it for the exchange. Up next on Power Lunch, we turn our attention to the national debt at a record high. Congress can't agree on where to spend, and the U.S. could face a shutdown yet again just a couple of weeks' time. We've got the implications and what it will take to get a deal done. Tyler is getting ready. I'll see you on the other side of this break.
much, everybody. Alongside Kelly Evans, I'm Tyler Matheson, and we're watching the markets very closely as stocks are trying to hold on to gains. The jobs report coming in stronger than expected, maybe taking a little steam out of that Fed will cut soon camp.
And some long weekly winning streaks are likely to be broken today. 9 weeks in a row for the Dow, which dates back to late October. Similar story for the S&P and NASDAQ.
I guess I need to...
Down 3% this week. Apple a big culprit there, and the 10-year yield right...
Oh, shoot. Jim, what we're done.
Report 200 created that.
Someone was in the room and was in the SPX earlier today, and I didn't notice. They took a loss, so if anybody's ever down on a trade, and I'm like reading my charts or looking for trades, a lot of times I don't pay enough attention to the chat room. So if you're ever in a bad trade or you think you're really worried about something, private message me, because I see it pop right up and I can get right to it. But that's, you know, if you're stuck in a trade and you need help or you need someone else's advice, private message me and I'll get right to it. But I don't catch everything in the chat room. Because I got so much, I got 4 monitors here, I got 2 on the side, I got 3 on the side, so I got 8 monitors that I watch. And it's hard to, I'm surprised I don't have a cracked neck. It's just hard to keep up with everything. So I've got now I've moved my chat room over here to one of the least watched monitor, which is on my left side, so I can always look at it. I'm always going to look at it. I'm always trying to look at it a little bit more. That's been one of my incentives this year. I got an Apple in there. It's a 2000 and one of the first Apples that ever came out. It's there on the far left. It was the first flat screen that come out, and it still works. I put it up for years thinking that it went out on me, and I plugged it in one day, and I said, damn, this thing still works. So that computer's over 20 years old, almost 19 years old, probably 20. I don't know. I keep thinking I got it in 2004. Might have been sooner. First one I ever got was Gateway. And this was my second one, the Apple flat screen. It's the only Apple product. I probably don't even know how to use it anymore, but it was my #1 where I did my music on, and when I played in band and wrote music, I used that. Some of my very first YouTube videos were on there. This was 12 years ago.
This is Wash Stock Talk. I've been trading stocks for the last 3 years in this economic turndown. I've learned a lot of things, and I'm willing to share a lot of things. Once you get into the habit of doing something, you tend to get better and better and better at it every time you do it. More practice you get, the better you get. I've learned a lot through my own mistakes, and I've learned a lot through other people's mistakes. I've learned a lot from other people's gains, and I've learned a lot from my gains. Not a day goes by where I don't learn something new. So much, every trader trades in their own specific way. No trader trades the same, but we all try to mainstream our trades and to understand and to read into the way the other people trade. So I look at the bigger picture of it, the philosophy of trading. I trade on momentum only, showing supports. I give my supports, I give my entries, and I give my exits. But I only trade momentum stocks, the ones that I can get in and get out, guaranteed. Practice makes perfect. I've hit some pretty good stocks. Having patience, dedication, and watching the trend lines, supports, pivot points, resistance, news, so many things that you can get overwhelmed. So you try to define your way of trading that makes you feel calm, collective, and gutsy. You've got to go with your gut. That's the main purpose of this. It is an investment, it is a risk, and it is tough. But once you practice, and I've been at it for 3 years straight every day. I've invested, I call it my college tuition. I've lost money, and I've made money, and I'm making money. I think having a sense of self-worth helps a lot. Confidence and just patience can really get under a lot of people's skin. People that use foul language should not trade because it creates bad karma.
Damn it.
You know,
I broke that rule.
But, you know, don't bring it any farther than that. The only person you have to blame in a mistake is yourself. So I wish you a lot. I hope you all follow me. I'm on Facebook under James Howard. You can find me with my dog. I post videos up there. I'm also going to open up a Twitter page. I want to soon open up my own website that'll give on-the-spot alerts. And will actually show you how I trade during the trading process, what I do, how I do my homework, how I study. I'm into math, I'm into charts, I'm into the ladies. So I would beg you to keep track of me, watch me, learn with me. We all learn from each other. And I've been known as Wash, Stock, Talk. So hopefully I'll get up here and get in more of a habit of showing my videos and showing my entries and my posts and my ins and outs. I think it's very important when you get into stock to know when you're going to get in and when you're going to get out before you even buy the stock. That way, when it comes to your supports, to your pivots, or your resistance, you know where you are. And I want to thank you, Al Gore, for creating the internet. You all have a great day.
I want to thank you, Al Gore, for creating the internet. That was 12 years ago when I opened up my first website, Watch Stock Watch.
You just said a moment ago, you landed on planet Earth and you saw U.S. inflation at 3% and unemployment rate at 3.7% and payrolls gaining. You would say this is not the time to protectively cut interest rates in anticipation of a slowing economy, you would raise them because the economy is firm, inflation is still alive above the Fed target, and the job market is stable and solid. So how do you get from that forecast or observation of present conditions to conditions where you say the Fed is going to cut 6 times in 2024 because they have to do it protectively against a recession prospect?
I guess I would fall back on the idea that when things fall apart, they fall apart fast. When we have a long-term productivity boom, it's a long-term productivity boom. It happens gradually over time, and its positive effects are felt in the economy over a very long period of time. When the unemployment rate starts moving higher, it tends to move higher quickly. And so things fall apart, they don't gradually erode.
Hey, Mike, look at the daily candle on on Tesla. You probably already noted it. We're bouncing off that 50 SMA. I wouldn't doubt if you've already noticed that.
Of the unemployment report, they are showing increases in unemployment across a number of states. So, I know there's been a lot of talk of the so-called SOM rule for the United States, where if the unemployment rate goes up by enough, then it means the economy's in recession. If you do that on a state-by-state basis, you've got a number of states already in recession.
Value gaps.
More states in recession in November than were in recession in October. And if you kind of put it out on a map and look at it, it looks like a disease that's spreading across the United States. It's not, I think that when a lot of people talk about soft landing and we're talking about a recession, we might be talking about the same thing. It's just that I remember that a recession looks like something out of 1990 or 2000. And a lot of people don't have experience seeing a recession that didn't look like 2008 or 2020.
True, and California, to your point, has seen its unemployment rate rise by at least a point, maybe more than that.
Boeing back to 250.
That's right, New Jersey, we're a case in point.
4 cents off my resistance.
Where does that leave the market? Do you think the market, I feel like it matters to the market if we're going to be in recession or not.
Well, I do think it matters because, I think it matters in terms of, where rates go. It's not just a matter of the Fed funds rate, it's where do 10-year rates go, where do mortgage rates go, and when should you be thinking about risk assets? Right now, everyone's thinking risk assets are great. That could change very quickly if the unemployment rate moves higher and everyone begins to save a little bit more money because it seems like there's a risk that people might lose their jobs. And so when I talk about the economy, rolling over quickly, that's part of the problem is once that dynamic gets moving, it's very hard to stop it. Fortunately though, for the Fed, the way to stop it is to actually kind of lower rates and try to manage that process. And we think that they'll have to do that. Although, to be honest with you, we would have expected that there'd be more weakness by now. But just because there's not evident weakness now doesn't mean that what we're seeing is stuff that points to a strong economy. And I think for those who are looking for a soft landing, if you believe in a soft landing, it means you're going to have a stronger economy with high inflation. And so you have to be thinking either that there's a recession later to get those Fed rate cuts, or that the Fed's going to abandon its inflation principles, and I just don't think that's likely.
6 rate cuts, a quarter point each time, that's $1.50, so that would take rates down to 4% or a little below. Is that what you see at the end of the year?
That's what we're seeing at the end of the year. We're expecting 10-year yields to stay about where they are today, so the curve completely flattens back to straight across the board.
Better than an inverted curve, I guess people would say. Drew Mattis, good to see you, my friend.
Thank you.
Coming up, a perplexing news story. Perplexity is using AI to go after Google's dominant position in search, and it just won backing from Jeff Bezos. Details in Tech Check next. Plus, is it shutdown season again? Congress has only 9 days to negotiate 4 spending bills to avoid a partial government shutdown. We will discuss that when Power Lunch returns.
This is the first week that I've traded without the scanner. Trade ideas. First week. And it just, like posting that video of me back 12 years ago, it brings back memories of how I used to trade, where I had to do a lot more work, a lot more research, where my mind got lazy trading using trade ideas because it became too easy. I made a lot of money using trade ideas. I could tell all I needed to know with trade ideas is which direction the market was going, and then bam, I'd look at my watch list. Without that, I have to rely on other sources. And listening to the first part of CNBC and their politics every morning just drives me a little batty. But when they later in the afternoon, it seems like they get more intellectual. That's just my opinion right now. But I used to watch these suckers for years, and I'd play the devil's advocate with them. That's when they weren't so progressive. They weren't talking politics back then. They would talk about the government, but they wouldn't voice an opinion and try to persuade you to think one certain way or another. That was when Maria was on there. She got involved with some guy, some CEO, and they got her messed up with her job, so she left. She did a little bit of oopsie insider calling there. Now I like listening to Kelly, but Sarah, her snootiness, kind of like me, I guess.
4 million in a round led by some big names. Deirdre Bosa spoke to its CEO for today's Tech Check. Hi, Dee.
Hey, Tyler. So Google has been so far dominant for search for decades that few startups have been able to even raise significant capital to compete with them. Until now, that is. Perplexity, backed by some, as you mentioned, very high-profile investors, from Jeff Bezos to NVIDIA, believes the generative AI shift has led to a paradigm shift that creates a new opening in search. I spoke to CEO Aravind Srinivas earlier this morning on what's changing the age of Gen AI. Have a listen.
I'm going to set...
Search has been about 10 blue links for the last...
I'm going to set me alert just right above the 50 SMA on Google, in between this gap. And that's at 134.04, so that's about a $2.50 dip. And if earnings come out and it pulls back to that, I'll probably jump in. Or if it pulls back sooner. I mean, we could want to raise that up. Oh man, right there. I changed my mind. 134. That's better. 134. I've seen this right here. There's a big gap right there. So I'm sticking with that one. 135.10.
A number of large language models, from GPT-4 to Anthropic's Cloud to Google's Gemini and beyond. And guys, Perplexity, it may represent the next act for generative AI at large. Last year, it was all about enabling the models, chips, and cloud computing. This year, Srinivas and many others here in the Silicon Valley believe that we will see the rise of consumer applications, and mega caps like Google, they may not be the clear winners this time.
How much you'll often hear in situations like this, and it used to be the Jack Welch rule, and that is that
Jack Welch,
if you're not number one or number two in the business,
he was a
you
good
might as well
guy.
get out of the business. You hear about first mover advantage, and that first mover advantage right now would seem to reside elsewhere.
Right, and if you think about the advantage in the generative AI age being data, right? First-party data in particular, nobody has more than Google, and that's why, I asked him, Are there going to be one winner, two winners in the space, just like Google has dominated search with 90% of market share? He says, not necessarily, actually. He thinks that there's going to be more, but he thinks that Google's still going to be valuable with that first-party data, which powers a lot of the large language models out there. And he also thinks that they're going to make a big bet on cloud to kind of offset what may be happening. But this is really speaking to Wall Street fears about Google's position since the generative AI hype cycle began. Will it displace search? Will someone like a Perplexity come up and do it better, maybe a better application built in the generative AI era, or can Google move fast enough? Nobody denies that Google has developed the foundational technology, that it's not necessarily behind, but can they create a product that users really want to use? And we know that OpenAI and ChatGPT was able to front run them on that front.
I just tried it out, had a good answer for how long for a sausage casserole. Gave me little links up top, and it got it basically right. I wouldn't say it's majorly differentiated from the others. Still makes you go through the whole sign-up rigmarole, which early Google didn't make you do.
But that's the thing. It's not that differentiated, and I asked him about the commoditization of these large language models, and that's why he says that this year it's going to be about the consumer applications. What Sequoia published a piece, the VC firm located here in the Bay Area, says that you either got to be close to the GPUs, the compute power, or the consumer. And he believes, and many others believe, that we're going to see companies be closer to the consumer this year, whereas last year it was all about the GPUs.
All right. Thank you very much, Deirdre. We appreciate it, and I'm getting hungry. Deirdre Bosa. Further ahead, years in the making, United Launch Alliance's new heavy-lift rocket, the Vulcan Centaur, is set to lift off for the first time early Monday morning. The mission is to send a commercial lander to the surface of the moon in what would be a historic first if all goes according to plan. Maybe a small step for man, as they say, but potentially a big one for investors. We'll explain next.
Hello, welcome to the Update Aftermarket Wall Street Report with Vegas and Jim. Hello, Vegas.
Hi, everyone. Hey, Jim. How's it going?
Man, great. Great.
Right.
What a great week last week with
my
all them
God.
runners.
It was a crazy day.
I mean,
it's on Friday.
I noticed the volume. Yeah, I noticed the volume's picking up better in the market, so I think it's clean sailing here on the way out till Christmas.
Well, I hope it just continues. I'm really happy picking up, and I was really happy with yesterday on SIN 004 and SIN 010. And let me tell you, a lot.
I miss trading with my Vegas. Right now I'm looking at 16 charts, 4 in each sector. It's hard to see them all.
Welcome back to Power Lunch. Let's get out to Chicago for a look at how this morning's data is playing out in the bond market. Rick Santelli with the latest there. Rick?
Hi, yes, what a wild day. You know, if you looked at some of the key parts of this morning's jobs report, what jumped out at me was 4.1. Let's look at a 10-year chart of year-over-year average hourly earnings. The fact that it was 3.1 to 3.5 pre-COVID, and you can see it on the left side, just shows us that it's been buoyant, and it actually looks like it wants to turn a little higher. The participation moving down to 62.5, that's never good. Look at an intraday chart of 2s, look at an intraday chart of 10s. It's almost as though they did a round tripper, okay? They were right around, what, 438, 439, right around the number. It goes up, it comes back down. So basically we're near unchanged after seeing 439 and 410 on the extremes. But here's the thing, look at how much steeper the yield curve is. If you look at the 2s to 10 spread, hovering at minus 35. This is the big point. This is 2024. Watch out for long-dated treasury rates to be a different path than what many are thinking, short rates, which are going to follow the Fed. Let's go talk to a trader. Hey, it looks like we have Big Dave today. Happy New Year, Dave. All right, so what'd you think of today's jobs number?
Well, I guess it's supposed to be a little encouraging. The market's up a little bit. They like it. Don't know what this is going to lead to as far as all the rate cuts, though. It's not a horrible jobs report.
Damn, I wish I'd cut that one.
Getting some rate cuts here.
Now, when it comes to rate cuts, at the end of last year, we saw the equity markets propelled because everybody's thinking 6, 7 rate cuts.
Yeah,
the Fed's maybe closer to 3, and it's an election year, makes it confusing. What do you think?
So here's my concern with it. Once they start cutting, even just once or twice a little bit, if inflation starts picking up, it could really show that they don't really maybe have it under control.
Ooh, that's a really good point. And you know, there's a lesson to be learned here. We had inflation data out of Europe this week. And they were expecting 3.9 in Germany. It comes out 3.8. All the major publications were like, great news, great news. The previous month was 2.3.
It's not supposed to be good. They wanted around 2%. 3.8, that's not a good number. They're telling us it's a good number. It's not really that good of a number.
Well, the market's telling us it's not a good number. The gilts closed up 25 basis points this week, and the Boons closed up 14. Right now, 2s are up 12. Our 10s are up 14 basis points on the week. So I like your argument. If the Fed doesn't ease, the market's going to expect more and aggressively.
Correct. And if they start easing and all of a sudden inflation's coming off, it might show, wow, they don't have this under control, and we might start to move.
You know, the whole notion of, is inflation going to be linear or not? Meaning, is it going to come down in an aggressive fashion? And maybe it will, but I don't see that happening in the UK. I don't see it happening in Europe.
Neither do I, and we hit, what, 34 trillion in debt this past week?
You know what? In how many places did you hear about that?
You have to dig. You have to dig deep.
You know what, though? You don't need to dig so far. I'll tell you who's going to tell you all about that every minute. 10-year, 20-year, and 30-year yields.
And Rick Santelli. Those are the people that you're going to hear from.
Absolutely. Dave, thank you. Tyler, back to you.
We're going to hear from that.
Someone messaged me with a support level of 80, 180, 20, and I got 180.08. I've been sitting here for a very long time waiting for this. I want it bad. And I didn't get it from that. We hit that this morning. I was tickled as tickle could be, and we bounced up real nice. And I'm going to see where I got this alert from. I'm going to go to the daily. You know where I got it from. The 200 SMA. That's where I got it from. Now this could be, these are huge gap downs. I can't see it going much lower than that 200. But it can. We've got a 178. A couple more dollars less. And if I'm right, that's the EMA, 200 EMA, which could be more faster and more accurate. The SMA is a slower moving average.
And Microsoft, which is in the green today, The reaction by investors here suggests what? I mean, even though this was telegraphed, they don't seem pleased about it.
Yeah, that was really curious. I mean, again, I just read through this New York Times story. I didn't learn much new that hasn't been reported for, that we haven't reported on this network before about what's being looked at into Apple. Again, these are all the same issues that have been on the table for many years now, going back to, 2018, 2019. But again, they did say there was a meeting between Apple and the DOJ as recently as last month, so that is something new. But also this story is saying there hasn't been the so-called final meeting between Apple and the Department of Justice where basically the regulatory agencies come to the company they're about to sue for antitrust and see if they can come to some sort of last-minute agreement or, read them the last rights before the lawsuit drops. That hasn't happened yet. When we hear about that, though, Kelly, then we can say this lawsuit is imminent, and then, of course, Apple will go to trial against the DOJ in an antitrust trial, just like Google did, and we're waiting for that verdict as well pretty soon.
No, great analysis. The shares are only down 0.5% now. The half dipped lower still at about $181. Danielle Shea last hour had just told us if they do go sub 180, she'd consider shorting it. It's been a rough start for them. Steve, for now, thanks very much for bringing that news to us. We appreciate it. Steve Kovac.
And let's go to Bertha Coombs now for a CNBC News update. Hi, Bertha.
Hi, Tyler. Two big headlines involving the New York Attorney General today. First, Donald Trump's civil trial could cost him $370 million. State AG Letitia James argued today that he should pay that price in penalties for decades of financial fraud. The filing came out less than a week before closing arguments are expected to begin.
If you're not a progressive liberal in this country and you're rich, you're in deep shit.
New York civil trial involving the CEO of the National Rifle Association is set to begin. Chief Wayne LaPierre announced that he is resigning. New York Attorney General Letitia James was seeking his ouster in the trial, as well as financial penalties for alleged corruption. LaPierre, who is 74, cited his health as the reason for stepping down. And you won't see any ads from Jeep, Chrysler, or Ram trucks during this year's Super Bowl broadcast. Chrysler parent company Stellantis said today that it won't take out any spots on the big game, as it focuses on cutting costs. The automaker has also pulled out of several auto shows as it contends with falling sales. Tyler, back
All
to
right,
you.
Bertha, thank you very much. Bertha Coombs. After the break, the national debt of the United States hitting a record $34 trillion. We'll talk about that and its impact when we return.
50% off.
Welcome back to Power Lunch. Another government shutdown could be looming in just 2 weeks, although we should be used to it by now. With the total U.S. debt passing $34 trillion, a lot of people are hoping for a more permanent solution this time around. More on that in a moment, but first let's bring in Emily Wilkins to explain where things stand right now. And Emily, the border standoff seems to be playing a big role this time.
The border standoff is playing a big role, the supplemental is playing a big role, and also playing a big role is that Speaker Mike Johnson has made it clear that this is really the last time he wants to be dealing with this. He either wants to get it done, part of it on January 19th, part of it on February 2nd, and that if that doesn't happen, he's just going to continue current spending levels. And look, Congress has spent months working out the details of funding the government, but they still do not have an agreement on the overall amount that they want to spend next year, and that is really critical. It's holding things up. Tennessee Republican Chuck Fleischman, a top House appropriator, told me that the longer it takes to get that overall spending number, the more challenging it's going to be to prevent a partial shutdown in 2 weeks.
Once we get the top line number and the allocations, then it's going to be exceedingly difficult, not impossible, but difficult to get a deal done by January 19th. However, if we could get a top line number within a day or two, I think it's entirely possible that we could put something together.
Now, if they can't reach an agreement soon, 20% of government funding will lapse on January 19th. Now, this includes funding covering the Departments of Agriculture, Energy, Veterans Affairs, and Transportation, plus military construction, the FDA, housing and urban development, a lot of stuff. This could really mean that fewer air traffic controllers will be at airports. It means reduced food inspections and delays in grants for farmers, as well as a number of other impacts really across the government. If lawmakers can't come to an agreement, and if they keep funding the government at current spending levels, they'll also trigger a 1% cut across the board. That translates to billions of dollars less, with defense agencies being hit particularly hard. And when I was talking with the congressman yesterday, he said that really, the shutdown is the worst option. The second worst option is that 1% cut. Absolutely no one wants that to happen, but to do that, they're going to actually have to find a way to get these bills passed.
Emily, thank you very much. Emily Wilkins in Washington for us, setting up our next conversation as a shutdown looms and the debt continues to bloom. Our next guest says the longer-term problem is that our two political parties are so far apart and seemingly unwilling to fix the problem. Let's bring in Aaron Klein, senior fellow with the left-leaning, I'm sort of obligated to say, Brookings Institution. Aaron, welcome. Good to see you there.
Good afternoon.
I'm glad you're with us. Let me try and untangle this a little bit. Emily talked about this being, we don't get an agreement on a top line for spending for next year. As I understand it, this is really spending for this year. We're talking about fiscal 24, right?
Yeah, no, the government runs on an October 1 to October 1 basis, and Congress has kicked the can down the road so far that we're talking about January 19th or February 1st for the funding levels for this fiscal year, which basically runs through this September. So it is about the amount of money that's going to be spent into the economy this year and about whether or not the government is going to have a partial shutdown.
And how much of this dispute, among the many disputes that seem to afflict Washington these days, how much is this dispute tied up with the question of military funding to Ukraine and Israel on the one hand, and border security funding on the other? Or is that sort of a separate issue?
So it had been a bit of a separate issue in terms of the White House's approach to adding a supplemental. This is what we're talking about is the regular money that funds the government for the entire year. What the White House proposed was extra money known as a supplemental, which happens often, to focus on Ukraine and Israel, and we're willing to make some border security adjustments in permanent law, as well as some more money to the border to get that through. So these are two separate tracks that have become interwoven as the political traffic jam backs up.
Do you see a way, let's talk about the broader question, which is the longer term debt situation the United States is in, that matter of overall funding for fiscal 2024 as apart from the supplemental. Do you see a way forward, or are these parties so locked into their positions that a shutdown is almost inevitable?
So look, there's a way forward, but for that way forward, you have to have a negotiation. A negotiation requires identifying the other side. Is the other side House Republicans? Is the other side Senate Republicans? What is it the other side wants? Do they want cuts to discretionary funding? Do they want border security and immigration? You have to have a negotiation, and right now it's difficult to know within the Republican Party who you're negotiating with. Look, this top line number that the congressman referenced before had been agreed to with Speaker McCarthy. Now there is no Speaker McCarthy, and we're going backwards in the negotiation as the House Republicans change their leadership.
I still wonder, Aaron, if we don't have a reckoning going out, because the structural...
You ready?
I don't want to get too technical, but now that interest costs are basically going to be half the deficit for the foreseeable future, and the more we run these deficits, the more we're going to add to the debt, which means we're going to have perpetually high interest costs for the...
You got a head and shoulders support right here, and that's where that was.
How do we get out of that situation?
You got the new one right here. This is the neckline.
As it relates to spending and
Hey, liberal.
revenue, is nowhere on the agenda. That's not a 2024 issue. That's going to require, I think, a pretty strong...
You're getting under my skin already. I hear this every time. Democrats are very smart. They play it very well. Where Republicans just kind of keep their mouth shut. I'm going to wait for this neckline. You've got a two-headed snake right here. Some people call this a W. And this represents the neck. This represents the shoulder. Where was I? Yeah. No. Here. Dingbat. You ready to run, dude? This is the neckline. This is the shoulder line. Right here. indicators saying it's not ready yet. RSI might say it. There we go. Got a hammer, lead out.
BC.
Got an RSI crossover.
Welcome back to Power Lunch. A powerful new rocket is preparing for its first flight, and it could significantly impact the space industry. Morgan Brennan is here to explain, and this is on Monday.
Bingo,
This
baby.
is on Monday at 2:18 a.m. Eastern, and I will be down on the Florida Space Coast. Thank you very much for this. This is a major moment.
Wow.
This is a decade and billions of dollars in the making. The major
Woo,
flight of
go.
United Launch Alliance's powerful Vulcan Centaur rocket. As I mentioned, the liftoff is scheduled for early Monday morning. The mission launching the startup Astrobotics NASA contracted lander, which is filled with government and commercial payloads to the moon, in what would become, if all goes according to plan, over the next couple of weeks, the first time ever a privately owned spacecraft has landed on the lunar surface. Now, Vulcan is ULA's new heavy lift rocket. It's going to replace the legacy vehicles powered by Russian engines. Vulcan's engines are built by Jeff Bezos' Blue Origin. It is a crucial moment for the Boeing Lockheed Martin joint venture. This is the first original rocket that's actually been developed by ULA. Customers include the US government and Amazon. And it comes as the company fields prospective takeover offers. It also comes as the launch landscape has dramatically shifted in recent years. SpaceX launched 96 successful missions last year, which was, by the way, an industry record. ULA, as it transitions to Vulcan, just 3. More competition is coming, including SpaceX's Starship that's under development, Blue Origin's New Glenn, which is under development, has yet to fly, NASA's SLS, which is used primarily and exclusively for Artemis moon missions, and a number of less powerful rockets from Rocket Lab, Relativity Space, and others. The question, is there room for everyone? That remains to be seen, but as ULA's CEO, Tori Bruno, and others have repeatedly told me, with thousands of satellites and spacecraft needing to be launched over just the next few years, a capacity crunch could be coming. We may have more need than we have rocket supply to get everything to space.
What is this vessel going to carry to the moon? It's not coming back, is it, or is it?
No, it's not coming. Well,
So what's it going to leave then?
so the Astrobotic lunar lander.
Yeah.
So it's got 7 different countries. It's got payloads for 7 different countries. It's going to be doing scientific
Some
research.
Amazon boxes on
But
it?
it also has some commercial payloads, including, and this has been more controversial for a variety of reasons, but the remains of some Star Trek luminaries on board. It's not going to attempt to land on the moon until later in February to time it with the sunrise on the moon, which is a very different cycle than the one we see on a daily basis here on planet Earth. It will have exactly 10 days to carry out all of these missions, collect all of the data, beam it back to Earth, and then everything basically shuts down when the sun sets again.
So it's going to orbit the moon for a few days?
It's going to orbit the moon for a few weeks.
A week.
And then it's going to attempt this landing. And by the way, it's not the only commercial lunar lander that is attempting to do this. We actually have a little bit of a competition there too. Intuitive Machines, which is publicly traded, though very small cap at this point, is also preparing to launch its own lunar lander. Remains to be seen which one is going to land first, if in fact both of them land and land successfully.
Is NASA still working on anything on this front, or is it all private sector?
So this is all. So it is public-private partnerships with NASA under a NASA program that basically prepares the lunar surface for humans' return later this decade.
Wow, interesting. All right. I'm not gonna.
It's happening to the moon.
Join Monday at 2:18. I'll be thinking of you. Shares of Peloton surging for a second straight day, getting a boost from its new partnership with TikTok. Coming up, we'll trade it in free stock lunch. We will be right back.
Yep, looks to me like I got burned here on this one. back to that bottom again. I'm gonna add on. We got one. Shit. Oh boy.
Today's three stock launch. We are trading some big movers as we close out the first trading week of this
This has been the hardest
year.
week
It's been
I've
a little
ever
bumpy
traded
here
in a
with our
long
trades.
time.
Art Hogan, Chief Market Strategist with B. Riley Wealth Management. The year may change, but Art Hogan never does. First up, Microsoft, the tech giant, closer to overtaking Apple as the most valuable U.S. company. Your trade on Microsoft, Mr. Hogan.
Hi, Tyler. I think Microsoft's an easy call. Obviously had a great 2023, but if you look at 22 and 23 combined, it's only up about 8.5%. Valuation looks very attractive here at about 35 times. Pays a nice little dividend, and it's got a pile of cash. More importantly, it is one of the AI darlings that is already monetized, and that's the most important piece. I think 2024 will be how do you monetize artificial intelligence? They're already doing it. They've got a head start. They've got the first mover advantage that you just talked about. And one of the So I think Microsoft is a buy here, and it's on our focus list. So we like the stock a lot.
All right. What about JP Morgan? They report next week. They hit a 52-week high again today. They're up 27% in the past year. Are you sticking with this theme of, kind of the juggernauts?
No.
Yeah, that's in the business when you think about the big banks. Obviously, the best balance sheet. That's why it has the premium valuation, trading at about 11 times and 1.6 times on the tangible book basis. Throws off a 2.5% dividend. But we think Jamie Dimon's done a great job of directing this bank to be in the best place that it can be. So what you don't like to do is have a stock making it 52-week high before it reports earnings. Not as nervous about this one. I think this is definitely a buy. Certainly, you may want to wait till after the report, but I would tell you that for the rest of this year, I think the financials, one of the underperforming sectors of last year, is going to get a lot of love. And if you want to have access,
Both Mike and agree that banks, this is their year, but we've had such a great run on a lot of them already. And I'm about ready to just bite the bullet here, but we'll see. $175 down. Just wait. Three black crows, or two major ones. The Randy Jinx? Not yet. Don't count your chickens before they hatch here. Oh. Well, I'm about done here.
Kroger shares are higher after
Come
they
on.
reported just over $26 billion in sales last month, a 9.9% increase from the year prior. Impressive.
New low.
Mostly by
I didn't want to see
e-commerce as
that.
Well, they said comp sales also got a 3% boost on an additional shopping day last month. And
Double bottom, baby.
Tuesday, which fell on Monday.
Let's have the run up.
I contributed also there, and I found great bargains in some clothing for my sons. And it was
They
never
had
bought
some-
clothes there.
We got to stay above 4, 6, 8, 4, 2, 9.
Yeah.
Great bargains.
Great stuff. I got some seasonal candles.
Good meat, good steaks there. All right, U-Haul releasing its annual growth.
It is now power hour, 2 o'clock, 3 o'clock Eastern.
By state, the number one
Double
growth state
bottom.
in 2023. Texas for I think the 6th time in the last 8 years.
Wow.
Rounding out the top 10, Florida, North and South Carolina, Tennessee, Idaho, Washington, Arizona, Colorado, and my home state of Virginia. California saw the most net losses of one-way movers, thanks in part to the rising cost of living there. Many of the states that are attracting new people obviously are low or no state income tax. And by the way, Texas has the most Fortune 500 headquarters
Excuse
of
me.
any state, 53.
Good job, Texas.
All right, thanks for watching Power Lunch.
Closing bell starts right now.
I love you, Kelly.
All right, Kel, thanks so much. Welcome to Closing Bell on this Friday. I'm Scott Wagner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with the state of stocks. Given this rocky start to the new year, we're going to ask our experts where things could go in the weeks ahead, including Tom Lee. He's coming up in just a few minutes. In the meantime, your scorecard with 60 minutes to go in regulation looks like that. It's been a pretty volatile day following that stronger than expected jobs report, but then weaker ISM services reading. So we're in the red, modestly so, across the board. Let's zero in on tech for a moment, given the NASDAQ's down about 3% this week. Boy, Apple worst performing mega cap this week after a couple of downgrades there. Yields, they've been up and down as well today, and that's a big reason for the
And I got the MACD chart here somewhere.
Think a jump after the jobs report, a fall after that ISM, and then another rebound, which definitely seems to be hurting equities. The 10-year now sitting above 4%. There it is, 404. It takes us to our talk of the tape. The slow start to 2024, and what lies ahead with some critical data and earnings looming next week. It's all coming fast. Let's welcome in Courtney Garcia, Payne Capital Management Senior Wealth Advisor, with me here at Post 9. Happy New Year. Welcome back.
Happy New Year. Thanks for having me.
So what's your big takeaway from the way this year has started?
The big takeaway is what we saw in October, where everything rotated, right? Out of the Magnificent Seven that was the place to be in the early 2023. Everything has shifted now, and you're seeing your interest rate sensitive things like small caps, real estate, energy are starting to outperform. And I think that's only going to continue as we look into 2024, and that's where you're seeing some of the euphoria with artificial intelligence is going away. People really want to see that actually reflected in earnings. I think things are going to go back to fundamentals, and that's where we want to look at some of those value opportunities.
I mean, it's not like you've had, a ton of money coming out of mega caps and going into the Russell. I mean, it's been a pretty equal opportunity sell-off. I mean, the NASDAQ and the Russell both are down about the same on the week, each more than 3%. So what is that telling us?
And I don't think we want to too much extrapolate from this 1 week. I think really if you go back the last 2 months, I think that's actually going to show a stronger picture here. And some of that is you're going to get, people are just taking profits across the board right now because it's kind of interesting, but the investor sentiment levels have been overly optimistic.
That's bearish.
But at the same time, and we're seeing this with our clients, people are still very cautious and they're keeping their cash on the sidelines. If you look at cash levels, the end of
the
last week of December, cash levels actually went up. Meaning even though people say they're optimistic with the markets, people think the interest rates are coming down, they're still keeping their money in cash. I mean, they're not actually ready to get in the markets. They're not actually believing that those money market rates are going to go down. And it's not necessarily we're advising, but you're definitely seeing that right now.
But does that mean that, some of that next leg is going to be a bit muted because there's just not enough?
Okay, we got MACD crossover on the 1 minute.
I would actually say that still leads to an opportunity because
That's what I'm going to trade this off of.
I think people aren't overly optimistic. They're not throwing all their money into the markets. You're not seeing that euphoria. I actually think that could lead to a further upward trend.
You sound like you're a believer in the idea, though, of that rotation being longer lasting. Money coming out of mega cap winners and going into other unloved areas or small caps or what have you.
Absolutely. And we're actively talking to our clients about right now because if you didn't rebalance your account so far, you're going to be overweight in technology in those 7 companies. And especially, I have a lot of people who say, oh, no, I've got an S&P 500 fund and a total market fund. I'm good. You have no idea that about 30% of that is those 7 companies. And if you haven't made a change in your portfolio, you're going to want to take some of those profits and add to other areas. I'm not getting out of the Magnificent Seven. I just want to take some profits there and take some better opportunities.
What if it's a giant head fake, though? I look at that ISM services today and I say that's the one thing that you cannot have deteriorate. Mm-hmm. This whole notion that, even Janet Yellen, the Treasury Secretary today, said in an interview that we can describe what we're seeing now as a soft landing, and my hope is that it continues. But what if the economy continues to soften a bit more than it is now? Still stays out of recession, but continues to be a little bit weak. Doesn't that take some of the oomph off of those other more cyclical and small cap areas of the market?
Not necessarily, because we need the economy to soften to a certain extent so that interest rates do in fact come down, right? Expectations are there, but we need a softening for inflation to continue to come down. It's just we don't want to soften so much we go into a recession, right? So it's that kind of perfect scenario that we need to get into. And I think that's what you saw with the jobs numbers today. It was kind of bringing into reality the fact that yes, the economy is softening, but we still have a really strong labor market. And I think when people are expecting those 6 to 7 rate cuts next year, probably getting a little overly optimistic. I think rates are probably still coming down, just maybe not as much as people had gotten excited about in the last 2 months. And it's probably going to be a little longer.
I'm sorry to interrupt you there. I don't know many people, if any, that are expecting the kind of year that we just had to be backed up in terms of, performance out of the S&P, 24% or whatever. But what's in your mind as to what seems realistic for the S&P? Mid single digits, high single digits, low teens? What sounds reasonable to you?
When you have a year like last year where the markets were at double digits like they were, you actually tend to have like a mid single digit year next year, but again, in the upwards direction. So I think odds are on your favor that we'll continue to have a positive year. We're going into an election year. I think things are actually, especially as interest rates come down, leading up well to that. So yeah, I don't know if it's going to be the same kind of outperformance last year, but specifically.
My next indicator is for this 21 to cross, the 9 to cross the 21 here.
That's what you need to be aware
But you think it's coming
We're
from the left.
got to stay above the
Healthcare,
9 right
the
now
energy,
to
and
squeeze.
small caps. Well, why healthcare and energy?
Both of those are actually going to be beneficiaries of, well, specifically healthcare is going to actually be a beneficiary of lower interest rates, right? I mean, you're going to see more M&A activity. You're going to see as they need to borrow money, it's going to become more feasible for them. So I think you're going to see a lot of that as we go into 2024.
Yeah, what about energy? I mean, energy's a big wild card. You got a lot of people trying to get on that side of the boat, saying, okay, you know, it had a great year a couple years ago. Last year was a total dud, and now's going to be the year yet again because supply-demand is still out of balance. Well, what's your take?
Well, I think that's the big thing. It's just a supply and demand question, and I think that really still leads into our favor, energy, and specifically a lot of the energy companies back in 2020 when prices really went out of whack, they had to become so much more efficient. So kind of regardless of what's happening with energy prices, as long as they stay relatively in the range that they've been in, I think those companies are going to continue to, you know, show the good profits that people are hopeful
What do you feel like is riding on next week's CPI? You know, today you have these, as we wrote in the top, we have these gyrations in interest rates and also in the performance of the markets. You know, the jobs report comes out, wages and the jobs report are a bit stronger than expected, so yields start to tick up. Then the services report comes out, yields tick down, and now they're moving back up in the 10 years at 404. What's the area that you get concerned in?
I think we need to continue to see inflation coming down. That's the ultimate thing. And I don't think one number is necessarily going to affect things too negatively. It's not going to be this perfect straight downwards trend. But I think over time we need to continue to see those numbers come forward because ultimately the Fed has said over and over again they're data dependent. If the data doesn't support them pausing and lowering interest rates, you're not going to see that happen.
But I just wonder, you know, because the market was so uneasy, it felt this week, you know, even though, as you said, 1 week doesn't a new story make necessarily, that a disappointing CPI is going to have maybe a larger impact because we're already kind of wondering, okay, maybe we were a little over our skis on the idea that they're going to cut 6 times.
And I think that's the big thing. The cutting 6, if not 7 times, depending on what you look at, that's the thing where I think probably people have gotten a little bit over their skis. And so any little bit of poor information, people are going to start to realize, okay, maybe it's not going to be that. The Fed's only said it's probably going to be 3 times. But bigger picture is I think likely interest rates are still coming down. But yes, you're right. I think some of that exuberance of the 6 to 7 times is probably going to come back.
Let's bring in CNBC contributor Stephanie Link of Hightower into the conversation. Steph, it's great to add you. What's your big takeaway then from the way that this week has started and this year has started?
That the economic data is supporting the soft landing that all of us are talking about. I always worry that when we're all talking about the same thing, but you got to look at the numbers, Scott, and it's not just the job report today. I mean, look at ADP, look at Challenger Gray, look at initial claims, which is a leading indicator. That's at 207,000 4-week moving average, so far from a recession. But then I also look at durable goods, and I looked at factory orders, and those numbers came in better than expected with business spending intentions going higher. So there are parts of the manufacturing part of the economy that are seeing a pickup because of the onshoring, the reshoring, all the infrastructure bills that have been put in place. So you kind of add it all
We got
up,
the 9. We got the MACD crossing.
Obviously, we all want to see the inflation numbers come down so that the Fed can cut
To the
but
upside.
It's not. It's still at 4.1%. It's still okay, but it's elevated. So that's why I don't.
We got the histogram to the upside,
6 times this year.
and we got the TTM squeeze getting ready to squeeze.
Massive decline and a turnaround to the downside in the economy, and I just don't see it at this moment in time. So
But I'm
the 3
just a little
takeaways,
too far
I
out.
think fewer cuts. I think better earnings, and I think the consumer has actually been really strong. And I'm really encouraged by Costco. And I know Costco is a beast in itself, but you had 100 basis point acceleration, x the 1 extra day that they had this month from the first quarter, 100 basis points acceleration. And you had a 400 basis point acceleration in non-food purchases. That's discretionary. So my thinking is maybe services is coming down a little bit from the torrid pace that we've seen, but maybe that we've seen the bottom in the goods side of the economy and the goods buying in the economy. So let's keep an eye on it, but I'm pretty encouraged.
hate this.
You start to
Sitting here
worry
and
at what
waiting.
point that the strong numbers that you always cite as a point of strength in the market
Everything
story
says go.
undercuts the cuts, and then the market has to reprice itself.
Well, I think that's what we're dealing with this week. I think 6 cuts got way ahead of themselves. I definitely do not think they're going in March. I think maybe they do 3. We'll have to see. I mean, we're all data dependent, including the Fed. So CPI number next week is huge. And
We
the
are
PPI
not all day.
well, and the earnings, we'll listen to what the companies have to say and how they're dealing with all of these but I do think whether the Fed cuts 3, 4, 5, 1 or 2, earnings are going to come in better than expected because demand is actually better than expected. And I really feel very strongly that the margin side is going to stay strong, especially because wages are coming down, input costs are coming down, supply chains are getting fixed.
You agree with that comment, Courtney, that earnings are going to come in better than expected that Steph just made?
I do, actually. And I think the idea that this earnings recession is ending and we're only going to see improvements from here, I think is really what we're looking forward to. I think she makes a really good point that the consumer is strong right now, right? Ultimately, we are a consumer-driven economy. And even if wages do start to come down, people are starting to spend into their savings. That they've
I said earnings are the big deal over the Fed.
You have the means to
Others are saying the Fed, but they've outpaced the Fed. Earnings are the very important deal here to make the. I don't think they give a crap about the Fed right now. But it's like that one guy said, we know that they stopped raising rates, so that's all we got to worry about. It's not how many cuts we get. And I think earnings is going to be the big catalyst still. I've already said that for the last 2 weeks. But
are tremendous. And the free cash flow, let's just say healthcare and energy, let's just take those two. I mean, the free cash flows in both are substantial.
See if we get this back up to resistance level.
We've had almost $400 billion in M&A, and it's gone practically unnoticed. And I think you're going to see a real step up in that in that activity in the healthcare space. But by the way, you're now all of a sudden starting to see it in energy.
50 SMA,
with Chevron,
what we got to break.
And Exxon, they're
Not I'm going to get out of it a little bit green, not much.
Of these really cheap valuations, so both sectors think their sectors are cheap and companies are cheap. And so do I. And so I think you can see real returns and a catch-up trade this year. I'm not giving up on tech, Scott, but I do think there's better value elsewhere, and it's encouraging.
Let's talk about a couple things. I wanted to ask you about this adding to energy and the fact that you used to be in Chevron, talked about it all the time, kind of got fed up and sold it, and now have bought Exxon. So give me that first, and then I want to go a little bit deeper on this mega cap tech conversation.
Yeah, no, I mean, look, Exxon, they've been executing a lot better over the last couple of years versus Chevron, and that's a reversal. And so it's a little frustrating with Chevron and the charge-offs and the write-downs that they have to take. They're not immune, I know, but they seem to be more frequent. And so I just didn't think that it paid to kind of wait. It's cheap for sure, but I like the better operator. Exxon has about $38 billion in free cash flow. I love the Pioneer acquisition. As opposed to Chevron, the acquisition that they made actually is more focused international, and I'm not as crazy about that. So, because I think the Permian deal for Exxon is really a good one, and they're going to be the #1 player there. So, 5.7 times versus 7.9 times for its 10-year average with a good yield. So that's why I added to that one. But by the way, I'm now 700 basis points overweight energy relative to the benchmark.
And you're underweight, things like Apple, even though you own it, which is where I want to segue to. So it's been an interesting week, to say the least. It's the worst performing mega cap tech. It's down 6% in 1 week. We rarely get downgrades on that stock. This week it got 2. Now you got the New York Times headline about regulators, looking at the possibility of an antitrust case, which on an intraday basis took that stock lower, and then for obvious reasons it took the market down a bit with it. They weighting out of the S&P, the Qs. It's accounted for 20% of the Qs move this week too. So it has such a large influence on everything, and the Dow too, of course. What happens if the market has an Apple problem?
There's a very good chance the market has an Apple problem. It's 7% of the S&P 500. And I don't know why anyone wants to pay 30 times for negative growth.
Exactly, baby.
Many times, and I'm very small in it. And in fact, on Tuesday we talked about I'm inclined to sell the rest of the 50 basis points that I have.
This gets me how they were pumping Apple. They only pumped Apple because it had the biggest market cap, and I don't know. I'm not an Apple fan to begin with. I think it's a great company, and at one time I loved it. Steve Jobs. But they got too enbraven with China. Too dependent on the population of China. So what they do, they go to India. And I'm just not, sometimes it's not the population that matters.
Yeah, for sure.
Yeah, Amazon's green, Nvidia's green. You know, so the Qs, by the way, are still green, albeit slightly. But what about this notion, Court, about, you know, Apple being upset for a bit? What does that mean to the market here in the early part of the year?
It is a problem where it's such a large part of the market, especially as indexing becomes so much more popular as an investment option. If Apple goes down, it's going to take a lot of that down with it. And that kind of goes to what I was saying, where you want to make sure you're taking profits from some of those things, adding to other areas, and not just throwing all your money in an S&P 500 fund. Because by doing that, I don't think a lot of people realize how much you are putting your money into Apple and Google and Microsoft and Amazon. If you are, look at an equal weight rather than the traditional S&P 500.
But see, that's why we bring it up, because there are a fair amount of people who invest that way, or at least it's part of their investment strategy. You own one of the index funds. And that's why we talk about the stock all the time, because the size of the weighting that it has, the influence it has, and why it matters so much if it goes through a period of some kind of upset. Remember, that stock was, you know, 167, 169, then it had this run in the upper 190s towards 200 as the overall market ripped from the end of October to the end of the year. If it goes through a period and some of these other mega caps can hold up, that's all good. Nothing to see here. If it's picked up by other areas,
to a certain extent, it's such a large section. I mean, the overall markets are going to feel that, right? And you're saying a lot of people invest that way in indexes. I agree. I think it's a great way to invest. I think a lot of people forget there's a lot more indexes than just the S&P 500. You can look at the Russell 2000. You can look at your international companies. You can look at alternatives like real estate and energy. There's so many more things than just the S&P, which people think is the entire market. So it's not the only index you want to buy, and I think that's what we want to point out here.
Steph, what happens if there's no cut in March?
I think that's what we're starting to price in, Scott. I really do.
No, I feel like we're pricing it back up. I mean, I'm sorry to interrupt you, but if you looked at the way that the market is now pricing March, it's when the jobs report came out at 8:30, you know, it was stronger than expected. Okay, so the probabilities go down a little bit. Services comes out, and it's like, oh, okay, well, now we're back up to what it was like 74% around noontime today. But what happens if we don't get the March cut?
I mean, if we don't get the March cut, that means the growth is better, and actually that inflation is probably around the 3.5–4% level. That's why these CPI numbers are super important. But in today's jobs number, I mean, it implied that productivity is going to continue to go higher. Unit labor costs are coming down, and so that's very positive for inflation over the long haul. And if you look at the quit rates in the JOLTS numbers yesterday, I mean, that's a leading indicator, and the quit rates fell pretty substantially. And so that's a leading indicator for wages. And so I think we're going to see inflation come down, but growth remain elevated. But wages and inflation isn't going to come down enough for the Fed to really say, okay, we can actually go. I don't think it matters. I think as long as the growth can hang in there, earnings are going to hang in there. And that's what we need to pay attention to.
Let me ask you this. I'm looking at a journal headline right now that says Southwestern and Chesapeake near a $17 billion merger. It just speaks to, you know, what may be in play this year. More M&A, more deal making. I mean, this obviously is straight out of the energy patch. But when I read you a headline like that, what's your reaction?
It's exactly what I expect. It's exactly what we've been seeing from some of the big companies. But you know, these smaller companies see value in getting bigger and getting scale to compete with the big guys, right? So especially as the big guys are getting bigger. So I think the free cash flow, look, cash break-evens at Chevron and Exxon is about $35 in oil. Where are we today? We're double that. So these companies are minting money. So I would much rather see them do M&A versus overproduce and also return the cash to shareholders, which is exactly what they're doing. And these stocks are trading at 5, 6, 7 times earnings, which is nuts. So I like what I hear, and I think, look, I mean, the S&P 500 energy is about a 4% weight. No one is there. Even though a lot of people like it, I think there's more that can happen where we can see it be a larger contribution to the weighting overall.
Expect more deals?
Absolutely, yeah. If rates come down, we think they will. That's absolutely going to lead to more M&A. That's going to affect energy. It's going to affect healthcare. All the things we're talking about. That's a big part of that.
All right, great stuff. Courtney, thanks. Good to
Thanks
see
for
you
having
again.
me.
Steph, thanks as well. We'll see you soon. That's Courtney Garcia and Stephanie Link. Let's send it over now to Christina Partsinevelos for a look at the biggest names moving into the close. Christina.
Give me my rent. Shares of Medical Property Trust are plummeting today. The nation's largest hospital landlord stock dipped about, well, look at that, 29% right now after the company announced that one of its tenants, Steward Healthcare System, is $50 million behind in rent payments.
God.
Meanwhile, a quarterly profit beat is pushing
50
consolation
million?
trends higher, although the wine and spirits distributor missed sales estimates and cut its fiscal year outlook. The company saw an 8% drop in wine sales amid a nearly 12% plunge in wine shipments.
STZ.
The company anticipates its wine segment will experience, quote, near-term headwinds. I guess customers weren't there or here for the right Riesling. Scott?
Very funny. We'll be back with you shortly. Christina Partsinevelos. We're just getting started here. Stocks struggling to start the year. The S&P is down just this week. Up next, we're going to hear from one of the biggest bulls on the street, Fundstrat's Tom Lee. Let's see what he makes the case for in the weeks ahead. We're back after this.
Well, this MPW, man, it don't sound too good. I don't see how you can be a landlord and let somebody come $50 million behind rent. How can you fall back so far in rent? This has been one of the toughest weeks I've had in a while. For me. I'm green today, but losing $260 ain't making me green. I might as well just this looks promising. Look promising right here. Need the volume indicator. Oh, I don't think it shows up on the SPX. Yeah, that's it. Come on, baby.
We are back. Stocks off to a rocky start this year. The first week of trading, the S&P's been down about 2% or so. Joining me now to discuss what it could mean for the trajectory of the market this year, longtime bull, Fundstrat's Tom
Walk
Lee.
away for a second. I'll be right back.
Happy New Year, Scott.
Are you wavering at all by virtue of what's going on this week?
We're not wavering, but it's clearly not a good start to the year. I mean, markets almost got to an all-time high at the end of last year, and the first 4 trading days of this year have been really terrible. I mean, I can see what the market's struggling with because, as your guest previously talked about, part of it is when the Fed cuts, and I think people are still jumpy about a strong labor market and if inflation is softening. But our base case still remains
Somebody got to clap.
We're going to see all-time highs in January, and then I think the market is tough in the first half of this year because of some of those things, but we'll overall end up strong by the end of the year.
Well, you're not rethinking your own outlook at all by how. I mean, you obviously sound somewhat concerned by the way this year has started. Maybe it didn't go according to your plan. So how's that all factoring into your psyche?
Well, yeah, I mean, I think it is disappointing because, the year tends to play out in January. So the fact that we're, sort of had a failed Santa Claus rally in the first
We did not fail.
5 days is pretty important, and the market looks like it's going to be negative. Just tells you that the fundamentals, which have been improving, aren't necessarily going to convince investors to be buying stocks. So I do think it's telling us it's going to be a tough year. But the reason we're not wavering is that the reasons we think 2024 will be a good year for stocks has to do with the fact that the PMIs are bottoming and inflation's falling like a rock, and the Fed has pivoted and is now managing a business cycle. I mean, those are really good anchors and supports for why stocks can do well, but it's not a great start. I mean, it'd be much better if we were up for the week.
Yeah, well, I mean, bulls would feel better. What about this ISM services report? I mean, I know you talk about PMIs, but is that concerning to you?
Well, it's there's pluses and minuses. I mean, to me, I think the ISM services employment number and the manufacturing number show you that the labor report we got today may not be as strong as it looks, and I think that's actually good.
That's just exactly what we haven't been told that.
Signs of rejuvenation. I think the trend there is sort of softer.
Everybody's boasting about how good the labor report is, and this guy says it doesn't look that good at all. So, where's the misjustice here?
Housing growing at 3% is fine. That's consistent with 2% inflation. I think inflation is going to eventually be viewed as, approaching target, and that's actually good. So, Scott, the data isn't always in a straight line. I think it's a little.
Okay, I'm going for it.
I think it is disappointing to see, but I think
add it on here.
Quickly turning bearish and then put on their hard landing or skeptic hat or the Fed hawk hat, and I think that's going to prove to be a mistake.
So you look for about 10% out of the S&P, but more or less is what you think we're going to do from here. How many cuts do you need to get that?
Well, it's not as dependent on cuts as it's dependent on really inflation approaching, what we'd all accept as close enough to 2%, so that the Fed is no longer fighting inflation. So it's not going to be as important as cuts as really sort of the quality of the inflation data. And I think the second is that, we do need to have a rebound in earnings and global growth, which I do think is underway. And, as you know, inflation is normalizing outside the U.S. And when you have that combination of inflation sort of normalizing and real growth recovery, I mean, that's good for stocks. So it's not dependent on the number of cuts.
Well, I don't know. I could almost make the argument that it's one and the same. I mean, if you get the number of cuts that the market has seemingly priced in, it means that inflation has continued to move down rapidly towards target. And if you don't, it likely means that inflation has gotten a little bit more sticky than the bulls had wanted it to be. So it impacts the ability and the wherewithal of the Fed to actually start cutting rates and doing it nearly as many times as the market still expects.
Yeah, I hear you. I think the problem people have is when they talk about cuts, they're assigning singular drivers for it. I heard someone say, well, if they make a lot of cuts, it's because the economy's in trouble. That's not the case. The Fed could be cutting rapidly because they've concluded that inflation is actually approaching normalization, and a nominal Fed funds at 5 3/8 or almost 5.5% at the upper end
is not appropriate when you're at 2% inflation. I mean, that's 3% real Fed funds. At the same time, the Fed may not have to cut. The market could conclude this by seeing interest rates fall. So we could be in a situation this year where the 10-year is at 3.2%, and FOMC members may be wavering, but the stock market will rally because it knows the Fed is behind the curve and needs to cut. So I guess this is the reason why I'm saying the cuts aren't as important as really the quality of the inflation improvement, and maybe it's more important to see what rates actually do.
Before I let you go, I want to ask you about Apple. I know you're still bullish on mega caps, but you don't expect them to outperform to the magnitude that they did in 2023. This stock has obviously not looked good this week. It's down more than 6%, variety of reasons, and we listed them earlier. Downgrades, chatter about antitrust, etc. If the stock goes through a period of upset, as I asked our prior two guests, I want to ask you the same question. What happens to stocks?
Well, it's, FANG, the destiny of S&P really does hang on FANG because it's such a large weight. I don't think FANGs are sell this year because, they actually derated over the last 2 years. Their earnings outperformed the stock price performance. But you are getting periods like this where, people get nervous. It's one reason why I do think the story in 2024 is going to be a lot more about small caps and sort of some of the laggard groups. Financials are our number one large cap sector pick. But I mean, if I owned Apple, I wouldn't be a seller here. Their franchise and sort of returns on investment are still enviable. So, if it's down 6% but was up 44% last year, I think people have to kind of look through that.
All right. We'll leave it there. Tom, I appreciate your time very much. We'll see you soon.
Thanks.
All right, Tom. That's Tom Lee, Fund Strat. Up next, trading biotech's bounce. That sector's seen some strength lately for a change. The XBI up more than 20% over the past 3 months. Hedge fund manager Michelle Ross joins us next with the top names she is watching right now. It's ahead of the big JP Morgan Healthcare Conference as well.
What was green is now red.
Come back on Closing Bell.
Niles at 807. Quit tripping me out. If I get 50 cents out of this, right now we're at 25, and I'm too far out. Well, I'm above where I need to be. I got a ton of this shit. Cheap. Come on, a little bit more. That's a nice car.
Welcome back. Biotech under pressure today, but up more than 30% in just 2 months. Bouncing off the lows set in late October. Group in focus at JP Morgan's annual healthcare conference, which is set to get underway in San Francisco next week. StemPoint Capital CIO and managing partner Michelle Ross with me here at Post 9 to discuss. Happy New Year. Nice to see you.
Happy New Year. Nice to see you as well.
All right. So is this bounce believable? Because it's been a rough stretch of 2 years plus.
Absolutely. And what we are seeing is clearly there's a macro tilt to this. We have inversely correlated from the 10-year, and as yields had gone up, we were under pressure. As they came down, biotech definitely made that move. But I really want to be clear, there are fundamentals that are at work here that are making this longer term in nature, in our opinion, and we actually believe we've seen the lows
Tell us some of
last
the
year.
fundamentals that lead you to believe that.
Yeah, so obviously we're very focused on the science and the scientific advancement we've seen, the clinical trial data that could be a meaningful impact to patients and ultimately change the standard of care for a number of different conditions. And the second, the very big one, was M&A, and is M&A. It's been something that is a key piece of our sector and had been kind of frosty and frozen there for a few years, and it was one of those effects. It was kind of slowly and then suddenly all at once it did show up in Q4 in a big way.
Thank you, Bristol Myers, right, which went on a spending spree.
Yep.
And you expect more of that. Does that ball really get rolling out at the healthcare conference out in San Francisco?
Well, it's a great question, and I think there is a little bit of a trepidation from my peers in the industry thinking that, did we just pull that forward? Did we pull forward some of these announcements? We had 6 deals in December. And as you mentioned, Bristol Myers doing 2, AbbVie doing 2. It was something that really could have been the expectation for that conference. So I don't want to say that by any means I'm making a statement on that conference and timing, but I would anticipate 2024 has more in store.
So what's your assessment of the weight loss craze? By now the story's well known for the stocks that have been bought as a result. Novo, Lilly, maybe 1 or 2 others. Is that played out? Does it still have legs? How am I supposed to think about that as an investor when all I've been hearing about is this class of drugs?
Yeah, I think it is a tremendous market opportunity. I think what Lilly and Novo have done in truly creating something that peak potential is in the hundreds of billions of dollars. I mean, that is staggering, and something that, we do look at as what is going to happen in the evolution of this. Now, for us, and what I would state, is there going to be next generation and additional compounds that can truly allow this to grow to a larger degree, meaning taking this to an oral pill. That would be the next generation, or looking at ways to change the side effect profile or augment it to prevent some of the, side effects that people are seeing right now.
Are there other companies that I need to keep my eye on as a result of what you're talking about?
Yeah, I would say that one in particular that we focused on is a company called Keros. And Keros does look at the opportunity to prevent some of the salvage of muscle, so muscle wasting that people have commented on in the past. Could you look at this as something to augment, as well as a number of other companies looking at the oral aspects of being able to bring this as an oral product in the future?
You own this name?
I do.
You do. Other names that you brought that I don't think I've ever talked about before, maybe we have, and I just don't remember. Syndax is one?
Syndax.
What do they do?
Syndax is had a wonderful year end in 2023, and that was on the back of 2 very important data sets that it presented at a medical conference in December. And the reason it's so important is these are late stage clinical trials that were successful. They are now with the FDA for approval, and they're both in the oncology indication. They're areas of unmet medical need. This will have a massive improvement for patients going forward, and we think the market is primed for them and what they're going to be able to do.
All right, we'll keep our eye on that one, ticking higher by about 2%. What about Cabaletta?
Yeah, Cabaletta, as a scientist by training, it really makes me excited what Cabaletta is working on and doing. They are looking at something called cell therapy, something we've been familiar with in the oncology, in the cancer setting. They're taking that now to the autoimmune setting. So very hard to treat conditions where the immune system is at the core, at the center of this. they are resetting the immune system and recharging our T cells in our body to basically have phenomenal results. Cabaletta is one of a handful of public companies doing this. Very exciting year ahead for them.
What about election year politics, which in a general election year is typically not good for healthcare because both sides are just teeing off on the drug companies? How should I think about that?
No, it is a very important point. We have typically looked at and seen different things happen going into an election year. It becomes a very bipartisan issue. The rhetoric does increase. I would say, though, there was a win that Biden can claim from this year, which was through the Inflation Reduction Act. He did put into place an attempt to lower drug pricing over the next few years. Now, that could be looked at as a win on his side and something that is not going to come out as what could continue to be done for this class going forward. So I think time will tell. It is obviously part of the volatility that we experience consistently looking at this space.
Last question, since we started talking about rates, why this sector really seemed to get jump-started as the 10-year went from 5 to 4. What happens if it's sticky here for a little bit?
Come on, jump up just 10 cents.
The thing about biotech investing is the amount of dispersion that you can find, and why I'm so excited to be able to talk to you about great advancements and new themes and new approaches. And we talked about this last time
35.
with the GLP-1 class working despite where the 10-year is going. So macro is a piece of this, but it is by no means the entire story here when investing in biotech.
All right, you'll keep us informed about the names we need to know. Thanks so much.
Thank you so much.
All right, it's Michelle Ross, StemPoint Capital, joining us. Up next, we're tracking the biggest movers as we head into this Friday close. Christina Partsinevelos standing by once again with that. Christina.
Well, Boeing shares no longer out of favor with Wall Street, and one analyst is arguing that the AI hype has yet to materialize, and that call is hitting one software name. Details next.
Well, okay, lady. Get it. 40, 40, 40, 40, 40, 40. I need 4,700. There we go. Now I'm even. But not out. There we go. Come on, stay. Give me 5. 5 more. There we go. I'm out. Nope. Now I am. Come on. 45. Bam. What'd you have, franchise? 95 cents. I'm all out now. Fuck. What a treat. Unbelievable. Malachi? Randy? Biden's going to speak about democracy. That was his speech today. It's not about how great America is, about how much it sucks. That was nice. To the 200. That was a long wait. It shouldn't have been down that much.
We are less
But
than
it
15
was. It
minutes
went
away
down to
from this
15
Friday
frickin'
close on Wall
cents.
Street. Let's get back to Christina Partsinevelos for a look at the key stocks she's watching. Christina?
Well, it's shares of software analytics firm Palantir Technology sliding almost 2% right now after the company was hit with a downgrade. Jefferies arguing that the AI hype is, quote, overblown and the so-called AI boom has yet to materialize, which is why the analyst questions Palantir's valuation, but still likes the actual business and fundamentals. The stock is down close to, like I said, 2% today and down over 6% in the past week. Meanwhile, Boeing becoming a more popular pick as of late. Analysts at both UBS and Wells Fargo named it a top pick in aerospace and defense. The stock is up 1.5% today and actually had a big run-up since October, bringing it to levels we saw back in early 2021, but still has a lot more work to do to get back to those pre-pandemic levels. Yeah.
Have a good weekend.
You too.
We'll see you next week.
Well,
Christina. Oh, I think she was saying she has something coming up in the market zone, which she does. Who knew? Up next, it's been an ugly week for tech broadly. The XLK dropping more than 4%. It hasn't stopped the street, though, from showing this one chip name some love. All the details, what it might mean for the mega caps just ahead. Closing bell, including the market zone, coming up.
That was a lucky. I didn't know what I was going to do with it. I had an average of 50 cents and a little bit. I got 25. I got a bunch of them at 25. That was so sweet. That was nice.
breaking down Apple's rough week. There's the ugly chart. Lot of red. The stock falling more than 5% over the past few days, now facing another new headwind. We'll give you the details and much more when we take you inside the market zone.
Man, that's just, it's holding up at 70 now. I could have probably bought 50 of them at 25 cents. 50 times 50 bucks. I got to start thinking about that because that's a pretty big price tag. That's $1,200 invested.
We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down the crucial moments of this trading day. Steve Kovac joins us with new details on a possible antitrust lawsuit against Apple and its supplier Foxconn, warning on guidance. Christina Partsinevelos is back, as you knew she would be, on why Wall Street is still bullish on NVIDIA. Mike, I begin with you, though. Looks like we're trying to make a run back to 4,700 here on the S&P before we close it out.
Yeah, it's been a little bit of a sticky number, a few days this year so far. Relatively, I guess, benign response to some conflicting data today. It still continues to look like this sort of low energy, profit taking / we already own enough of all these stocks type of reaction all week. Didn't really seem to have to reprice rate expectations too much. Most of the data, as much as they were a little bit noisy, confirm in general terms the soft landing thing. So I don't think we can argue all we want about what the market expects from the Fed, when they're going to get it, when they're not going to get it. I don't think it matters that much. We stay clear of imminent recession and inflation doesn't flare up, and you can probably navigate that okay.
Oh, Tuesday CPI.
Yeah,
right?
exactly.
So that's the big test.
It is, because there's a ton of conviction that inflation's still going in the right direction. Everyone's waiting for the lagged effective shelter to really start to drag on those numbers. So yeah, it certainly matters. And again, you got this retracement of Treasury yields back up to 4%. Not a big deal at this point, but you don't want it to gather momentum.
So Steve Kovac, I mean, first the analysts come out against Apple this week, and now you got a headline talking about antitrust, and the stock's down about 6% on the week. It's the biggest loser out of the mega caps.
Yeah, what a year this week has been for Apple. And this antitrust report took it from green to red. It was up about, I don't know, a tenth of a percent before this headline from the New York Times came out saying the DOJ is, quote, closer to that anticipated antitrust lawsuit against Apple. This is all regarding the ecosystem around Apple devices, the App Store, the fees, everything we keep talking about. We've been expecting this for years now. It was supposed to happen last year. It was supposed to happen in 2022. Maybe we're getting closer. We'll really start to get a sense of when this is going to drop there, Scott. Likely after the Google case wraps up with the DOJ. And maybe as soon as early this year. But let's also talk about Foxconn. That is, of course, the company that makes most of Apple's gadgets, based in Taiwan, and with production in China. They said December quarter revenue was down 5%, and sales from electronics flat from slow demand. And guidance saying sales are going to be down for the March quarter, but those comps are going to be a little wonky because if you remember at the end of 22, a lot of COVID shutdowns throughout China caused Foxconn to close their factories, so a lot of things got pushed into the following quarter. But look, bad sign for Apple and consumer gadgets overall as far as demand goes, Scott.
All right, Steve, appreciate that. That's Steve Kovac. Now to Christina Partsinevelos on why Wall Street is still bullish on NVIDIA, which I mentioned is still higher today by a couple of percentage points.
Yeah, it shows interest has not waned for NVIDIA. Bank of America reiterating as well for the company that predicting that actually NVIDIA could go on a buying spree since it'll have about $100 billion of incremental free cash flow over the next 2 years. The Bank of America analyst estimates that about $30 billion of that cash could go to buybacks, and then roughly $70 billion could go to, quote, new growth initiatives. So recall back in 2022, NVIDIA tried to buy ARM. And
Less than a minute.
It didn't work out, but clearly it has an appetite for software and IP-driven assets, so that could be where it's buying. Or it can go hunting for storage companies to be a fully rounded AI systems vendor offering everything from A to Z. And then you have some bullish notes from Truist and Mizuho, both putting out the notes today. Mizuho thinks NVIDIA will stay on track with its product launches like new server AI GPUs, even with the new restrictions on AI chips to China. And then there's another note saying that NVIDIA will continue to lead the GPU market while increasingly winning over the developer community with software and services, which helps with market adoption of its products. So that cycle just keeps on going for NVIDIA. Stock, though, is still down on the week, about 1%, Scott.
All right, Christina, thank you. Christina Partsinevelos. So, Mike, I know you don't love the idea of as goes Apple, so goes the market, but how are we thinking about what's going on this week with that stock in particular?
Okay. What is today? Today, Friday? I think it is. So in summary, we rebounded a little bit into close. Been hard for me to guide. I mean, today I could have had, this week I could have had one of my biggest days ever. That was yesterday. And what's making that noise? Trend spider alerts. Just now triggered PLTR. We definitely hit my support on PLTR just now. And I want to take it down to this inverse head and shoulders. Somewhere off this here support line here. That's where the money is. So we definitely got to watch this. We had a harmonic kind of yesterday. This is on the daily time frame. So we definitely got to watch PLTR the beginning of next week. And then I got Yeti hit the anchored VWAP. I got 2 alerts here, I think, or maybe 3. So it was also triggered just now. If anybody knows how to program, I used to be in a room. I've got a room over here on the side where I'll set my alerts. And I'd like to be able to bot that into the main chat. Jim's alerts. I don't know if anybody knows how to do that. That way I don't have to type twice into 2 rooms. So in summary, this was a pretty tough week for me. Tougher than usual. It shouldn't have been as tough because I knew we were going to pull back. So I'm really, should have been psyched out for the pullback. I called it way in advance. Pulled back in the market. Now this Apple news, they're all tripping out on it this week compared to last week. That's why they're all down in the guts. Because they've been using the Apple as an indicator to take this market up, which I think is foolish. I'm not a big Apple fan, especially when you're having declining quarter after quarter after quarter and they pump this up. So I didn't like that. And I definitely called a hard pullback. And if I just even bought the put into next week, that would have probably been a real nice trade. A very nice trade. So I was definitely anal on Apple. And we're going to pull up the weekly time frame, clean this all up. They're going to start buying into this stock next week, I think. We came down and we hit the 65. We hit my bottom support line of 181.30, which I had alerted. It can easily drop down and hit the 50 on the weekly and be a very, very strong buy because we bounced once here before and we've bounced here before. For almost a month, we held that 50. Now on the daily, it's the 200 SMA. I've got a strong, strong buy at 180.08. And I think we were 10 cents off of hitting that above the 200. This is a big flush out. So now they said Microsoft might lead the pack. Well, Microsoft ain't one that's going to lead the pack either. So if they're putting their blood in on Microsoft, I wouldn't count on that either. Now, if they said Tesla, Jimmy say, yeah. But they won't do that. Tesla hit a real strong support level on the yearly. And that was the 50 SMA. You heard that lady earlier talking about the 50. As long as we stay above the 50, we're still bullish. If not, we'll definitely drop down to the 200, and that's right around 230. The winners today were Piton, up 9.63% on the news of TikTok. We hit the 200 SMA. So we hit the 200 SMA. We hit the 200 SMA. We hit the 200, the 200, the 200. So it'll consolidate back down to right around 650 and be a good buy. Somewhere right in there. to see what happens next week with this ascending triangle at 260. It's got a gap in here. It's got a pivot point. And I'd say that 650 is a pivot point. Sophie took a big hit this week. And I don't see it on here. I thought I put it in here. There's a lot of people invested in Sophie long that got stuck in this trade. The gap down. So many of them just didn't sell. They're just holding on to it. And the ones that are in it, especially the King Lord himself, he's a pumper. He's the kind of guy that likes to stick with the same stock and trade the same stock over and over and over and over and over again. And I just said yesterday he'd come out with a video on it, or a couple of days ago. Well, he did. So we're going to see if we hold the millionaire's price of 811, the 50 SMA on the daily. If not, she could fall back and hit and be a stronger buy at the 200. But then with that kind of news or rumor, it can drop on down. Coin's another one. Bitcoin, we pulled back to 61.8% the other day and kind of building a little triangle above it. I think we still pulled back a little bit more. Banks, we really got to do our homework on the banks next week. I think that's going to be one of the catalysts to make the market run. And like I said, the other day could have been my biggest day ever. If I just stuck with what my plan, I had puts and I sold them for a small profit, and then the end of the day, we're down at the double bottom. Same thing happened today. I was in calls, scalped them, then got in the puts, took a small profit, and decided to take a double bottom on not the double bottom, but some other moving average. And then I got stuck in the SPX and the SPY. So I got lucky with the SPX. I was down. And the end of the day, last minute, boom, she jumped up 70 cents, 45. I added on to 25. China, Baba. I just don't know about this. Again, this week they came out with, indicators that China was a buy. Somebody got on here and said they've improved in the last 6 months and some kind of number or something. Does anybody know when the PPI comes out? Yeah, franchise, just unmute yourself and when you get a chance. So, people on YouTube, there is a delay. I use Tastyworks. Somebody asked me on YouTube what trading platforms I use. I use Tastyworks for a lot of my option scalping. I use Ameritrade for stocks, swing trading, penny stocks, any kind of stock. If I'm trading a stock, I only use that. I got Webull, and I have Robinhood. So I have 4 different trading platforms. I did that to get by with the PDT rule. The more platforms I had, the more I could trade. And then they opened it up to where you can trade like with cash accounts. And that's why I like Tastywork. As long as my account's cleared the next day, I can trade the funds. And every year I take so much out of the account and I put it up and I start fresh every year. And I think I'm going to start an options challenge in the SPY. Just trade the SPY. I got two different accounts with Tastyworks, a margin and a cash. And I regret getting a margin account. I wouldn't recommend that to anybody. There's no reason to have one these days. As long as your funds clear out the next day, it's all good. I like Tastyworks because the executions are so good. Ameritrade's alright. Ameritrade's good too. But now it's Schwab. So now I'm trading with Schwab. And I don't know if I like that or not. I haven't traded much out of it. I'm waiting for these dips to come in. This could just be a good opportunity for us to buy. There's so many mixed messages on CNBC. Everybody has, like I said in my little video earlier, we all look at things different. And I caught myself back then doing the same thing. And back then I just traded with Scottrade and Ameritrade. I had to do that because I couldn't trade pennies in Scottrade, or Ameritrade wouldn't post a lot of the penny stocks that I'd trade, and Scottrade did. Then they turned around and merged. Now Ameritrade has sold off to Schwab. But I learned a very valuable lesson about having 2 accounts to trade in. I don't think that's a big issue anymore, but when pennies, nobody traded pennies until the internet, till the retail trader came into the scene. Then they started getting popularity. And then we've had a stall in the pennies. Now they're starting to bounce back up. So I'm going to be looking at more of the micro caps and the penny stocks. I need to start studying them companies again. And I got a great scan for it. I got a couple of good scans. I used to do like 0.0 to 50 cents. And these things are flying. These things are flying. And I'll just go to the biggest volume and trade off them. GOEV, GT, and just go down the put it on a 20-day. See, these pennies are just flying. I haven't seen this kind of movement in a long time. I mean, they've been sold off real hard in the past 3 years. 8 cents. We were at $11. That's why I quit trading pennies. They weren't worth, they weren't, you'd get caught stuck in them things, and nobody knows how to call them out anymore. The pumpers know how to, because they trade floats. They trade off shitty news. You can see all of them. GOEV. These things have all been broke down and beat up. I got another scan up here that I like. Now, a smarter trader will trade 50 cents and up. So I've got scans in here for 50 cents, 90 cents to $2 if you want to be the safest about it. Always go with the volume high and the breakouts every morning when I used to trade these. MAIA. Here's a $5 stock at $150. $7 stock at $150. ADTH I used to trade. This in here, RWalk. This used to be a big one. So yeah, these are all set up in ascending triangle breakouts. Then I'd have like a descending one. Ascending. Descending. So yeah, I'm going to start looking at these. These things are really bouncing up good now for the first time that I've seen in years. I don't like trading them because you get involved in the pumps. People that don't know how to trade will just call them out. And 90 cents to $5. This is a real good scan for a healthier kind of trade. GSAT, that's a good one. Laser. I was trading this laser here up in this area. Now look, we got a snake breakout pullback, so we're pulled back to an inverse head and shoulders right here. So this could be ready. Squeezing with the moving averages. I'd check out the news and see what kind of float they have now. NAT used to be a good one. Still is, it looks like. For trading. Take that to the 20-day. I'd be watching this off the 200. MVIS. Here's a good one. Microvision. Traded this years ago. Them red lines represent a long time ago. LUNR. It's another good one. Here's Adam Koo's watch list from last year. I wonder if he's still trading Apple. Okay, well, this has been a real tiring week. Could have been one of my biggest weeks ever. Just in one day, I would have made probably more than I made in a year. I don't think my head's been in the game this week or something, because called the 52-week high, the all-time high, and I said we were going to pull back, and we did, and then I didn't take advantage of it. So I got to learn how to stick with my first instincts instead of just follow the day trade every day. So I'm going to discipline myself this week. I got to set my platform up a little bit better. Plus, I transitioned. I think that could have been a lot to do. I had to come up with a new strategy, a new game plan, an old way I used to trade without scanners. Not having trade ideas is really, a difference. It made me lazy. It made me lazy, for sure. It made me a better chartist, maybe. But not having that, I had to come up with, I'm still not developed it yet. It might take 2 weeks, maybe 3. But I'm definitely going to be playing earnings. Earnings is going to be every bit of whatever comes in earnings is going to make the market. I don't think it has much to do with the Fed anymore. I agree with that one guy on here. 1 hike, 2 hikes, 3 hikes, it doesn't matter. Everybody in these fat cats were talking 6, and I'm going, no. This economy's not in that great shape, but I think, but you're getting mixed messages on CNBC. It's a good economy, it's a bad economy. You have to just go with what your surroundings are. I don't know what it's like if living in New York or Los Angeles or Detroit, or I lived in Portland, Oregon. I lived in Knoxville. I lived in Honolulu, and that's all a tourist trap. And I've got 2 big cities right above me, Kansas City and St. Louis. So yeah, I'm going to probably come in here and look at some scans this week and thin them all out, find the ones that I like. I've got hundreds of scans. Above 10%, these are like breakouts. Maybe catching a pullback. Used to be gap plays. Big old gap coming up. I see if the news is worthy. If there's no news, short it to the 200. This one here has been up here a lot. It's AXGN. Every one of them were good trades today. This one didn't have much volume. That's 10% plus. So let me see how I got that in here. Net change of 90 cents. Volume up above 100,000, which should be probably more. Percentage change of 10% with an ascending triangle. So it's a pretty simple scan. I think that'll be about it. I wish everybody on YouTube hit that like button. We'll catch you later. I'll do some videos this weekend, so be sure to watch my alerts in the video. I might do it sector-wise. I definitely want to go through the next week's bank earnings for Friday. We could be trading in banks. And I think it is earnings update. So next week's earnings, We got Bank of America, BlackRock, Citibank, Delta Airlines, Dallas, JP Morgan, which is the most watched one, United Healthcare, and Wells Fargo Wagon, all on Friday. So I'm going to do a video on every one of these here, all lumped up in one. And I think my favorite ones in here, if Bank of America pulls back, JP Morgan is my number one. We got United Healthcare. That's going to be the one to watch. UNH. If UNH comes out, that means Humana will do good. Now we've got a good breakout here already. She's pulled back. So we got support right there. If it comes back down here to right around 528, I might load that baby up. Pay attention to Mike's alerts in the room. Mike's very proud of his alerts. I got lucky today, definitely. Looks like we got some fights going on this weekend. So I'll be watching the fights. Ricky, I'm glad, did you come out green today? I know it was a tough day for you. Slightly red. So this was a flush out week, and Apple didn't help matters. And I blame CNBC for that, pumping that on bad news last week. I knew they were going to get downgrades. You banned on Apple Watch. I mean, they boasted and bragged about that watch all year long. And then when the ban comes in, they snub it. Oh, that don't mean nothing. It's only 1.4% of the sales. I used to have a belly like that. So let me see. PLTR, I think we're going to get some movement on it next week. It's got money. It's profitable. NVIDIA. We always got to keep that on any dip. Google, they're pumping. IBM. I didn't look at IBM today. Yeah, we're going to fall a little bit more on it. See, everything just had such a big run. And you heard him today. They'd come out after the fact and say, oh, we took some off the table. they're telling everybody to hold it over the. Said we're going to have a big bounce. That Tom Lee was disappointed with this week. I think it was too easy to see because we had such a humongous run, and like I said, I've never seen. They said we had no Santa rally, and I said, well, to me, Santa rally went for about 2 months, 9 weeks. If they're just calling the last week of the trading period, fine, let them do so. I define a few things differently. We'll catch you later.
The all-electric Genesis GV60. It won't take...
Following final confirmation of rocket and payload readiness, 2 GEM 63XL solid rocket boosters and twin BE-4 engines produce more than 1.7 million pounds of thrust to lift ULA's Vulcan rocket away from Cape Canaveral Space Launch Complex 41. Shortly after liftoff, the rocket begins a pitch over to attain the proper flight path while minimizing the dynamic pressure it experiences during flight. Vulcan then reaches Mach 1, the speed of sound. With the ability to add 2, 4, or 6 solid rocket boosters, or SRBs, Vulcan can be precisely configured to take any mission to space, from low Earth orbit to Pluto and beyond. These boosters augment the rocket's total thrust at liftoff, adding approximately 460,000 pounds of thrust per SRB. With their propellant expired approximately 90 seconds into ascent, the SRBs burn out, followed by jettison. Jettison time is variable, occurring between 100 and 150 seconds after liftoff, depending on mission requirements. Vulcan's guidance system then activates to steer towards the precise target in space. First stage flight continues as the rocket crosses the Kármán line, entering space. With the majority of propellant expended as Vulcan fights against the force of gravity, the BE-4 engines shut down, and the booster stage separates. With the rocket now weighing less than 10% of what it did at liftoff, dual RL-10C engines on ULA's Centaur upper stage ignite. Spacecraft are encapsulated inside a 5.4-meter diameter payload fairing, which provides a protective environment during ascent. Following Centaur engine ignition, the payload fairing is jettisoned. With the first burn complete, the Centaur engine shuts down for a coast phase. Centaur flies a short, medium, or long coast, which is determined by launch day. Further into flight, Centaur ignites for a second burn, powering the vehicle into a translunar injection orbit. Following the second main engine cutoff, ULA Centaur places Astrobotic's Peregrine lunar lander into a highly elliptical orbit, more than 220,000 miles above Earth, where it will intercept the Moon. Following delivery of the Peregrine spacecraft, Centaur comes alive for a third and final burn to reach a heliocentric orbit around the Sun. Centaur completes the CERT-1 mission by carrying Celestis' Memorial spaceflight payload into deep space. Known as the Enterprise flight, this mission includes 234 flight capsules containing cremated remains, DNA samples, and messages of greetings from clients worldwide on an endless journey in interplanetary space beyond the Earth-Moon system to orbit the Sun forever.
Very interesting. We'll see y'all later, YouTubers.